Hello, everybody. Welcome to this special English marathon for CA Final Direct Taxes and International Taxations, International Taxation portion, where we aim to complete this whole syllabus of international taxation in least possible time. This marathon will be in complete English, so every student who is from South India can take benefit from it. Also, this marathon aims to complete things in such a way that you can revise it a day before exam also. So things are meant to be a bit faster. I expect you already know a few things about this chapter. This is a faster revision come marathon so that even if you are studying it for second time, you will be able to understand everything. And even if you are revising a day before exam, it will be a full-fledged revision for all of you. So without wasting any time, let us right away start from non-resident taxation. What does non-resident taxation aims? It aims to tax a non-resident. It aims to tax a non-resident. For taxing a non-resident, we need to identify who non-resident is. So first part, we will be aiming identifying non-resident. Second part, which income shall be taxable in India? We have to tax his income. For that matter, we need to know which income will be taxable in India. So second part will be aiming to identify what income will be taxable in India, and third part aims at applying tax rates for such income. That is the part three. So right away, starting from part one, we need to understand who is the resident of India and who is the non-resident from for India. For that matter, we will be studying residential status. Residential status. The study of residential status comprise residential status of four-person. For example, individual, HUF, AOP, BOI, or any kind of firm, and last one is company. For each of the SSC, we have to find out residential status individually, and for every SSC, we have different method of finding out the residential status. First of all, for individual, what it if an individual fulfills any of the condition prescribed under section 6(1) shall be deemed to be resident of India. What is the condition prescribed under section 6(1)? It says his stay in India should be for 182 days or more in previous year. His stay in India be 182 days or previous year, or the provision says his stay should be 60 days or more in previous year and 365 days or more in preceding four previous year, not the previous year but preceding four previous year. His stay should be more than 365 days. So what I said, his stay should be greater than 180 days, that is the 182 days, that is the first condition. And second condition says his stay should be more than 60 days in previous year and 365 days or more in preceding four previous year. If any of the conditions is being fulfilled, he shall be deemed to be resident of India. Did you get this point or not? Yes, sir, we did understand. Now we have to understand the second condition of 30, 60 days and 365 days is not applicable in three cases. This condition is not applicable. That means in following three conditions, if he is resident for 180 days or more, he will be resident. Otherwise, he will be completely non-resident. What are those three conditions? First case is when a person leaves India for employment. If a person leaves India for employment, then second condition is not to be checked upon. Second thing, any crew member of Indian ship, if he leaves India, then this second condition is not to be checked. And the third person, if a Indian citizen or person of Indian origin visits India and his total Indian income is up to 15 lakh, then the second condition is not to be checked. We just have to check the first condition. If he fulfills first condition, he will be resident. Otherwise, he will be non-resident. Sir, what if he becomes resident of India? Then what to do? Then you have to check whether he is resident, ordinary resident, or resident but not ordinary resident. Sir, how to check whether he is resident, ordinary resident, or resident but not ordinary resident? We have to check additional conditions prescribed under section 6(6). Section 6(6) prescribes two additional conditions. For that matter, we have to check if both the conditions are fulfilled. If both the conditions are fulfilled, he will be resident and ordinary resident. Otherwise, he will be resident but not ordinary resident. So what are the conditions prescribed under section 6(6)? We have two conditions. He should be resident in at least two previous year out of 10 preceding previous years. He should be resident for 2 years out of the 10 preceding previous years. Sir, how resident? Sir, you have to check section 6(1) for finding out the residential status in two previous years. Second thing, his stay in India should be, sir, 730 days or more in preceding 7 previous year. In preceding 7 previous year, he should stay in India for 730 days or more. If he satisfies both of these conditions, he shall be deemed to be resident and ordinary resident. Otherwise, he shall be resident but not ordinary resident. Did you get this point or not? Yes, sir, we did get this point. Two or three basic things you need to know. So we have already studied that if a person is Indian citizen and person of Indian origin which visits India and his total income is up to 15 lakh rupees, then what to do? Then we don't have to check the second condition. We don't have to check the second condition. That is, we already know. Sir, what if his total income is greater than 15 lakh? Then what to do? If his total income is greater than 15 lakh, then what to do? Then you have to check the second condition. You have to check the first condition and you have to check the second condition. But for checking the second condition, this 60-day limit will be changed to 120 days. That means for this matter, you will be checking 120 days stay in previous year and 365 days in preceding 4 previous year. And also one thing, if he becomes resident because of only this condition, he becomes resident because of only this condition, then he shall be deemed resident but not ordinary resident. You need not to check six additional conditions. You don't have to check. You don't have to check additional conditions as prescribed in section 6, subsection 6. But he becomes resident as per 180 days. Then you have to check the additional condition. You have to check whether resident, ordinary resident, or resident but not ordinary resident. Did you get this point? This was the bottom line. This was the gist of person resident in India or resident person. Another thing, so whenever a person visits India and goes out of India, the day on which he entered India and the day on which he left India will be considered as stay in India. That is the bottom line. You all know very much well. But if a person of crew member of Indian ship, if a crew member of Indian ship visits India, then entry and exit date shall be excluded from the stay in India. What I am saying, ordinarily entry and exit are included in stay in India. But if a person is a crew member of Indian ship, then entry date and exit date shall be excluded from the Indian stay. That is the bottom line that you have to check. You must remember this point whenever you are checking number of days stayed in India for a crew member of Indian ship. This was all about residential status of an individual. Another point we have deemed resident. So what does this imply? So if there is any Indian citizen or a person of Indian origin, Indian citizen and person of Indian origin. So who is person of Indian origin? Any person whose parents or whose grandparents were born in undivided India. For example, Rishi Sunak. He was president of UK. His grandparents were born in Pakistan. So they were born in undivided India. So for that matter, Rishi Sunak is a person of Indian origin. Got this point? So what this section says, if a Indian citizen or person of Indian origin whose total Indian income exceeds 15 lakh, Indian income exceeds 15 lakh and is taxable nowhere. Nobody is taxing him just because of his domicile. He stays in India for 40 days in India. He stays in UK for 40 days. He stays in Germany for 40 days, because of which he becomes resident of no country. For that matter, what this provision says, he shall be resident of India, but he shall be resident but not ordinary resident. Did you get this point or not? Did you get this point or not? Yes, sir, we did get this. This provision is not applicable if he is already resident of India. Then we have to check how to check residential status for Hindu undivided family. If control and management of its affairs are being wholly outside India, then it will be non-resident. But if affairs are wholly or partly in India, then it will be resident. And for HUF also, we have to check whether that HUF is resident ordinary resident or resident not ordinary resident. How you will be checking? You have to check whether Karta of that HUF satisfies the additional conditions prescribed under section 66 or not. If yes, then it will be resident, but ordinary resident and ordinary resident. If not, then it will be resident, but not ordinary resident. Sir, for firm, AOP, BOI, local authority, artificial juridical person, how will you check the residential status? Sir, if control and management of the affairs are wholly or partly in India, then it will be resident. If wholly outside India, then it will be non-resident. The most important thing now is residential status of a company. For this matter, I want you to focus on a point. What I am saying is, sir, we have two concepts in income tax. First concept is domestic company, and other concept is foreign company. Along with that, we have two more concepts in income tax, that is resident company and non-resident company. Sir, what is the difference between these two concepts and those two concepts? Sir, domestic company and foreign company demarcation is being made just because of our tax rates. A domestic company's income will be taxed at 25% or 30% depending upon turnover, and foreign company will be taxed at 40% depending. Foreign company will be taxed at 40%, no turnover benefit is given. Domestic and foreign company demarcation is being made just because for the purpose of taxes. But resident and non-resident demarcation is being made to find out the scope of total income. Which income is Indian income will be taxed only for non-resident. But for resident company, income throughout the world, income from whole world will be taxed in India. For that matter, you have to understand what is resident company and what is non-resident company. Domestic company and non-domestic company and foreign company demarcation is being made just for the purpose of tax rates, but resident and non-resident company demarcation is being made for identifying the scope of total income. For resident company, only for whole world income will be taxable, and for non-resident company, only Indian income will be taxable. That is the basic difference. Here we are studying the residential status to find out the scope of total income. Sir, we have to understand, if any Indian company, if we have only if we have Indian company which is registered under companies law under section under 1956 or 2013, it will always be resident. For example, Reliance, Infosys, these are always resident. But other companies, sir, if other companies which are foreign companies, sir, if they have POEM in India, then it will be resident. Otherwise, sir, it will be non-resident. Sir, irrespective of the fact whether they are resident or non-resident, tax rate shall be 40% only. Every foreign company is liable for tax at the rate 40%, irrespective of the fact that they are resident or non-resident. Did you get this point or not? Sir, what does the POEM imply? POEM imply place of effective management. Place of effective management means place where key management and commercial decisions are necessary for the conduct of the business of the entity are taken in substance. Important business decision, the place from where important key decisions or business decisions are being made for that entity will be considered as POEM. For example, if a company is in India and complete decision making is being made at UK, so POEM will be UK. That is what we have to understand. How to identify POEM? First of all, you need to remember that POEM concept is only applicable for companies having turnover greater than 50 CR. No company below 50 CR will have to apply POEM. Only companies having turnover greater than 50 crores will be having POEM concept. Lesser than that, you have to check whether resident, whether incorporated in India, then resident. Otherwise, it will be non-resident. That is the bottom line. How to identify POEM? Sir, you have to check POEM identification is a two-step process. First of all, you have to check ABOI test, and then you have to check other company test. So what does ABOI test imply? ABOI test imply you have to check whether company has active business outside India or not. If company has active business outside India, that means POEM is outside India and company will be non-resident. How you will check whether company has active business outside India or not? For that matter, we have 5 conditions. Sir, what 5 conditions it says? Sir, passive income is up to 50% of the total income. Sir, any company whose total income, whose passive income is up to 50% of the total income, then we can simply say that company's income is actively outside India. Is less than 50% of the total assets are situated in India. This implies companies actually doing business outside India. For that matter, it is having assets up to 50% only in India. If a company less than 50% of the total employees that are situated in India are resident, less than only 50% of the employees are resident of India. That means companies actually doing business outside India. For that matter, it has active business outside India, and POEM lies outside India. Fourth point says payroll expenditure on such Indian employees is less than 50% of the total payroll expenditure. Sir, 4 conditions, and fifth condition, majority of the board meetings shall be held outside India. What I am saying, just repeat after me. Sir, what 5 conditions you have to check? First of all, sir, passive income is up to 50% of the total income. Assets located in India are 50% of the total assets, less than 50%. Number of employees, a resident of India has to be lesser than 50% with respect to total employees. Number of employee benefit expenses paid in India, paid to Indian employees, has to be less than 50% with respect to the total employee costs that company is incurring. Also, you have to check board meetings. Majority of the board meetings shall be held outside India. If all the 5 conditions are fulfilled, then only you can say that company is having active business outside India and its POEM lies outside India and it will be non-resident. If one of the condition even is fulfilled now, then you have to say that company has POEM in India. Then you have to say company has POEM in India. If any of the condition is not fulfilled now, you have to accept that POEM is in India. Sir, meaning of certain terms. Sir, what does passive income implies? Sir, income from, sir, royalty, dividend, capital gain, interest. Sir, for except banking company, for banking company, interest dividend will be PGBP income. Otherwise, sir, for any other person, interest income will be other sources income or passive income. Rental income, it is also passive income. Sir, income from purchases made to associate enterprise and sales made to associate enterprise will be passive income. Sir, if there is entity say Rahul Limited, if we have entity name Rahul Limited, it purchased certain goods from associate enterprise and sold the same goods to associate enterprise, then whatever income Rahul Limited has will be, sir, passive income. If I'm only doing purchases and sale to unrelated party, then it will not be passive. If I'm only doing purchases from unrelated party and selling to associate enterprise, it will not be passive income. Both purchase and sales are to be made to associate enterprise to qualify such income as passive income. What is income? Income implies income as per the tax laws of the country. What is the value of assets? Sir, for depreciable assets, you have to check block of asset and opening and closing WDV. For other assets, you have to check assets as per books of accounts. Number of employees, sir, average number of employees from the beginning date and end date, including contract employees. Sir, for number of employees condition, you have to check any number of employees, any kind of employee, whether contract employee or any kind of employee. You have to check average number of employees on first date and last date. You have to average it out and you have to find the number of employees. So what does payroll implies? Payroll implies any kind of employee benefit expenses borne by the employer. It may be salary, it may be bonus, it may be wages, any kind of employee benefit expense. Sir, what if, sir, board is not, just wait for this process. Now you have to see the second process. Second process, what it says. For other company, how will you identify if you are not given with information of active business outside India? You are not given with above five information like passive income, like assets, like payroll, like number of employees. If you are not given with, what you will do, you have to check whether you have to identify the key person making key management and commercial decision. You have to identify who is making decision in that company. And second step is place where such decisions are in fact made. This is more important. For example, in Reliance, Mukesh Ambani takes the most important decision. That is the first step. And in second step, where does Mukesh Ambani lies as he stays? If he stays in UK, then his poem will be UK. Then Reliance's poem will be UK. First of all, Reliance is registered in India, so it is just an arbitrary example. You need not to get confused. Just assume a company whose decisions are being taken by some person, and where he stays is the place where poem will lie. Okay, sir, got this point. Sir, for example, when board of directors exercise authority and take commercial decisions, sir, if board of directors take decision, then what will happen? The place where such decisions are taken will be considered as poem. Second thing, powers are being delegated by the board to senior management or others. For example, board of directors delegated such powers to audit committee. Then then what will be the poem? The place where such audit committee takes the decision will be considered as poem. Sir, if board of directors delegate their powers to executive committee, then what will happen? The location of executive committee will be considered as poem. Sir, what if decisions are being made in a circular resolution? Then you have to see location of the person who has authority to take decision. Any person who has authority to take the decision will be considered as poem. Sir, what if some matters are reserved for shareholders? What if some matters are being reserved for the decisions by the shareholder? How poem will be determined in that case? You have to understand decision of poem is irrelevant in terms of shareholders. Shareholders have no say. Shareholders have no say in determination of poem. Only board of directors have any say. So for that matter, it is irrelevant for determination of poem. Sir, if company is decentralized, that means it has multiple locations. How will you determine the poem? You have to check where senior management is located. That place will be considered as poem. If senior management operates remotely from different locations, then what will you do? You have to check. You have to identify the senior most personnel of that company. Location of that senior most personnel will be considered as poem. Did you get this point or not? I am requesting you, all the hands joined together, both the hands joined together, that this topic was easy. This topic was scoring. You cannot think of leaving this topic. Enjoy this repetition. So now things. So if board is not exercising powers of the management and such powers are being exercised by the holding company, then what will be resident? So for example, if a company is located in UK and board of directors are not exercising their powers, its powers or decision making is being made by the company resident in India, what will be poem in that case? In that case, poem will be considered India. Second thing, board of directors are board of directors have outsourced general policies like payroll, accounting, HR, IT network, supply chain, routine banking, operational procedure. Then can that be considered as board not exercising power? For example, if a company is in USA and it has outsourced payroll work, accounting work, HR work, supply chain, routine operational, and these small petty works to a company located in India. Can I say that company has poem in India? Right answer is no. These are routine works. This can be outsourced. Key decision making does not involve such processes. Therefore, poem is not dependent upon such smaller things. Sir, if a company, because of certain things, tries to do abusive tax planning, by applying the concept of the poem, in that case, provisions of GAR will apply. Provision of GAR, general avoidance rules will apply. How you have to consider data? You can consider data for previous year and to preceding previous year. If not, if data is not available for preceding to previous year, then take the data of the previous year only. These were the basic points in case of poem in case of residential status of a company. Now, there was an example given in institute study material. Sir, if a company in country A, in a country X, if we have a company named A in country X, it is the holding company or a part of the group company whose networks are in India. For example, India has a multinational entity. For example, India has a multinational entity. One of the company is in country X, named country A. It is a part of country company A. Company A is a part of Indian multinational group. Indian multinational group. Okay. Now, company A's business is to just invest in its subsidiary. Companies A work is to invest in the subsidiary and earn the dividend income, interest income. That is the only work of this company. This company's decision are being made by a person resident of India. For that matter, this company will have poem in India. It is very crystal clear. Also, this company A is 100% parent of company B, company C, company D. 100% parent. All the decisions are individually made by the board of directors of these respective companies. For that matter, can I say if company A has poem in India and it is 100% parent company, then company B, C, D will also be resident of India? Right answer is no. Right answer is no. Why, sir? Why no? Because you have to check OM for individual companies, irrespective of the fact that these are 100% subsidiary. Even if they are 100% subsidiary, if their decision making is independent, their POEM may lie outside India. For that matter, for POEM, you have to check differently for subsidiary and differently for the holding company, irrespective of the fact that they might be having 100% parent holding relationship. But this point, yes, sir, we did get your point. Now, what we have to study is part two, scope of total income. What we have studied till now, sir, we have studied how to identify the non-resident. We have identified the non-resident, who non-resident is. Now we have to tax such non-resident. For that matter, we need to find out which income will be taxed. Which income will be taxed? What will be his scope of total income? For that matter, we already know that if we have any kind of non-resident, his only Indian income will be taxable. Any Indian income for such non-resident will be taxable. Sir, his foreign income will not be taxable in India. Or any other income from business and professional setup, business or profession set up from India will not be taxable. For non-resident, only Indian income is taxable. But for resident person, all the incomes, sir, are taxable in India. All the incomes, sir, be it Indian income, be it foreign income, be it income from business and profession controlled and set up from India, every income is taxable for resident person, resident, ordinary resident. But for resident but not ordinary resident, what we have to check? So Indian income is taxable. Income from business and profession control setup from India is also taxable, but other incomes are not taxable. Other incomes are non-taxable. Got this point? Yes, sir, we did get this point. For other SSCs, sir, for resident SSCs, Indian income, foreign income, both taxable. But for non-resident SSC, only Indian income is taxable. So bottom line is, sir, for non-resident, Indian income is taxable. That is the bottom line. For that matter, we need to identify what is Indian income. That is the part of this topic. That is the scope of this topic, to identify what Indian income is. For that matter, you have to read the definition of Indian income. What does Indian income imply? Sir, any income that is received or deemed to be received in India. Income that is received in India or deemed to be received in India. Income accruing in India or arising in India or deemed to accrue arise in India. What it's saying? It is saying four things. The income received in India, income deemed to be received in India, income accruing or arising in India, or income deemed to accrue or arise in India. These are the four kinds of income that are considered as Indian income. For example, any income that is being received in bank account, or a bank account in India, or it is received in India, then it will be Indian income. Any income earned by any person, if it is received in India, it will be completely Indian income. But what does this deemed to be received in India implies? What does this income deemed to be received in India implies? Sir, for that matter, we have to refer section 7. What section 7 says? Some income shall be deemed to be received in India. Even if received outside India, it will be deemed to be received in India. What it says? Sir, if contribution is being made, contribution to PF, sir, contribution to PF is being made greater than 12% of the salary. For example, any employer contributes greater than 12% of the salary. Sir, any such contribution will be deemed to be received in India. It will be deemed to be received in India. Second thing, any interest on such PF, sir, is greater than 9.5%, then any excess interest will be deemed to be received in India. Any contribution in pension fund made by either central government or any other employer will be deemed to be received in India, or any contribution to unregistered provident fund will be deemed to be received in India. What I said. Sir, income received in India, either received in India or sir received in bank account of India will be received in India. Second thing, income deemed to be received in India, less important. You can skip this topic. Sir, income deemed to be received in India implies sir contribution in excess of 12% to salary. Sir, interest in excess of 9.5% of the salary, any contribution by the employer in the pension fund or any contribution to unregistered provident fund will be income deemed to be received in India. Now we have to study income accrued in India or income deemed to be accrued in India. Income accrued to be accrued in India and income deemed to be accrued in India. For that matter, we have to refer section number 9, and section 9 requires your patience. Section 9 requires your patience. For that matter, we have to understand section 9 has 8 clauses. Clause 1 to clause 8. And each clause states a story in itself. For that matter, I require your patience. Just study along with me what it says. So section 9, clause 1 says, income accruing or arising outside India, directly, indirectly through business connection in India, any property asset or source located in India, or any transfer of capital asset in India will be income accrued or deemed to be accrued in India. What it says, any income from business connection in India will be deemed to accrue in India. Any income from the property located in India will be income deemed to accrue in India, or any kind of income from transfer of capital asset will be deemed to accrue in India. So it implies, sir, any kind of direct transfer or any kind of indirect transfer. Okay. Sir, what does business connection implies? What does business connection implies? Just focus here. For understanding business connection, you need to understand two different concepts. So business connection implies business in India. If a foreign person comes to India and does business in India, for that matter, as per Income Tax Act, business connection is established. If a person comes to India, has an office, has a license office, has a factory, that means he is doing business in India. For that matter, business connection will be established. But sir, business connection can be established via agent also. Business connection can be established via agent also. For example, we have Mr. Ross. Mr. Ross in USA. Mr. Ross never visits India, but he has an agent in India named Rahul. Sir, Rahul carries out activity on behalf of Mr. Ross. Okay. What Rahul does? Rahul concludes contract in India habitually on behalf of Mr. Ross. Rahul maintains stock for delivery, or Rahul habitually secures mainly or wholly for this Ross, for this non-resident, then in that case, Rahul will be considered as business connection established via agent. Rahul will be considered as agent of Mr. Ross, and Mr. Ross will be considered as having business connection in India. Any such income arising from Rahul then will be taxable in the hands of Mr. Ross. Got this point or not? Yes, sir, we did get this point. So, for example, if any non-resident appoints any person in India to act on behalf of such non-resident, for example, Mr. Ross appoints Mr. Rahul to act on behalf of Mr. Ross, and Mr. Rahul, sir, concludes contract in India, maintains stock for delivery, and habitually secures order for non-resident, in that case, sir, non-resident will deem to have business connection in India. As soon as business connection is established, any income will be deemed to accrue arise in India. Sir, also, sir, if Rahul acts for Mr. Ross, then business connection is directly established. But if Rahul acts for Miss Monica, if Rahul acts for Miss Monica and Miss Monica is sister of Ross, or if Miss Monica is being controlled by Ross, or if Miss Monica controls Ross, or if Miss Monica and Mr. Ross are being controlled by third person, then business connection indirectly will also be established with Miss Monica. I hope this point is really very clear. Sir, but what if Mr. Rahul does same thing for Mr. Ross, Mr. Same thing for Mr. Joe Biden, Mr. Same thing for Mr. Donald Trump, same thing for Kamala Harris? If Mr. Rahul does the same thing, same work, same all three work for all the different people, all the non-resident person, can I say that business connection is established? Right answer is no. Right answer is no. Because Mr. Rahul here in this case is independent agent. Mr. Ross is not carrying out activity only in the name of Rahul, but Mr. Rahul is helping out everybody. In that case, business connection is not established. What I am saying is, sir, business connection shall not be established if non-resident carries through broker work, general commission agent work, or independent who does not only mainly work for one non-resident. If an agent does not ordinarily work for only one person, then in that case, business connection is not established. I hope I made my point very clear. Sir, business connection can be established in another form also. In another form also, sir, business connection via significant economic presence. I hope all of you must have heard about the name Spotify. If a company, if a company, if a company, what it says, transacts in goods or services, transacts in goods or services, or download of software. Any company transacts in goods or services. So Spotify sells their subscriptions. It is transacting in services or download of software in any person in India. And for that matter, Spotify collects greater than 2 CR of proceeds from India, or Spotify has more than 3 lakh downloads, then Spotify will be deemed to have significant economic presence in India. Significant economic presence in India. So, what significant economic presence implies? Sir, any non-resident transacting in goods or services with person resident of India and collects a 2 CR of revenue, or has got downloads of 3 lakhs or more. In that case, such non-resident will have significant economic presence in India. Despite of the fact that they do not have any agreement in India, they do not have any business place in India, they will still be considered as significant economic presence. And for that matter, any income arising from such presence will be taxable in India. That will be considered as business connection. Got this point or not? Sir, what kind of incomes can be taxed under such significant economic presence? Sir, such incomes include advertisement to Indian person. For example, listen. If Spotify, if ad comes on the Spotify and such money is being made, if such money is being paid by the boat company. For example, boat is that variable that Aman Gupta has created. Now, if boat pays certain sum to Spotify, then any advertisement showed to resident person or person using IP address of such IP address to use such advertisement. In that case, any income earned by such Spotify will be taxable in India. Sir, for example, I listen songs and Spotify got to know that my breakup has occurred. My breakup has occurred. I was just crying. I was just listening all the sad songs, all the melodramatic songs on Spotify. Spotify got to know this information and they sold my information to Tinder. They sold my information to Bumble, and now I am getting ads from Bumble. So any income made by the Spotify by selling my data or selling data of any person who has used IP address of India, then in that case, any such income will can be taxed in significant economic presence. Or any sale of goods, data collected from person deciding what it says. Sir, it says, for example, my breakup has occurred, and Spotify got to know about this. They sold my data to Tinder. So any income of Spotify on sale of such data to Tinder will be taxed in the hands of Spotify. But also, if any further sale is being made from the data collected, then that will also be taxable. For example, if Spotify sells my data to Tinder, and now Tinder is able to sell me their premium subscription. In that case, such premium subscription will also be taxable in India under business connection head or under significant economic presence. I hope you got this point. That a few transactions cannot be treated as business connection. It is important question from your examination point of view. You need to remember this. Sir, any kind of purchase of goods for export. Sir, for example, if any person purchases goods from India just to export from India, can I consider it as business connection? Right answer is it is not business connection. If any news collection is being made for transmission outside India, sir, can I say if a company like BBC sends their news reporters to India, can I consider that those news reporters constitute business connection? Right answer is for news channels, it has been exempted. They may not constitute any kind of business connection. If a non-resident or non-citizen person visits India, if a non-resident or non-citizen visits India for shooting films, in that case, it will not constitute business connection. But you have to remember every person in that movie, every cast member of that movie has to be non-resident and non-citizen, and also they must not be fulfilling conditions that are prescribed under section 6.1, that is 182 days or 60 days, 65 days. They shall not be fulfilling these conditions. Got this point? Yes, sir. Any kind of display of uncut and unassorted diamonds in special notified zones by foreign company. So what it says, any foreign company display of uncut unassorted diamonds in special notified areas. So in that case, it shall not constitute business connection. It shall not constitute business connection. But what if an individual displays uncut unassorted diamond in special notified areas? It will constitute business connection. You have a question in your question bank where an individual does some activities relating to uncut unassorted diamonds in special notified zones, it will constitute business connection. This exemption is only available for foreign companies. I hope you got this point. See, we had business connection till now. We had business connection till here only. What we are studying, just focus. In section 9, we are studying income that will be deemed to accrue or arise in India. Clause 1 says business connection is the one that Clause 1 says income shall be deemed to accrue or arise in India if they fall out of business connection or any property held in India or any kind of transfer. We have studied part 1. Part 1 of clause 9. Clause 1 of section 9. Part 1 of, wait, what we have studied? Part 1, or I can say clause 1 of section 9(1). Got this point or not? Yes, sir, we did get this point. Sorry, what we have studied, clause 1 of section 9(1). Yes. Clause 1, we have three parts. We have three parts of business connection. We have income from asset. And third one was sir, capital gain. We are done with business connection. Now we have to move forward to income from any property located in India. Income from any property, asset, source of income situated in India, then such income shall be deemed to accrue or arise in India. For example, we have a non-resident named Mr. Ross. Non-resident, Mr. Ross. Mr. Ross has a flat in Delhi. Flat in Delhi. So any income from such flat that is located in India will be taxable in India because it will be deemed to accrue or arise in India. That is the bottom line. If any non-resident has any property located in India and income arising from such property will be taxable in India in the hands of such non-resident. That is what the part 2 says of this clause. Part 3 says any income from the transfer of the capital asset situated in India. Any transfer of capital asset that is situated in India will be taxable in India. Sir, what this point says? This point says, for example, this is Mr. Ross. Mr. Ross is a non-resident person. Now, Mr. Ross transferred a flat in Delhi, flat in Delhi to Miss Rachel. Miss Rachel is also non-resident. Sir, since transfer is being made from non-resident to non-resident, but since property is located in India, then any gain arising in the hands of Mr. Ross will be taxable in the hands of Mr. Ross. Any capital gain will be taxable in the hands of Ross since property is located in India. Capital gain will arise in India and income will be deemed to accrue or arise in India. Another concept, sir. Another concept. Sir, what if Mr. Ross transfer, so sorry, sir. Another example we can check for Vodafone India Limited. We have this was the case of the direct transfer. Any indirect transfer now will also be taxable in India. What does indirect transfer implies? Sir, for example, we have company named Hutchison SR in India. Hutchison SR in India. Such Hutchison SR has a 67% parent named CGP Mauritius. CGP Mauritius is 100% subsidiary of HTIL. What happens is CGP Mauritius wanted to sell this Hutchison SR to Vodafone PLC. Vodafone PLC. Correct. Now, if CGP wants to sell this Hutchison SR to Vodafone PLC, then capital gain will be taxable in India. Capital gain will be taxable in India since asset is located in India, then capital gain will also be taxable in India. But what they did, HTIL sold the shares of CGP Mauritius to Vodafone PLC. What was the case? Sir, they sold a company which was non-resident. They sold assets which were non-resident. What I am saying, a non-resident company selling shares of a non-resident company to any other non-resident company, nothing lies in India. So whether tax will be India or not, it depends on the fact that this company derives its value. This CGP Mauritius, if it derives substantial value from Indian assets, then the CGP Mauritius will be deemed to be located in India, and any transfer of the CGP Mauritius will be taxable in India. So what I am saying, shares of foreign company shall be deemed to be situated in India. Shares of foreign company will be deemed to be situated in India if such foreign company derives substantial value from assets located in India. If such foreign company derives substantial value of the assets located in India, then such foreign company will be deemed to be located in India, and any transfer of such company will be taxable in India. Got this point? Sir, what does indirect transfer implies? Sir, for that matter, we have to check what does derive substantial value means. What does derive substantial value means? Sir, for that matter, you have to check specified date or date of valuation. Date of valuation. On valuation date, you have to check whether value of Indian assets held by such foreign company exceeds 50% of the value of the assets of such foreign company. For example, in this case, CGP Mauritius, on the date of the valuation, whether total balance sheet of such CGP Mauritius consists greater than 50% of Indian assets. Does it exceeds greater than 50% of the Indian assets? So what it says, value of Indian assets held by foreign company represents greater than 50% of the value of all assets by the foreign company, and such value exceeds 10 CR. You have to check whether such value of Indian assets exceeds 10 CR or not. And sir, and greater than 50% of value of Indian assets of the foreign company are Indian assets. If both the conditions are fulfilled, then we can say that such foreign company derives a substantial value from Indian assets. For that matter, we need to understand what is specified date. What is specified date? On what date valuation will be done? First of all, you have to check the balance sheet date. You have to check the balance sheet date. Last balance sheet date of that company of CGP Mauritius will be considered as spare valuation date. But you have to check the balance sheet date and the date of transfer. If increase in asset in such foreign company from the date of balance sheet till the date of transfer is more than 15%, if increase in asset in such foreign company is more than 15%, then date of transfer will be considered as valuation date. Otherwise, date of balance sheet will be considered as valuation date. On valuation date, we have to determine whether value of Indian assets exceeds 50% of the total assets and they exceeds 10 CR. In that case, it will be considered as substantially deriving its value from Indian assets. Any capital gain arising from capital gain will be taxable in India. Got this point or not? Yes, sir, we did get this point. So there are certain things, certain examples that we need to understand. We have an example here. With this example, we will be able to clear up things we'll be able to clear up things. So for example, Hutchison SR is an Indian company. CGP Mauritius holds 67% in Hutchison SR, and HTIL Hong Kong holds 100% in CGP Mauritius, that is the foreign company. This is the balance sheet as on 31st March 2024. This balance sheet is of CGP Mauritius. Share capital is 1000 CR. Reserve surplus is 7000 CR. Sir, investments in Hutchison SR. Sir, investment in Hutchison SR is 5000 CR. Sir, and other current assets are 3000 CR. That means on balance sheet date, can I say total value of Indian assets, total value of assets are 8000, and out of that 8000 CR, 5000 CR are Indian assets. That means greater than 50% are Indian assets. Okay. Sir, HTIL sold 100% shares to Vodafone PLC. HTIL sold 100% share, 100% shares of CGP to Vodafone PLC. Sir, for 12,000 CR. Sir, on 30th September 2024. On 30th September 2024, this sale was occurred. On the date of transfer, this is the balance sheet of CGP Mauritius. So share capital is 1000 CR, reserves is 8500 CR, investments still remains 8500, but current assets are being increased to 4500. Can I say that increase in assets is more than 15% or not? Sir, on balance sheet date, total assets were 8000, and on valuation date, total assets are 9500. Can I say increase is greater than 15%? Right answer is increase is greater than 50%. Increase is greater than 50%. So our valuation date will be 30th September 2024. On valuation date, you have to check. So total assets are 9500 crore. And out of these total assets, the 5000 CR is Indian assets. 5000 CR are Indian assets. Can I say greater than 50%? Greater than 50% are Indian assets. That means this CGP Mauritius derives its value from asset located in India. This CGP Mauritius derives its value from asset located in India. So for that matter, any capital gain that HTIL has will be taxable in India. Sir, how capital gain will be calculated? Just see. Sir, capital gain in the hands of HTIL. Sir, for example, sales consideration is 12,000 CR and cost of acquisition, we have assumed that it is 5,000 CR. Sales consideration is 12,000 CR and cost of acquisition is 1,000 CR. So capital gain in the hands of HTIL is 11,000 CR. Capital gain in the hands of HTIL is 11,000 CR. But since CGP Mauritius had other assets also now. CGP Mauritius has other assets also now. For that matter, not this complete capital gain will be taxable in India. Only with respect to proportion that CGP had with respect to Indian assets will be taxable in India. Will be taxable in India. What I am saying is the CGP Mauritius had only 52% of its share cash, 52% of the assets located in India. So can I say that complete capital gain will be taxable? No, only 52% will be taxable. For that matter, sir, this 11,000 capital gain will be taxable in the ratio of 5,000 divided by 9,500 in the ratio of FMV of Indian assets with respect to total assets. FMV of the Indian asset with respect to total asset, that much capital gain will be taxable in India. I hope I hope you are very much clear with what I am saying, because we are revising things. We are bound to be a bit faster. So for that matter, if you find me a bit faster, you are bound to find it faster, because we are revising it a day before exam. Got you? Yes, sir. We did get this point, sir. What if this Indian company, say Hutchison SR, parent company CGP Mauritius. Sir, ultimate parent company STIL, transfer made to Vodafone PLC. Sir, who is required to report to income tax department? How will Indian government know that this company is being sold ultimately? How will government know that this company is being sold? So the responsibility for intimating to department, income tax department, lies upon Indian entity. And this Indian entity is required to report to income tax department. Sir, in case, sir, till when it is required to report? It is required to report within 90 days from the end of the financial year in which transfer took place. Sir, the year in which transfer is took place, from end of that financial year, in 90 days you have to report. Got this point? If you did not report, what will be the penalty? You have to check whether your ultimate parent holding is changed or not, whether your ultimate ownership is being changed or not. In this case, since ultimate ownership is being changed, then penalty will be 2% of the transaction amount. Sir, but if ultimate parent is changed, then in that case in that case 5 lakh will be the penalty amount. Got this point or not? Yes, sir, we did get this point. So what I am saying, the responsibility to tell to income tax department lies upon the Indian entity, and it has to be told to income tax department within 90 days from the end of the financial year. And if it fails to do so, it will be liable for penalty. What will be the penalty? So 2% of the transaction value in case of change of ultimate ownership, but in case of not in other cases, penalty will be 5 lakh rupees only. With that, I can say we are done with clause 1 of section 9.1. Of section 9, subsection 1, clause 1. What clause 1 we have studied? First of all, business connection via agent. Then we have studied business connection via significant economic presence. Then we had studied any kind of income from asset located in India. Then we studied any kind of capital gain from asset located in India, or asset located outside India which derives substantial value from asset located in India. Or we have studied all these things. These incomes constitute transfer. These incomes will be deemed to accrue arise in India. Now we are switching on to clause number 2. Clause number 2 says any kind of salary income from services rendered in India shall be deemed to be earned in India. Any kind of salary that is being earned from servicing rendered in India. If a foreign person comes to India, renders services to any entity, sir, whether such foreign entity or whether such Indian entity, it is not relevant. It will be deemed to accrue arise in India. At this point or not, salary income is deemed to accrue arise in India if it is rendered in India. Third point, so clause number 3, what it says, any salary received by Indian citizen from government outside India will be taxable in India. Sir, what I'm saying is, if we have any embassy consulates, if we have any foreign consulates, like for example in USA, we have Indian embassy, and in Indian embassy, people who are staying are Indian only, are Indian diplomats only. So their salary is being paid by the Indian government only. For that matter, those consulates, those embassies, those foreign diplomats are non-resident, because they are not staying in India. They are staying in embassy, so they are non-resident of India. For that matter, any salary paid by government to such foreign consulates will be taxable in India. Got this point or not? Sir, but any kind of perquisites or any allowances that they are receiving is exempt. Any kind of perquisites or any kind of allowances that they are receiving is completely exempt. You have to remember this point, because this point has been asked many times in question exam. Clause number 4, what it says, any dividend paid by the Indian company outside India will be taxable. Any dividend paid by the Indian company outside India will be taxable. Sir, what it implies, just focus here, just focus here. What it says, sir, for example, if you have Reliance pays dividend to Mr. Ross. Sir, will that be taxable in India? Right answer is it will be taxable. Sir, but what happens, sir? There is company called Hutchison SR. Hutchison SR has Hutchison SR has parent named CGP Mauritius. Sir, Hutchison SR paid dividend to CGP Mauritius of rupees 100 crore, and CGP again remitted such remitted to HTIL. Can I say that this dividend paid by entity which derives its substantial value from asset located in India will also be taxable in India? Did you understand my question? Sir, my question is, can I say any foreign company which derives its value from asset located in India and distributes dividend, can I say this dividend will also be taxable in India? Right answer is no. Transfer of such company will be taxable in India, but dividend from such entity will not be taxable in India. That is the bottom line. Only dividend from entity located in India will be taxable in India. Any dividend outside will not be taxable in India. Got this point or not? Yes, sir, we did get this point. So now interest. How interest income is taxable? For example, somebody lent to India. Somebody gave money to India as loan. Sir, if it is being given to government, sir, any kind of loan that is being taken by the government, any interest paid by the government will be taxable in India. क्लोज योर आइज, आंख बंद करके जो इंटरेस्ट इनकम होगी गवर्नमेंट पे करेगी वो टैक्सेबल होगी इंडिया. Any kind of interest paid by government will be taxable in India. Sorry for India. Okay. Any kind of interest that government pays will be taxable in India. Sir, any kind of resident person who pays interest will be taxable in India. Sir, for example, listen. We have Mr. Rahul. Mr. Rahul pays interest to Miss Rachel. Miss Rachel. Sir, any kind of interest paid by Mr. Rahul will be taxable in the hands of Rachel, taxable in Rachel in India. It is bound to be taxable. But sir, in two cases, such interest will not be taxable in India. In two cases, it will not be taxable. What it says, sir, if Rahul uses such money to conduct business outside India, to conduct business outside India, or Rahul uses such money to invest and earn interest, dividend income outside India. Sir, for example, any resident person who uses such borrowed sum to carry out any business outside India or invest such income outside India and earns any investment income, in that case, income arising in the hands of non-resident will not be taxable in India. This is the case of when interest is being paid by the resident person. Got this point or not? Yes, sir, we did get this point. Sir, what is the last case? The last case, just listen. So, for example, this is Miss Rachel. This is Mr. Ross. Mr. Ross. Sir, Mr. Ross pays any kind of interest to Miss Rachel. Can I say this interest will be taxable? Right answer is this is never taxable. This is never taxable. But in one case, it will be taxable. Sir, if Mr. Ross uses such money to do any kind of business in India, then in that case, such interest will be taxable in India. If such money is being used to carry out any business in India, then any such interest will be taxable in India. Got this point or not? Yes, sir, we did get this point. So now we have royalty and FTS. So royalty and FTS go side by side. So royalty and FTS go side by side. Sir, for example, government pays any kind of royalty or FTS to any non-resident. Royalty or FTS to non-resident. In that case, can I say this royalty FTS will be taxable? It will always be taxable. It will always be taxable. There is no doubt. There is no second thought about this point. Next, we have if any resident person pays any royalty or FTS, sir, it will always be taxable, but in two cases, it will not be taxable. It will always be taxable ordinarily, but in two cases, it will not be taxable in India. Sir, when they'll be not when they'll not be taxable? Sir, when this resident person uses when this person uses when the resident person has paid royalty to carry out any business outside India, carry business outside India, when payment is being made for the technical services to carry business outside India, or when FTS is being paid to earn any investment income outside India. So what I said, any kind of if any resident person pays any royalty FTS to any non-resident, it will be taxable in India. But if royalty is being paid to carry business outside India or to earn any investment income in India, to carry business outside India or to earn any investment income in India, in that case, such royalty will not be taxable in such non-resident's hand. Got this point or not? Yes, sir, we did get this point. Sir, what if, sir, this is Miss Rachel and this is Mr. Ross. Mr. Ross. Sir, Mr. Ross pays royalty or FTS to Miss Rachel. Sir, will that be taxable in India? Sir, if non-resident pays any kind of royalty to any other non-resident, how will that be taxable? Sir, but in two cases, it will be taxable. Sir, what are those two cases? Sir, if Mr. Ross If Mr. Ross uses such FTS, uses such technical services, or uses such royalty to carry out business in India, carry business in India, or sir does any investment in India and earns investment income, in that case, such royalty and FTS will be taxable in India. Got this point or not? Sir, now I have a one question for you. Sir, this one question can be asked in exam, so you must be very much aware of this. Yes. Sir, we have Mr. Ross, we have Miss Rachel. Mr. Ross paid interest to Miss Rachel. Interest. Of course, Mr. Ross must have borrowed money. Mr. Ross used this borrowed money to invest in India, invest in Indian markets. Sir, if this money if this money paid by Mr. Ross were royalty or FTS, then this were definitely taxable in India. But since Mr. Ross is paying interest to Miss Rachel and he uses such money to invest in India and earn any such income from India, then in that case, income when sorry, if any interest is being paid and interest when money borrowed for earning income outside income from any source in India, then in that case, such interest will not be taxable in the hands of such non-resident. What I'm saying, sir, if non-resident pays any sum to non-resident, it will not be taxable. But in two cases, in case of royalty and FTS, it will be taxable. Sir, if royalty is being paid to carry business in India or to earn any investment income in India, then such a royalty FTS will be taxable. But in case of interest, only if he does business in India, then only it will be taxable. Sir, for investment income, such interest is not taxable in the hands of non-resident. I hope you are very much clear with what I am saying. So this was all about clause number 5. This was all about your clause number 6. This was all about your clause number 7. We are very much clear with clause number 7 also. We need to know the definition of royalty and FTS. We need to know the definition of royalty and FTS. So royalty does not imply first of all any kind of capital gain consideration. No kind of capital gain consideration can constitute royalty. So any kind of transfer of rights for patents, prevention, secret design, or any kind of import of concerning use of formula or similar, any kind of patent, invention, secret design, imparting information concerning technical, industrial, commercial skills, or any kind of right to use any commercial equipment excluding 44 bb, or any kind of rendering services in connection to above 5 shall constitute royalty. Got this point? Yes, sir. So lump sum consideration for use of software embedded in computer hardware does not constitute royalty. For example, sir, what does this implies? Sir, what it says, for example, I bought a laptop. I bought a laptop. Bought laptop of HP, paid 60,000 rupees. Out of the 60,000 rupees, sir, 30,000 is being paid to hardware company. I am not paying this. This company is paying. I am not paying this 30,000 to hardware company, but this HP is paying hardware. The HP is taking 30,000 and it is remitting 30,000, balance 30,000 to Microsoft because Microsoft takes royalty from HP. Can I say when I am paying this money to HP of rupees 60,000 rupees, I am also paying royalty. So for that matter, sir, this will be taxable in the hands of HP. Right answer is it will not be taxable. If you are paying lump sum consideration for hardware and for software, it will not constitute royalty. Got this point? Yes, sir, we got this point. One point that I want you to rectify is, sir, any kind of payment for downlinking channels constitute royalty. This has been asked. This has been asked. It is irrelevant to know what it is, but sir, any kind of payment for downlinking for channels constitute royalty. Last point, consideration for sale, distribution, and exhibition of films is royalty. Any kind of consideration paid for distribution, exhibition of films is royalty. I hope you are very much clear with this point. So clause 9(8). So FTS we understood, paid by government always taxable, paid by resident person always taxable, but in two cases it will not be taxable. But paid by non-resident always non-taxable, but in two cases it will be taxable. What does FTS means? What does fees for technical services imply? Sir, any kind of managerial, technical, and consultancy services. Any kind of managerial, technical, and consultancy services will imply FTS. Sir, also, but it excludes. Any kind of FTS excludes. Sir, any kind of construction services, assembly services, mining services, or income that is chargeable under salary will not be taxable under FTS. Got this point or not? Yes, sir, we are understanding what you are saying. We are understanding through core of our heart. So sweet of you. Section 9(1), what it implies. 9(1), clause 8. Till now, what we have studied, just we have studied the 7 clauses. 7 clauses. What were those 7 clauses? First one was business connection. Sir, business connection via agent. business connection via significant economic presence. First point also included any kind of income from the property located in India. First point also included capital gain, direct transfer, indirect transfer. Second point was any kind of salary income. Second clause was salary income will be taxable in India. Third point was any income by the foreign diplomats. Fourth point was any kind of dividend income. Fifth was any kind of interest income. Sixth was any kind of royalty income. Seventh was any kind of FTS income. And now we have eighth one. What this eighth point says, any kind of gift of any money paid by resident to non-resident foreign company or resident not or resident shall be deemed to be earned in India if aggregate amounts exceeds 50,000 rupees. Sir, for example, Rahul gives any kind of money, only money. You have to remember money. We are not talking about any kind of movable or immovable assets. Only money to any kind of NOR or any kind of sir non-resident or any kind of sir foreign company. In that case, such money will be taxable in such non-residents' hand. You have to remember this point. Sir, no kind of movable property or immovable property is covered here. Sir, why not? Because it will be covered in IFRS. Na? It will be covered in IFRS. Na? So for that matter, it will be taxable there under section 56 to got this point? Yes, sir, we did get your point. So this is least important. You can leave this topic. You can leave this topic. This has never been asked. This is least likely to be asked. Now we have some exempt income. So these incomes might be looking at first instance, you might think that these incomes should be taxable in India, but these are specifically made exempt. These are specifically made exempt. So what are those income? First of all is any kind of interest from non-resident external accounts. Sir, we politely call it NRE account. Any kind of interest received or earned by any non-resident from NRE account will be always exempt. Sir, even though interest is being paid by Indian entity, it will always be exempt. But sir, conditions are to be fulfilled. Person shall be resident outside India. Person shall be resident outside India as per FEMA and not as per Income Tax Act. And such account is being opened by permission with RBI. Okay, got this point. Second thing, any interest income earned, any interest income by Indian company on money borrowed via RDB. Sir, for example, if any interest is being paid by Indian company via RDB, via issuing RDB. What RDB implies, sir? RDB is rupee denominated bond. RDB. Bond that are denominated in rupee. If they are being issued from, sir, for 17th October 2018 till 31st March 2019, if such money is being raised by Indian company via RDB from non-resident to foreign company, then any interest paid on such RDBs will be exempt in the hands of non-resident and foreign company. Got this point? Sir, we have 4 exemptions for IFSCs. Sir, you can ignore these 3. You just need to remember this 4th point. Sir, what this point implies? Sir, any kind of interest paid by unit located in IFSC. Unit in IFSC. Any kind of interest paid by unit located in IFSC after money is borrowed. After, what is the date? 1/9/2019. If any unit of IFSC borrows any money after 1/9/2019 and pays any kind of interest thereon, then such interest will be exempt. Sir, even if it is non-resident, even if it is foreign company, you can exempt such income. Got this point? Yes, sir, we did get this point. Okay, sir. Now, sir, for example, we have in India, we have embassy of Pakistan, we have embassy of USA, we have embassy of United Kingdom. Every company in which India is a every company which is a part of United Nations has embassy in India. If you want to go anywhere else, you have to go to embassy and take the visa from it. For that matter, any person sitting in that embassy are citizens of those respective countries. For example, we have embassy of France. So any person sitting in the embassy of France will be citizen of France. They are not citizen of India. Got this point? But because since they are living in India, they might become resident of India because they are staying in India for 180 days or more. For that matter, any salary received by such a foreign person, any salary received by such foreign diplomats in India must be taxable in India. It shall deemed to be taxable in India because it is received in India also and they are resident also. For that matter, it will be taxable. For that matter, some exemption is being given. It says that if our diplomats receive any salary in their country and that salary is exempt in your country, then any salary received by your diplomats in our country will be exempt. Sir, got this point or not? Sir, remuneration received by foreign diplomats in India. If salary of our diplomats in their country is exempt, plus such diplomat do not constitute any business employment in India. You have to remember that such diplomats may not constitute or may not do any kind of business in India, nor any business, nor any other employment. They are just here to sit as foreign diplomats, nothing else. Next point, salary of any foreign enterprise while they stay in India. For example, there is a foreign company which sends their employees to India just to understand the Indian market. For that matter, they stay in India for less than 90 days. They do not do any business and profession. They are given certain salary to stay in India for 90 days for meeting out their hotel expenses, traveling expenses. They are being given some salary. For that matter, any salary received in India must be taxable in India. They are receiving that salary in India now. So for that matter, it should be taxable, but it is being given exempt to them. Sir, but you have to consider these two things, that their stay should not be 90 days or more. And second thing, they should not do any kind of business or profession. Then we have says any kind of salary received in connection with employment in a foreign ship is in lesser than 90 days is exempt. You can read this. Any kind of royalty FTS project with connection to security services in India. Any kind of, if in India, from India, we pay any kind of royalty or FTS to any person in the world with respect to security services related to India, then such income to the foreign company will be exempt. Any royalty paid FTS from National Technical Research Organization will be exempt. So, for example, if NTRO, National Technical Research Organization, pays any kind of royalty or FTS, then it will be exempt. It will be completely exempt. Got this point or not? Sir, we have specified fund. You can ignore this point, completely ignore this point. Now we have tax rates. We have tax rates. So before understanding tax rates, I want you all to refer to this screen. Refer to this screen. So first of all, what I want is you to remember the tax rates that I am writing here, or that I have written here. Just give me a second. You just remember this tax rates, and after remembering these tax rates, I will get back. So these are the tax rates. This is the gist of tax rates. I want you to remember firstly these tax rates. Then only we can switch to that topic. So first of all, capital gain for any kind tax rates for non-resident we are studying. Sir, any kind of income arising from the capital gain in the hands of non-residents. Sir, if they are selling any kind of listed shares, if they are selling any kind of listed shares listed on recognized stock exchange, that too they are having long-term capital gain, what will be tax rate? So section 112A simply prescribes that in excess of 1 lakh, it will be taxable at the rate 10%. Simply we all know. Section 112A does not create any difference between non-resident and resident. It does not create any difference. It is applicable as good as for resident and for non-resident also. For 111A, sir, if any non-resident incurs any short-term capital gain on any shares listed on recognized stock exchange, then tax rate is 15%. We all know very much. We all know very well. Sir, if they sell any kind of property or sir real estate or any kind of gold, then what will be tax rate? Tax rate will be 20%. With indexation, they are being given such tax rate benefit. Perfect. In capital gain chapter only, we have studied if any non-resident or foreign company, if any non-resident or foreign company invest in unlisted shares of India, unlisted shares of any company in India, then any kind of long-term capital gain is taxable either at 10% without indexation or 20% with indexation, whichever is lower will be the tax rate. This is very much we know. Section 180, 115D prescribes, 115AD prescribes any kind of capital gain arising from bond and GDR, any kind of long-term capital gain will be taxable at 10%. Any kind of long-term capital gain will be taxable at 10%. Sir, it is simple. It cannot be any simpler. Sir, we are very much aware. Sir, if any NRI invest in any forex asset, then capital gain is 10%. If any NRI invests in any foreign forex assets, then that capital gain is 10%. What without indexation? What is forex asset? We will study later on. Sir, if any FIIs invest in India and incurs any STCG other than 111A, then it will be taxable at 30%. We are very much aware. So any offshore banking units incurs any LTCG, then it will be taxable at the 10%. You can ignore this point. But these were the only tax rates available for capital gain for any non-resident. Now we have royalty and FTS. If any foreign company has permanent establishment in India, then 44 DA will apply and royalty will be taxable at 40%. Along with that, any kind of expenditure that they are incurring to earn such royalty will be allowed. But if such foreign company does not have any permanent establishment in India, and such royalty and FTS is being paid by government approved, if such royalty is being paid after the approval of the government, in that case, Section 115 applies and you are being taxed at 20%. I'm assuming that you remember these tax rates. You remember at least a bit of those. You are just being confused in those points. For that matter, I'm making you revise this thing. Again, I'll be switching to that that book for complete comprehensive coverage. This is the gist of the topic. Sir, any kind of interest, any kind of bond interest or dividend or GDR is taxable at the rate 10% under Section 115 AD. You have to remember this thing. You have to remember this thing, that interest on bond is taxable at 10% and dividend on GDR is taxable at the rate 10%. This is the thing that you must be aware of. You must remember. Okay, sir, we remember. Sir, dividend flat 20% is the tax rate. But sir, if dividend is being received by non-resident from business trust, then it is taxable at the rate 10%. If any dividend is received by non-resident from unit located in IFSC, then tax rate is 10%. Or if any dividend is received from GDR, then it is taxable at 10%. So in these three cases, it is taxable at 10%, and rest in all cases, it is taxable at 20%. Got this point? Yes, sir. Now the thing that you fear the most is interest. You are bound to make mistakes in these topics, but remember what I am saying is the bottom line. So interest on loan, if nothing is given, it is taxable at the rate 20%. Interest on loan is taxable at the rate 20%. So other kind of interest. So if interest is received by non-resident from infrastructure debt fund, infra debt fund, or any kind of interest is received from business trust. Any kind of interest received by non-resident from business trust or infra debt fund, in that case, it will be taxable at the rate 5%. Sir, if any FII is received any interest from RDBs on municipal securities, sir, before investment is being made before 30th June 2023, then the tax rate is 5%. And after that, for RDB and municipal securities, tax rate is 10%. Sir, I beg you to remember these words. I beg you to remember these words. Sir, if interest is being paid on long-term loan, long-term bond, or RDB, and agreement for the loan bond RDB is being made before 30th June 2023, then tax rate is 5% for loan, 5% in RDB, 5% for bond. But after 30th June 2023, for loan, this interest rate is being changed to 20%, and for RDB and for bonds, it has been changed to 10%. At this point, also remember that if we have any bond, long-term bond, or any kind of RDB that is listed on recognized stock exchange of IFSC, listed on RSC in IFSC, if they are listed in recognized stock exchange of IFSC, in that case, sir, before 30th June 2023, tax rate is 4%, and after that, it is 9%. Did you get this point? This is the bottom line of all the points. Sir, you have to remember that this is only possible, sir. This is only possible when such loan, such bond, such RDB, such any kind of loan is being taken in foreign currency. Sir, foreign currency inflow has to be there in India. If there is no foreign currency inflow, in that case, interest will be taxable at flat 40% in the hands of non-resident. Or if such non-resident is individual, then it will be taxable at slab rate. Got this point or not? So any kind of non-resident, non-citizen sports person comes to India, earns any sports income, in that case 20% will be taxable plus education cess. Any kind of NRI earns any kind of forex income, then 20% will be taxable, and we have presumptive taxation we will study later on. This is the bottom line. If you are even aware about these a few points, then it is more than enough for me. It is more than enough for me. Now I can simply start off with tax rates. I can simply start off with tax rates. So how tax rates are being defined under this chapter? First of all, sir, presumptive taxation. So if any entity is involved in shipping business, and such person is non-resident, it can be either non-resident individual or it can be foreign company, then he has to pay 7.5% of the specified sum. Sir, what is a specified sum? Sir, any kind. If it is involved in shipping business, that means it has come to India and it has left India. It has come to India and it has left India. Sir, any kind of freight that is collected in India will be included in the specified sum, or any kind of goods that are taken off from India and freight collected anywhere will be considered in this specified sum. So two things are to be considered in this specified sum. First of all, any income that is received in India, any freight that is received in India. And second thing, any freight received for goods left outside India, received anywhere in the world, will be considered in this 7.5% limit. Similar for operating aircraft. So any non-resident, sir, if any non-resident operates any aircrafts in India, he is required to pay 5% of the specified sum. Sir, what is the specified sum? Any kind of flight whose freight has been received in India, whose money is being received in India, will be considered in the specified sum. And any person who left India and his respective freight is collected from his respective freight is collected anywhere in the world, in that case, it will be considered in the specified sum. And 5% of that specified sum will be considered. So these two are 44B and 44B. Sir, are these provisions mandatory or optional? Sir, these are mandatory provisions. Sir, they do not have any other option of opting to pay tax in any other form. Sir, since these are mandatory, is it possible them to have any losses? Right answer is they do not have any losses. They cannot have any losses. If they don't have any income, losses will be zero, profits will be zero. But if they have any income, they have to pay taxes for that matter. So they cannot have any losses. 44BB and 44BBB, what it says. If any foreign company or any non-resident does business of providing services or facilitate in connection with supplying plant and machinery to hire to be used for extraction and production of mineral oil. Sir, for extraction and production of mineral oil, if you are asking any plant and machinery, so the person supplying plant and machinery will be having rental income. Such non-residents' income will be taxable in India at the rate 10% of specified sum. At the rate 10% of specified sum. Sir, what will be the 10%? Sir, any kind of machinery used in India, any rent paid by the Indian entity for machinery used in India, or sir, if machinery used outside India, any rent paid by such Indian entity for such machinery used outside India, total rent paid by such entity to such non-resident person, out of that 10% will be total income. Got it? Sir, 44 triple B, what it says, sir, any kind of foreign company that is involved in turnkey project. For example, sir, if a foreign company is being delegated a work to construct a flyover in India, for example, it is being delegated such work. So turnkey project implies, sir, till the date finance minister or any kind of road minister comes there to cut the ribbon, sir, it will not be considered as operational. That means from the date of starting till the date of cutting that ribbon, sir, all work has to be conducted by such foreign company. That is the turnkey project. That means they are giving project from start to end. That project is considered as turnkey project. So if any foreign company is engaged in doing any turnkey project in India, is liable to pay tax at the rate 10% of the specified sum. So what is specified sum? Any kind of sum paid by the Indian government or Indian person for to such foreign company for such turnkey project. Got this point? In 44BB and 44BBB. So what 44BB was? Sir, 44BB was rental for hiring of machinery for extraction of mineral oil, and 44BBB was turnkey project. Sir, we do if any entity is involved in 44BB or triple B wants to declare lower profit than these sections, they might have lesser profit now. So they can declare lower profit than this. For that matter, what they have to do, they have to maintain books of accounts as per section 44AA. They have to get their books of accounts audited. And in case where they maintain books of accounts and do audit, they might incur losses. They can have losses. But these losses cannot be set off when they are opting for presumptive taxation. That means whenever they are offering presumptive taxation, their incomes cannot be set off against any prior losses. At this point, their incomes under presumptive taxation cannot be set off against any prior losses. This was all about the presumptive taxation. We have another presumptive taxation named section 172. Shipping business, any company which comes to India occasionally, once in a year, twice in a year, once in 2 years. For that matter, they are required to pay tax at the rate 7.5% of the amount, 7.5% of the specified sum. What is the specified sum? That same specified sum. Any kind of money received in India, or any kind of money received for goods that left India. For that matter, 7.5% is the specified sum. That is the income that they have to declare. So no deduction of any expenditure is allowed. Sir, but in this case, the master of ship is required to furnish the ROI along with tax before the departure of the ship, because this ship is occasional business. This ship is occasional comes to India. Occasionally, this ship comes to India. For that matter, master of this ship is required to file ROI and pay taxes in India. But in case ROI may be filed after 30 days, within 30 days from the departure of the ship. Normally, ROI is required to be filled before ship leaves India. But in certain cases, ROI may be filed within 30 days from the departure. What are those two cases? Sir, if AO is satisfied that ROI cannot be filed before departure, sir, ROI cannot be filed, then it can allow that ship to leave India and can file ROI within 30 days. Second thing, sir, master of ship has made satisfactory arrangements for the payments of taxes and filing ROI. Sir, for example, master of ship has already paid taxes, but it has not filed ROI because of certain compliance issues. For that matter, AO can ask ship to leave India and ask such master to file ROI within 30 days. Did you get this point or not? Yes, sir, we did get this point. So in this case, assessment order is to be passed within 9 months from the end of the financial year in which ROI was filed. Okay, we got this point. We don't have to remember anything because this has not been asked. Anything that has been asked is section number 44B or 44 triple BBA. Got this? The taxation of capital gains in the hands of non-resident. Sir, capital gain will be taxed in the hands of non-resident only if capital asset is situated in India or sir, such capital asset derives such value substantial value from asset located in India and transfer of such asset took place in previous year. Transfer has to take place in previous year. Sir, following transfers are not regarded as transfer. You need to remember this. For example, what it says, just remember. For example, we have Rahul Private Limited. Rahul Private Limited is an Indian company. The shares are being held by Facebook. Now, Facebook got merged with Meta. In that case, sir, whatever the shares that were held by Facebook are being now transferred to Meta. In this case, transfer of any shares by amalgamating foreign company to amalgamated foreign company will be exempt transfer. Sir, what if the case is different? What if the case is different? Sir, Meta Limited is the Meta Inc. is the shareholder of Rahul Private Limited. Meta Inc. is the shareholder of Rahul Private Limited. What if, sir, Meta demerges and one of its subsidiary becomes Facebook? Now shares of Rahul are being transferred to Facebook. Now in that case, can I say demerging foreign company and resulting foreign company? Demerging foreign company transfers shares to resulting foreign company. In this case, can I say the shares of Rahul Private Limited are being transferred? In that case, such transfer will be exempt transfer. Transfer of shares held by Indian company in transfer of shares held in Indian company by demerged foreign company to resulting foreign company will be an exempt transfer. Got this point or not? Yes, sir, we did get this point. Sir, also listen, sir, any kind of bond, any kind of GDR, any kind of RDB, rupee denominated bond, if it is being transferred by non-resident to any kind of non-resident, then it will be exempt transfer. This is the exemption given under section 47. Okay, sir, we did get this. Also, if any non-resident invests any kind of shares, invest in any kind of shares in India, then first proviso to section 48 is also given. We have already studied this provision in capital gain. The special provisions for NRI. What is the special provision? So first of all, you need to remember this is optional provision. And if NRI aims to pay tax under normal tax regime, they can pay tax, but this is optional provision. Sir, any kind of NRI who have income, investment income or LTCG income from forex asset. If any NRI has any forex asset and they have income from LTCG from such forex asset or any investment income on such forex asset, then such income and LTCG will be taxable. So that investment income will be taxable at the rate 20% or LTCG will be taxable at the rate 10%. That is the bottom line. Sir, what is the forex asset and what does the forex asset imply? So forex asset implies shares of Indian company. It can be public limited company or it can be private limited company. It is irrelevant. Sir, debentures of public company, sir, no private company. Remember, no private company for debentures. Debentures of deposits of public limited company, again, no private company. Sir, securities of central government, sir, no state government. Remember, and other assets as will be notified. So, what I have said, forex asset imply any shares of Indian company, any shares. It can be public, it can be private. Second thing, sir, any kind of debentures in public company, deposits in public company, and securities of central government, no state government. Got this point? Yes, sir. So investment income, any kind of interest or dividend derived from such forex asset, any income from such forex asset, for example, it can be dividend, it can be interest, any kind of income from such forex asset will be considered as investment income. So capital gain is long-term capital gain from such forex asset. For example, you are selling shares, you are selling debentures, you are selling deposits. So any kind of such gain will be considered as LTCG. Sir, how you will compute the capital gain, sir? Just remember, sir, sales minus cost is capital gain, sir. What I'm telling you, sir. Method of computation. Remember, whenever you are having any interest income, sir, no expenditure is allowed against such investment income. No expenditure is allowed. If you are earning any interest, it'll it'll pass from no deduction. You will not be allowed any deduction against such investment income. And for capital gain income, sir, no chapter 6 deduction is allowed, but cost of acquisition is allowed. Any kind of transfer expenses paid is allowed, but no other expenditure is allowed. Okay, sir. Sir, no Chapter 6A deduction is allowed for investment income. No Chapter 6A deduction is allowed for LTCC income. Sir, first proviso to Section 48 is available. That is for forex fluctuations. Yes, sir. Fluctuations is available. Second proviso is not available, sir. Indexation is not available, sir. Already you are paying taxes at the 10%. You want indexation on that also? You want indexation? Right answer is indexation is not allowed. Sir, what about other incomes? Sir, other incomes are taxable as normal. Sir, if they have any other income, will be taxable as per their slab rate. The tax rate LTCG will be taxable at 10%, investment income will be taxable at 20%, other income as normal tax rates. We have already studied in capital gain. I told you in capital gain topic, I told you that LTCG or on forex asset will be taxable at 10%, and investment income like interest dividend will be taxable at 20%. I have already told you in this point. See, NRI forex asset 10% taxation, NRI forex income 20%. Sir, if any NRI transfers any capital asset or any forex asset and he incurs long-term capital gain, he can take the exemption under Section 115F. The same exemption that we have studied in capital gain under Section 54F. Sir, what the exemption amount is? Sir, any kind of long-term capital gain he incurs, sir, he has to utilize the net consideration. Sir, the amount that he utilizes to buy new forex asset will be considered as exempt. Sir, for example, if he sold asset for 10 lakh rupees and out of 10 lakh he bought 9 lakh, so he will be allowed exemption in 9:10 ratio. That is the bottom line. But for that matter, whenever he buys any kind of forex asset to claim the exemption under Section 115, he must not sell such asset or convert such asset into money for 3 years. Otherwise, it will be taxable. Sir, if we have any NRI, if we have NRI and he has only forex income, he has forex income or LTCG income, and his TDS is already deducted, then in that case he is not required to file ROI. Sir, if he is not required to file ROI, in case NRI wants to pay taxes under normal provisions of income tax, he can still opt to do so. Even if such NRI becomes resident, sir, if he continues to have such forex asset, he can still claim to opt for provisional claim to opt for such exemption under Section 115E. Did you get this point or not? Yes, sir, we did get this point. Now we have special rates for non-resident. So you can simply ignore this point because I have already told you just this will only confuse you. The interest from infra debt fund 5%. Dividend, so interest distributed by business as to non-resident unit holder, it will be taxable at 5%. Sir, any kind of interest from government or Indian concern on money borrowed by them in foreign currency will be taxable at 20%. Any kind of interest received by FII, QFI on RDB or municipal securities before 30th June 2023, 5%, after that 10%. Sir, any kind of interest from Indian company or business trust on money borrowed in foreign currency under loan agreement between this or long-term bond, this will be 5%. After that, sir, loan will be 20% and RDB and bond will be 10%. Also, if it is listed on IFSC, then this 5% will be 4% before, and after that it will be 9%. Got this point? Yes, sir, we did get this point. Sir, any kind of income from bond, interest income from bond will be taxable at the rate 10%, and dividend income from GDR will be taxable at 10%. Sir, other dividend will be taxable at 20%. Dividend from UTI mutual fund will be taxable at 20%. But sir, these two dividend will be taxable at 10%. Sir, any kind of dividend from unit located in IFSC 10%. Any kind of dividend received from the business trust, any kind of dividend received by the business trust to non-resident unit holder will be taxable at 10%. Sir, what I have said you is the bottom line. You can again refer this dividend portion. So dividend flat 20%. But if non-resident receives such dividend from businesses, will be taxable at 10%. If any non-resident receives such dividend from unit located in IFSC, it will be taxable at 10%. If any non-resident receives such dividend from GDR, it will be taxable at the rate 10%. This is the bottom line for the dividend. You don't have to remember anything else apart from this. But for interest, you need to remember, sir, interest on loan 20%, sir, infra debt fund and business trust is 5%, sir, FIIs, RDBs, municipal securities before 30 June 2023 is 5%, after that it is 10%. Sir, if we have any term related to long-term loan, long-term bond and RDB, it is 5% before 30th June 2023, and after that it is 20% for loan and 10% for long-term bond and RDB. For any bond located on recognized stock exchange on IFSC, it is 4% before 30th June 2023, and after that it is 9%. It is only applicable if such loan is being taken in foreign currency. Otherwise, flat slab rate will apply or 40% tax rate will apply. So royalty in FTS. So if it is made as per contract with the government and such company does not has any permanent establishment in India, then it will be taxable at the rate 20% under section 115A. But if DTAA says any kind of lower tax rate, then it will be taxable at a lesser rate. Otherwise, 44DA will apply. 44DA says it will be taxable at 40%, and in that case, sir, expenditure, any kind of expenditure incurred will be allowed. Any kind of expenditure will be allowed on such for earning such royalty. So remember, under section 115, if a person only has only interest income, or sir dividend income, or sir royalty income, or sir any FTS income, or in all of these four income, sir, in this case, if he incurs only such four incomes and TDS is already deducted on such income, then in that case he is not required to file ROI. Got this point? Yes, sir, we did get this point. Sir, income of FIIs or specified fund, you can ignore specified fund, but remember for FII. Sir, any kind of income earned by FII, remember. So LTCG 112, 10% in excess of 1 lakh, 10% in excess of 1 lakh, and other LTCG is taxable at the rate 10%. So other LTCG is taxable at the rate 10%, that is clear. Any kind of STCG. Sir, STCG 111A, flat 15%, we already know. But other kind of STCG is taxable at 30%. If any FII invests STCG that is other than 111A, for example, any unlisted shares for short term, then in that case it will be taxable at 30%. Interest income, dividend income, it is flat taxable at 20%. Interest on RDP, sir, it is taxable at 5% before 30th June, and after that it is 10%. So remember, sir, who are FII? FIIs are foreign companies. FIIs are foreign companies. So for that matter, sir, maximum surcharge applicable is 15%. If it is individual, maximum surcharge is 15%. But if it is company, by default, you have to assume that it is company. FIIs are by default companies. And for any income exceeding 1 CR, sir, surcharge will apply at the rate 2%. And any income exceeding 10 CR, sir, surcharge will apply maximum 5%. Got this point or not? Yes, sir, we did get this point. So now we have any kind of taxation for non-resident sports person, sports association, or entertainer. What it implies, sir, any kind of sports person excluding umpire, referee, and commentator. Sir, because umpire, referee, and commentator are not sports person. These are not covered under section 115 BBA. These are normal individual. Any kind of will be taxable at their slab rate. But if any kind of non-resident sports person comes to India and participate in any sports scheme other than lottery or horse races, they participate in any sports other than casual winning, or they participate in any advertisement, or they participate in any article or in any newspaper, in that case their income will be taxable at 20% on gross basis without any deduction. Their income will be taxable at the rate 20% without on the gross basis without any deduction. I hope this is very much clear. So remember, whenever you are deducting TDS at the rate 20% or taxing income at the rate 20%, so definitely add education cess to it, because for any non-resident, rate of TDS will be tax rate in force, and tax rate implies 20% plus tax rate at 20% plus education cess. Got this point? Sir, you have to remember, sir, any kind of sports person, sports association, sir, any amount guaranteed to be paid, sir, to such sports association will also be considered under this section. For example, we have India. In India, we have BCCI. Sir, for example, Indian cricket team went to Sri Lanka. And BCCI paid certain sum to Sri Lankan Cricket Board for stay or accommodation of such Indian cricketers. So any kind of income that is being received by Indian Sports Association to other non-resident sports association will be taxable at the rate 20 plus 4%. Okay, sir. Also, sir, any kind of entertainer, for example, we have Rihanna in Mukesh Ambani's son's wedding. Or if Taylor Swift comes to India, so whatever money that she will be taking, for that matter, that money will be taxable at 20% in India. Did you get this point? Sir, for what I said, sir, any kind of sports person comes to India to participate in any game, advertisement, and contribution of any article in newspaper. Second thing, any sports association, any amount guaranteed to be paid to such sports association. And third thing is, sir, any kind of entertainer income from any such performance in India will be taxable at the rate 20% on gross basis without any deduction. Even if they incur any expenditure, you have to ignore such expenditure. Sir, other income will be taxable at the rate. Normal provisions surcharge will always be applicable if their income exceeds the threshold. Sir, if such non-resident sports person or any such non-resident sports organization or any such entertainer comes to India and they only have such income as specified. Sir, what specified? Like sports income, like amount guaranteed or any kind of performance income. If they have only such income and their TDS is already deducted, then they are not required to file ROI. Got this point? Got this point? Yes, sir, we did get this point. Sir, very important points are head office expenses. Sir, for example, if any branch of any foreign company, if any Indian branch of foreign company has received supernatural head office expenses as allocation. For example, branch has profit of 5 CR and head office expenses that are being allocated to such branch are 4 CR. Unnecessarily, head office expenses are being allocated to India and to Indian entity so that profit of Indian entity is least and tax paid in India is least. So for that matter, allocation of head office expenses is being limited to certain extents. Sir, what is the amount that is being limited? Sir, only 5% of GTI, 5% of adjusted total income, or actual head office expenses. Whichever is lower will be allowed. Whichever is lower will be allowed. You will not be allowed actual head office expenses. You will be allowed 5% of adjusted total income or actual, whichever is lower, you will be allowed. Got this point? Yes, sir, we did get this point. So what is adjusted total income? For adjusted total income, now you have to consider total income of the you have to take the total income of the permanent establishment, add what these five expenses you have to add that has been debited after that has been considered to consider such total income. Sir, if any head office expenses that has already been debited to P&L, you have to add back. So any kind of unabsorbed depreciation that has been reduced to arrive at total income, you have to add back. Any kind of capital expenditure on family planning that has been reduced to arrive at total income, you have to add back. Any kind of brought forward losses that has been set off, you have to add back to total income, or any kind of deduction under Chapter 6 that has been reduced to arrive at total income, then you have to add back. Sir, what you don't have to add back is important, sir, because this will be tested in exam. Sir, depreciation, any kind of depreciation that has been debited will not be added back. Second thing, any kind of scientific research expenditure. So section 35. So any kind of expenditure under section 35 that has been debited to P&L, that has been considered in total income, you don't have to add back these expenses because it is not allowed. Sir, if ATI is lost, for example, after adding back all the expenses, you arrive at ATI and ATI turns out to be in -1 or it is in loss, then what will you do? You want to allocate head office expenses. What will you do? Then you have to take average of ATI of last 3 years. For previous year 23-24, which 3 years you have to consider? So previous year 22-23, previous year 21-22, and previous year 20-21. So consider the ATI of these 3 years and take the average of these. This will be allowed. 5% of this will be allowed, or actual expenditure, whichever is lower, will be allowed to you. Sir, income from UTI mutual fund to overseas financial organization, you can ignore this point. So 10% is flat. Income from unit mutual fund, it will be taxable at the rate 10%. I hope this point is very much clear. Sir, taxation of GDR. Sir, what I said, taxation of bond and GDR. LTCG will be taxable at 10%. Interest and dividend will be taxable at 10%. Simple point this says. Sir, for GDR, for bond and GDR, I want you to be clear with a few things. Sir, what if GDR of no, not GDR, sir, bonds. Bond are held by Mr. Ross. If Mr. Ross sells such bonds to Miss Monica, in that case, can I say this transfer is an exempt transfer? Right answer is yes, it is exempt transfer. We have already studied any kind of bond, GDR or RDB that has been transferred by non-resident to non-resident will be exempt. Okay, sir, no issue. We have another provision. Sir, for example, we have a unit in IFSC. We have Mr. Ross. Mr. Ross transfers bonds from himself to unit located in IFSC. Can I say this will be an exempt transfer? Right answer is it will also be exempt transfer. So what will be taxable transfer? Sir, if such bonds are being transferred to person resident of India. Sir, for example, we have Rahul and sir, Mr. Ross transfer such bonds to Mr. Rahul, then it will be taxable in India. Got this point? This is same applicable to GDR also. This is equally valid for GDR. Now, how taxation of GDR is calculated, how GDR is considered, how taxation of GDR is considered, we need to focus on certain points. I want your focus for 2 minutes. The GDR are nothing but envelopes. Indian shares do not have any credibility in France. So, for that matter, whenever we go to France for public issue, we have to intimate their stock exchange that we want public issue. But in France, nobody wants shares of Indian company. They want government backing. So what happens is we give our shares to that stock exchange. That stock exchange envelops such shares and present in the form of GDR. So whenever such French person or any other person in the world want to sell such GDR, they have to get their GDR first converted to shares, and then those shares are being sold in Indian stock exchange. So it is a two-step process. It is two-step process. First of all, the GDR that are being held by such non-resident person are being converted into shares, and then such shares are being sold in Indian market. These are two-step. This is two-step process, and capital gain is calculated twice in this case. For example, Miss Janice is a non-resident person. Miss Janice is non-resident person. Sir, Miss Janice is a non-resident person. Miss Janice on 5 March 2021 bought 6,000 GDR of TCS at the rate 15.8. Sir, what is the total amount that she invested? Sir, she invested 90 lakh rupees she invested. On 21st June 2023, she requested conversion of GDR. Sir, on that day, share of TCS was 2,400 rupees. On that day, share of TCS was 2,400. She bought at 1,500. She asked for conversion on the date on which she asked for conversion was 2,400. The day on which she received the shares, so she received shares after 6 months, and on that day TCS shares were at 2,500. And the day she sold the shares in Indian Stock Exchange, it was 2,700. How capital gain will be calculated? Sir, ultimately capital gain lies is 2,700 she is receiving and 1,500 she paid. Capital gain is 1,200, that 1,200 per share, per GDR. But that is not how capital gain is calculated. You have to calculate capital gain in two steps. First of all, date on which request for conversion is being made, and sir, cost on the date on which GDR is being bought is the first step of calculation. Full value of consideration on the date of conversion will be, so 6,000 GDR into 2,400 will be 1 CR, 1.44 CR will be full value of consideration. Cost of acquisition was 90 lakhs, so 54 lakh will be short term. Sir, how short term? Sir, since it is GDR, and for GDR period of holding is 3 years. So it is held for lesser than 3 years. In that case, it will be short term capital gain. Sir, on the sale of shares, sir, how say shares are being sold? Sir, shares are being sold at rupees 2,700. 2,700 for 6,000 GDR, it will be 1.62 CR. It will be 1.62 CR. And cost of acquisition will be, sir, full value of consideration for such conversion. How cost of acquisition will be determined? So it will be determined the date of conversion. It will be full value of consideration on the date of conversion or on the date of request for conversion is made. This is how you will arrive at actual capital gain in second leg. Sir, what bottom line I want to say is, sir, date of request for conversion is important. Sir, the date on which receipt of such shares is being made is not relevant. So, date on which request for conversion is made will be considered for determining the capital gain in case of GDR. Got this point or not? So, transition mechanism. Sir, for example, what happens is, sir, casual income, if any person earns any kind of income, if any non-resident earns any kind of lottery income, crossword income, horse races income, it will be taxable at flat 30%. It is for both resident non-resident. Remember to add 4% education cess to it. Okay, sir. So transition mechanism for foreign company. Just give me a second. Transition mechanism in foreign currency. What if a company which was a foreign company and earlier it was non-resident company now turns out to be resident company because of poem? It becomes resident company. So what will happen? Earlier, only Indian income was taxable in India, but now Indian income as well as foreign income will also be taxable in India. For that matter, there has to be certain rules that has to be governed that must be governing this section. Also, how they will be getting depreciation of the assets all over the world, how different expenditure that will be allowed in India, how different things will be treated, how losses and depreciation in foreign country that are now being taxed in India are being allowed in this provision. This all need to be understood in this provision. What this says, sir, How WDV is calculated, opening WDV calculated. So what I'm saying is ultimately what happened was earlier only Indian income was taxable. So only Indian assets, only assets that were in India, depreciation was allowed on those assets only. Now, since complete world income is taxable in India, so if any asset that company has all across the globe will be chargeable to depreciation and will be allowed in India for that matter. And all the losses in different entities that it used to had in different countries will also be allowed in India. So how that allowance will be made, it says how opening WDV will be calculated for the purpose of calculating depreciation. You have to see if that country is accessible to tax in any other country. If it is not accessible to tax, then whatever will be the WDV as per books of accounts will be considered. But if yes, it was assessed to tax, then what we have to see whether depreciation is considered in whether depreciation is considered in taxation, whether depreciation was allowed, then WDV as per tax records you have to consider. WDV as on 1/4/2023 will be considered. Second thing, if depreciation is not considered, then WTV as on 1st 4 2024, assuming that depreciation was actually allowed, will be considered for as opening WTV. And on that opening WTV, you will be getting depreciation. Got this point or not? Yes, sir. So what I said, if any of the entity which became a resident in India, which became resident because of poem, so we have to consider depreciation of assets that are located all across the world. For that matter, we need opening WTV of all the assets. How that opening WTV will be arrived, we have to check for every country and assets located therein. If that country is not accessible to tax, which that country does not charge any tax on such entity, then in that case, WTV as per books of accounts you have to consider. But if that country charges taxes, then whatever the WTV after charging as per tax records will be the WTV, opening WTV. And if that country does not even considers depreciation, then in that case consider depreciation and find out the WTV as on 1/4/2023. How brought forward losses and depreciation will be allowed, you have to check whether that company is assessed to tax in that country or not. If that company is assessed to tax in that country, then losses and depreciation as on 1/4/2023 as per tax laws of that country will be considered. If that country is not assessed to tax, then as per books of accounts you have to consider. Sir, whatever losses that company had will be allowed in India only for remaining period. For example, if a company had income from two countries, for example, France and India. Indian entity was profit making and France entity was loss making. Earlier, this company was non-resident of India, so only Indian income was taxable. France income was non-taxable. But now, since this company became resident of India, so France income has to be clubbed in this entity. For that matter, losses will be allowed in India. Sir, how much losses will be allowed? Losses will be allowed for remaining period. For example, this entity of France has already used losses for 4 years, already carried forward losses for 4 years. So only 4 remaining years will be allowed in India. Remember, sir, if different accounting period is followed, then you have to allocate it proportionally. Also, one thing to be taken care of, sir, what happens is earlier when it was non-resident, income was taxable. For example, 4 lakh, 8 lakh, 8 lakh was taxable. Now, because sir, it became resident, sir, income taxable turns out to be sir 12 lakh. But now also additional losses are also allowed. So in that case, the total income turns out to be 7 lakh. Is it justified enough? Is it justified enough? So earlier that company was non-resident and for that matter only 8 lakh rupees Indian income was taxable. But because such company became resident in India and income got increased, along with that losses got also allowed, can I say that now lesser income can be taxable in India? Right answer is no. So this says, sir, only that much of income can be reduced, only that much set off of losses can be claimed so that our previous income is not reduced. Losses set off cannot be to such extent that our income turns out to be lesser than that as if this company were non-resident. If this company were non-resident, whatever income it used to offer, now after becoming resident, it cannot offer income lesser than that. That is the bottom line. Sir, what if foreign company follows different accounting period? That company in other country follows different accounting period, and in India it follows different accounting period. For that matter, you need to have same financial statements to find out the opening WDV, to find out the depreciation, to find out different profit centers. For that matter, you need to have common financial year, common accounting period for that matter. Sir, for example, if a company follows accounting year for year ended 31st October 2022. accounting year of that foreign company ends on 31st December 2022. And in India, financial year starts from 1st April 2023 till 31st March 2024. So there is lag of 3 months. There is lag of 3 months. The day on which financial year ends and the day on which financial year begins in India, there is lag of 3 months. Sir, how will the foreign company deal with such period? How will such foreign company deal with such period? You have to check whether this intervening period is lesser than 6 months. If this intervening period is lesser than 6 months, as in our case, it is of 3 months. In that case, what will company do? Company will present financial statements of 15 months, 12 months of accounting year, and 3 months additional period. It will prepare financial statements of 15 months and consolidate it and present in India, and that will be considered as opening balance sheet for India, and that will be used for consolidation purpose, and that will be used for considering opening WDV, opening depreciation, and opening losses. But what if what if this intervening period was greater than 6 months? For example, company's financial year ends on 30th June 2022 and Indian financial year starts on 31st April 2023. What happens? This intervening period is greater than 6 months, that is equals to 9 months. Then what in that case, what will do? This company will prepare financial statements for this 9 months additionally. Separate financial statement for this 9 months is to be prepared. Got it, sir. Sir, one very important thing, sir. One very important thing. This is being asked many a times. Sir, for example, if a foreign company is there, and there is Indian company, for example, Rahul Private Limited. Rahul Private Limited takes FTS services. FTS services is being taken by Rahul Private Limited and payment is being made, for example, 40 lakh. Sir, what will be the amount of TDS that Rahul Private Limited has to deduct? It has to deduct TDS as per rate and force. For foreign company, rate and force is nothing but 20 plus 4% as per 115A. This is the rate and force. Correct. Sir, what if this foreign company becomes resident of India? This foreign company becomes resident of India. Can I section 194J is also attracted? Section 194J is also attracted because Section 194J specifically says that if you are making payment for technical services to any resident person, foreign company can also be resident. Foreign company can also be resident. In that case, TDS rate or at the rate 10% may apply. So, sir, there is clash between Section 195 and Section 194J. Then in that case, who will prevail? Sir, right answer is provision relating to foreign company will prevail. Foreign company. Provision relating to specifically foreign company will prevail. In that case, Section 195 will override. Got this point or not? Yes, sir, we did get this point. This was all about transition mechanism. Now we have conversion mechanism. Sir, for example, if there was a bank named Citibank, Singapore. It has a branch in Mumbai. It is not subsidiary. It is not subsidiary. It is just a branch. Sir, what if this branch wants to convert itself into a subsidiary? Into company named Citibank Private Limited. So here we are seeing a branch being converted into company. So sir, what will happen? All the assets of the branch will transfer to company. Company will issue shares against it. Sir, all the liabilities of the branch will also transfer to company. Sir, all this transfer will be exempt transfer provided certain conditions are fulfilled. Sir, what are those conditions? Sir, this scheme has to be approved by the foreign company shareholders. This has to be approved by the Indian branch, or it has also to be approved. It has to be sanctioned by RBI. Also, all the assets or the liabilities of the Indian subsidiary are to be transferred to all the assets of the branch are to be transferred to the subsidiary. All the assets of the branch are to be transferred to subsidiary at book value. Remember, my dear friends, sir, all the assets of the branch are to be transferred at book value. That means no revaluation should be there. Sir, foreign bank and nominee should hold at least 100% of the subsidy till the end of the conversion and at least 51% till the end of the next financial year. That means you cannot simply sell off as soon as this branch is converted into subsidiary. You have to hold 100% at least till the end of the year in which conversion takes place. Also, for 51% shareholding, you must hold at least till the end of the 5 years from the end of the year of conversion. That means for the end of the year of conversion, you must hold at least 100%. And as soon as the year ends, you have to hold 51% till the next 5 years, for that matter. Then only the exemption will be allowed. Sir, remember, this branch or this foreign company shall not get any other consideration except for the shares of the subsidiary. All the assets that are being transferred from this branch to this subsidiary this branch or this parent company should only get the shares of such subsidiary. No other consideration should be paid. Also, sir, certain provisions relating to the brought forward brought forward things. For example, current year depreciation. Sir, current year depreciation is to be allocated into the number of days that the asset has been into with branch or with subsidiary. We have to allocate as per number of days. We have studied this in PGBP. Sir, carry forward of losses. Sir, except for speculative losses, all the unabsorbed depreciation will be transferred to subsidiary and they can be carried forward for fresh 8 years. Sir, normally we have fresh 8 years only always. Sir, WDV of the assets, sir, WDV before, sir, WDV, whatever will be the WDV for the branch will be the WDV for the subsidiary. Whatever will be the WDV for branch will be the WDV for subsidiary. It is as simple as it can be. Closing WDV for branch and opening for the opening for this for the subsidiary. Sir, cost of acquisition for the capital asset of the subsidiary. For example, branch acquired a land and now such land is being transferred to subsidiary. What will be the cost of acquisition for subsidiary? Sir, cost of acquisition will be for the cost of acquisition will be cost of acquisition of the branch. Sir, period of holding of the capital asset. What will be period of holding? Sir, period of holding that has been held by the subsidiary and that has been held by the branch. We have to combine that period of holding. Sir, what will be the MAT credit? Sir, MAT credit can be carried forward for fresh 15 years. That means if any of the branch has MAT credit, it can be carried forward for fresh 15 years by the subsidiary. Sir, VRS and unamortized expenditure. Sir, it can be carried forward for the remaining period. Provision for doubtful debt, as provision was there in the books of the branch, will continue to be in the books of the subsidiary. Sir, on receipt of the shares of the foreign banks, sir, 56.210 not apply. 56.210 may not apply. If company fails to comply with any of the provisions, sir, AO will re-estimate the income within 4 years from the end of the violation. What this ninth provision says, this is what I need you all to focus. So, for example, we have branch. The branch had assets. Branch had asset, for example, 10 lakh. All these assets are being transferred. All these assets are being transferred to subsidiary. Subsidiary issues shares. Sir, issued share capital of at the rate 1 CR. Sir, in this case, can I say this foreign company whose branch it was received much more than what it has already given. It has given asset worth rupees 10 lakh and received share capital of 10 lakh. How is it correct? Sir, for in that case, even if they receive a foreign company received much more than what it has given, in that case also 56.210, that means gift provisions will not apply. Gift provisions in this case will not apply. So this was all about your non-resident taxation. Let's take a break for 2 minutes. Then we shall resume and start with transfer pricing. 2 minutes break. Break implies break. You need not to do anything else in this break except for hearing songs or taking a walk or having a shower. You need not to take break for any other purpose. No need to use WhatsApp, Instagram, or any other social media platform. The break is just to refresh, just for refreshment. After that, we will start with transfer pricing. 2 minutes break. So welcome back from break. Now we are about to start the next chapter, that is transfer pricing. A really very important chapter for exam. It will definitely carry 6 to 8 marks for your exam and you will see a question from this chapter. For that matter, this chapter has to be studied in whole. You cannot think of leaving anything from this chapter. So let us start without wasting any time. Sir, why transfer pricing? Sir, less relevant. Less relevant from a day before exam, it is less relevant. Sir, we need to understand any international transaction or specified domestic transaction done with any kind of associate enterprise should be done at arm's length price or correct market price. We studied three things. Sir, international transaction with associate enterprise should be at arm's length price. These three things we need to know. First of all, what is international transaction? Sir, any transaction between two associate entities. Any transaction between two associate entities, sir, at least one of them should be non-resident. At least one, sir. Can it be both of them be non-resident? Right answer is both of them also can be non-resident, but at least on one of the entity, provision of income tax should apply. It may apply because of indirect provisions. It may apply because of any other reasons, but any of the entity provisions of Income Tax Act shall apply. Sir, what I said, sir, between any two associate enterprise and at least one of them should be non-resident. Did you get this point? Yes, sir, we did get. What kind of transactions are covered? For example, any kind of expenditure, allocation of any cost, any kind of interest, or any kind of sale, purchase, lease agreement. These are the types of transactions that can be covered. So what I studied from international transaction, you need to know two transaction between two associate enterprises and sir, one of them should be non-resident. That is the bottom row. Next one is a deemed international transaction. For example, sir, in Hindustan Unilever of India did transaction of sales with Marico UK, Marico United Kingdom, which is an unrelated party. Sir, but what happened was, sir, our associate enterprise has already made agreement with Marico to buy things at a cheaper cost. For that matter, this Marico UK will also be treated as deemed will be treated as associate enterprise and it will be deemed international transaction. Did you get this point or not? So this means that any kind of transaction done with unrelated party shall be deemed to be international transaction. If you are transacting with unrelated party, it shall also be deemed to be international transaction if there is prior agreement between any associate enterprise and terms are defined by associate enterprise. What it says, if there is any prior agreement by Hindustan Unilever with Marico Limited, then in that case this transaction will be deemed international transaction. Did you get this point or not? Yes, sir, we did get this point. Sir, what is meant by associate enterprise? Sir, really very important point for your exam. Mark it double important. Every question that you will see will be asking you whether you have to state whether it is an associate enterprise or not. You have to prove that it is associate enterprise. For that matter, you need to know every bit of this definition. Sir, what this says, two enterprises shall be treated as associate enterprise if they fulfill any of the 13 conditions. If they fulfill any of the 13 conditions, they will be treated as associate. Otherwise, they will not be treated as associate. Sir, first of all, one entity holds at least 26% of the voting power of the other. For example, A Limited holds 33% in B Limited, and sir, B Limited holds 90% in C Limited. Sir, can I say A Limited holds more than 26%? Right answer is yes, it holds more than 26%. Therefore, it is a direct associate. But sir, can I say, sir, A holds 26% in C Limited? For that matter, you have to check whether A Limited holds more than 26% in C Limited. Right answer is, sir, if we consider 33% of 90%, it is more than 26%. So for that matter, C Limited will also be an associate enterprise of A Limited indirectly. Got this matter? Got this point? What is direct associate enterprise? What is indirect associate enterprise? Okay, sir, no issue. Sir, if any of the person holds more than 26% in two or more enterprises, then they shall be treated as associate enterprise, directly or indirectly. Sir, for example, there is a name, there is person called Uday Kotak. He holds 30% in Kotak Mahindra Bank, which is more than 26%, of course, and he holds 40% in Kotak Securities. Sir, can I say so Kotak Mahindra and Kotak Securities will be associate enterprise? Right answer is yes, they will be because of second condition. Third condition, sir, one enterprise is being controlled by other and the other is being controlled by the relative of the other. For example, sir, Mukesh Ambani controls the Reliance. And sir, Anil Ambani controls Reliance Power. Then in that case, if Mukesh Ambani and Anil Ambani are brothers, then in that case, Reliance and Reliance Power will be associate enterprises. Any transaction should be done at arm's length price. What fourth point says? What fourth point says? Sir, if one of the enterprises being if one is controlled by HUF and other by the member of HUF or relative of the member of HUF, then in that case it will be associate enterprise. For example, if HUF holds at least 26% in any entity, and member of HUF holds 26% in any other entity, then in that case these two entities will be associate enterprise. Did you get this point or not? Yes, sir, we did get this point. Also, there is one point. If not this member, but relative of this member, sir, relative of member, sir, what kind of relative? Not defined, sir, any kind of relative of the member of the HUF if holds 26% in any entity, then in that case this entity will also be treated as associate enterprise of such entity. Got this point? Yes, sir, we have no issue whatsoever. Sir, if any person or any enterprise has right to appoint, sir, more than half of the board of director or more than one executive director in any entity. For example, if any person has voting power, if any person has right to appoint, sir, more than half of the board of directors, or if any person has right to appoint one or more executive directors, in that case he will be treated as associate enterprise. He will be treated as associate to such entity. Sir, what happens? Sir, this point is really very important because this point is tested the most. Sir, for example, there is entity called Rahul Limited and there is entity called Rachel Limited. Sir, what it says, loan given by one enterprise, sir, represents, sir, greater than 51% of the total assets of the other enterprise. For example, sir, total assets of Rahul Limited are 100 CR, and out of that 100 CR, 100 crores, 51 CR is being loan given by Rachel Limited. Can I say loan exceeds 50%, 51% of the total assets? Right answer is yes. Sir, assume it 52 CR for simplification of the calculations. Loan given by one person exceeds 51% of the total assets of the other enterprises. So you have to check the total assets of the other enterprises, and you have to consider, you have to calculate 51% of that, and then you have to check whether loan given exceeds this percentage or not. For that matter, you will be able to identify whether it is associate or not. Sir, one enterprise guarantees at least 10% of the borrowing of the other enterprise. For example, sir, Rahul Private Limited borrows 100 CR, and out of that 100 CR, sir, 10% is being guaranteed by Rachel PLC. Then in that case, Rachel PLC will be considered as associate enterprise. Sir, next very important point, sir, very important point. Sir, business of one is dependent upon copyright, know-how, or patent of other business. Sir, for example, McDonald's India. Sir, business of McDonald's India is completely dependent upon patent copyright of the McDonald's USA. So in that case, McDonald's India and McDonald's USA will be completely associate enterprise. Sir, at the time of sales and price, sir, one has the power to influence the price and other conditions. Sir, what it says? Sir, for example, Rahul Limited, sir, transacts with Rachel Limited. Sir, Rachel Limited. Sir, Rahul Rachel Limited, in that case, sir, in one party has right to determine the sales price. Sir, for example, Rachel has ability to determine the sales price. Sir, in that case, will it be considered associate enterprise? Right answer is no, it is no, it will not be considered as associate enterprise just because Rachel has ability to control the prices. Sir, for that matter, other conditions are also to be checked. What it says, sir, Rachel should have ability to influence the price along with the other conditions of the transaction. If one of the enterprise has ability to control the price and other conditions also, in that case it will be treated as associate enterprise. Not just price, just remember, not just price, but price along with other conditions. If he has ability to control, then in that case it will be treated as associate enterprise. For that matter, Rachel Limited will be considered as associate enterprise. Sir, what it says, one enterprise had at least 10% interest in the other enterprise. For example, we have Rahul LLP. Rahul LLP has one of the partner named Rachel. Rachel holds 10%. Sir, in that case, can I say Rachel and Rahul will be associate enterprise? Right answer is yes. For partnership firm and for LLP, you don't have to check 26%. For that matter, 10% is sufficient. If Rachel holds more than 10% of the profit sharing of Rahul LLP, then in that case, Rachel will also be treated as associate enterprise. Sir, any kind of mutual interest as may be prescribed by CBDT. Sir, has it prescribed any? Right answer is it has not yet prescribed. Sir, calculation of arm's length price, really very important topic for your exam. Sir, how you have to calculate? Sir, we have 5 methods for that, and really very important point, really very important topics. First one is comparable uncontrolled price. Sir, for example, if you are transacting with somebody, sir, if you are transacting with associate enterprise and you are transacting with some other party, sir, you are selling goods at a lower cost to associate enterprise, and similar transaction is being made with somebody else in on which you don't have any control to, is at higher price. For that matter, there whatever the difference will be treated as primary adjustment. Sir, let us see first example. Let us see simple example. For example, sir, Hindustan Unilever sell soaps per carton at rupees 1800 to Britain Unilever. Britain Unilever is its associate enterprise. Sir, but similar carton is being sold to an outsider at rupees 2500. What it says, you are selling at rupees 1800 to your associate, but you are selling it at the rate 2500 to other person. Isn't it difference? For that matter, you have to check the functional differences. You have to check the functional differences. Sir, what kind of functional differences? Whenever you are selling it to Marico, it is on CIF basis. But if you are selling it to Unilever, it is on FOB basis. So for that matter, sir, in case of sale to Unilever, sir, any kind of freight you have to bear, any kind of insurance you have to bear, for that matter, price is low. Sir, what is the value of insurance and freight? It is 200. Sir, even if you add the freight, you should at least charge 2000. You should charge 2000. You should have charged 2000. Or I can say vice versa. Even if this freight or insurance is being borne by you, not by Marico, you should have charged 2300 from Marico. 2300 you should have charged from Lever, but you charged 1800 only. For that matter, you are charging 500 less. Okay. So credit period is given to Marico 1 month worth. You are giving credit period to Marico, but you are not giving credit period to associate in price, which is worth of rupees 100. So reduce that price from this. So at least 400 should be difference. 400 should be difference. At least you should charge 400 despite of functional differences. For that matter, 400 will be primary adjustment. This is how you have to solve. Sir, you have to remember the format. Sir, first of all, you have to take the price charge in independent party transaction. Sir, in this case, you have to take the price of uncontrolled price. You have to take the value of uncontrolled price, that is 1500. Then you have to adjust for functional differences. Sir, how you have to adjust for functional differences? Basic thing is your common sense. Basic thing is your common sense that will help you a lot. Otherwise, this example, most of the times it is bound that these type of examples will repeat itself. So if you have practiced question answers, it will be of greater help that you will be able to solve those questions in exams. Sir, resale price method. Without going to format, let us see the example first. Sir, Hindustan Unilever purchases from Unilever Britain. Sir, what is purchases made? Sir, what worth, sir, 2 CR purchases is being made? Sir, Hindustan Unilever sold goods to Rahul at 2.5 CR. Okay, sir, no problem. Sir, normally gross profit margin is 40%. How much margin Hindustan Unilever has charged? Sir, it has just charged 20%. Oh my God, sir, it has just charged 20%. That means some or the other way, this Unilever has made purchases at a higher price. Understand this point. You are selling it to an unrelated party at a low profit margin. This implies you must have bought at higher price. Therefore, your profit margin is low. You must have bought at higher price. Therefore, you are reducing profits in India. Therefore, arm's length price adjustment is important. That is why we use resale price method, where you buy from associated enterprise and sell to an unrelated party. Okay, sir, how transaction will be treated? Sir, take this price 2.5 CR. Sir, reduce the normal gross profit margin. What is normal gross profit margin is 40%. Sir, reduce 1 CR from that. At least you should have charged, sir. At least your buying price should have been 1 CR. Your buying should have been 1 CR, but you bought at 2 CR. That means you are buying at a higher price. Okay, sir. But one point says, but Unilever charges 2% of the sales as brand value. Unilever charges 2% as brand value. Sir, what is 2%? Sir, 2.5 CR you are making sale, and 2% of that will be 2.2% of that will be 5 lakh. So this is the royalty difference. This is the difference of royalty. This is allowed. This is allowed in international transaction. So even if you should have bought at 1.55, even if despite of royalty, sir, add 5 lakh in that, you must have bought at 1.55 lakh now. Despite of this royalty, despite of this brand value, you must have bought at 1.55 lakhs, 1.55 CR. But you bought at 2 CR. So whatever the difference will be added to will be added as primary adjustment. 45 lakh will be primary adjustment. Sir, how you have what will be the arm's length price? Arm's length price will be 1.55 lakh, 1.55 CR. At this point, this is resale price method. Sir, what is cost plus method? Or what cost plus method says? Sir, right away come to example. Sir, this example is really very important. Sir, even if you don't understand this concept, so this example is bound to repeat itself, because in most of the cases, this example in itself repeats an exam. So for that matter, just understand the example. Sir, for example, Hindustan Unilever sold machine of rupees 70 lakh rupees to Britain Unilever. Okay, sir, no problem. Sir, what is cost of production? Cost of production is 50 lakh rupees. Okay, sir, 50 lakh is not an issue. Okay, fine, no issue. Sir, normal GP margin is 40%. I forgot to mention it. Normal GP margin is 40%. Sir, normally, if this transaction would have been made to a normal person, 40% would have been easily charged by Hindustan Unilever. But in this case, how much percentage they are charging? How much percentage they are charging? Sir, okay, let us ignore for that matter. Let us ignore for that matter. But there are some functional differences in this case. What are those functional differences? Sir, Britain Unilever gave technical support, which is 10% of GP margin. Sir, 10% of GP margin. Okay, no issue, no issue. Sir, what is the value of this technical support they are giving? So GP margin is 40%. Of that, 10% will be 4%. 4% difference is allowed. That means even if you are charging 40% from the others, 4% discount is allowed because you are getting some technical services also now. So less margin is allowed. Okay, sir, no issue. Britain Unilever is an old customer and buy in bulk, thus discount at the rate 5% of the GP is expected. He's buying in bulk. Sir, 5% of GP. What is 5% of GP? So 2% discount. So this is also discount allowed because, sir, 40%, how can we charge? He's a old customer. 2% discount is allowed. Sir, Hindustan Unilever gave credit to Britain Unilever of 1 month valued at 1% of the transaction price. Oh my God, this is not done. This is not done. Sir, what happens is 1%, sir, credit is given. You are not giving credit to anybody else, but you are giving credit to Britain Unilever. For that matter, you should charge extra profit. So for that matter, this 1% should be increased. Sir, at least you should have charged how much percentage? You should have charged 33%. You should have charged 33% in this case. So you should have charged 33% on the cost. You should have charged 33% on the sales. You should have charged 33% on the sales. Now, how much you should have charged on cost? How much you should have charged on cost? So 33% divided by 100 minus 33 turns out to be 50% you should have charged on cost. If 50% you would have charged on cost at the cost of 50 lakh, adding 50%, you should have at least charged 75 lakh. How much you are charging? How much you are charging? 70 lakh. How much you should have charged is 75 lakh. Sir, whatever the difference is, 5 lakh will be adjustment to be made, will be the adjustment made in the ITR. Got this point? Yes, sir, we did get this point. You need to understand this concept is tricky. Cost plus method turns out to be tricky in most of the cases. But for that matter, you need to remember this question. If you are not able to understand this question, I think it is not wise enough to leave this topic. It is wise enough to remember this topic because it might be possible you might see similar question in exam. These examiners do not focus on making new questions, rather they repeat questions from past. So for that matter, this cost plus method is important. If you did not understand this question, complete question answer videos uploaded on YouTube. You can refer that. It's in Hindi if you are comfortable with that. Otherwise, this example is sufficient in itself. And if you can remember it, it will be of great help. If you did not understand, if you understand, then it's no issue. Then profit split method. So profit split method, what it happens, sir, it is done in joint ventures. It is done in joint ventures. So what happens is, for example, there is a project which we are three joint venturers. So for example, Ross PLC of USA, Rachel Inc. of UK, and Rahul Limited of India. Three people are the partners. So what is the cost incurred? Cost incurred is 5 lakh by Ross, the 6 lakh by Rachel, and Rahul incurs 9 lakh rupees cost. Sir, total cost is, sir, 20 lakh rupees. If you do total, it will be 20 lakh. Okay, sir, no issue. Sir, what is the total revenue? Total revenue is 30 lakh. Sir, what is the amount of profit? Sir, amount of profit turns out to be, so 30 lakh minus 20 lakh is nothing but 10 lakh. 10 lakh is the profit. Okay, sir. Now this profit is to be split between different parties. Sir, what can be the possible basis of splitting these profit? Sir, it can be either cost incurred, so that can be one basis, or it can be either capital employed, which is given in question. In most of the cases, you have to use capital employed. So how this profit will be split? Sir, 1:1:3. So what will be the share of Rahul? So 10 lakh into 3 by 5 is nothing but 6 lakh rupees will be Rahul's share. Okay, sir, no problem. So 6 lakh is his share of profit. Along with that, he incurred 9 lakh cost. So he must receive at least 15 lakh. He must receive 15 lakh. Any lesser money received will be considered as primary adjustment, and that is to be adjusted in ITR. Okay, sir, no issue whatsoever. No issue whatsoever. Next example, sir, what it says. The transactional net margin method, what it says. Under this method, sir, you have to compare the other players in the same industry in the similar circumstances for computing arm's length price. Sir, understand the example. Sir, Google India transacts with Google USA. It provides technical services worth rupees 1 CR, and operating cost is 70 lakh rupees. Okay, sir, 70 lakh cost, 1 CR is the transaction value. Whereas, sir, listen, Facebook provides similar services at 60% margin. What margin we are charging? Sir, just find out what margin we are charging. So 30 lakh profit we are earning on 70 lakh. Sir, we are charging 42.8%, whereas Facebook charges 60%. Oh my God. Facebook charges 60%. No issue. Sir, if we charge 60% on our cost, sir, what happens is 70 lakh plus 60%, what happens is 70 lakh plus 60%, what happens is, sir, 1.12 CR. This is the price we should have charged. But how much we are charging is 1 CR. So 12 lakh will be adjustment to be made. So arm's length price will be 1.12 CR. Sir, there might be a possibility that you might get confused between TNMM method and cost plus method, because in both of these methods, we are adding percentage on the cost involved. But for TNMM, you need to understand this thumb rule that you are comparing with other person. You are comparing with other person, but in cost plus method, what you used to do is nothing but normal GP margin. You are comparing with yourself. You are comparing with other transaction of yourself. But in TNMA method, transactional net margin method, you are comparing yourself with other entities, other players in the industry. These are two basic differences between cost plus method and TNMA method. Most of the students are most of the students make mistake in these in finding out which method to apply. So I have told you thumb rule. In case of cost plus method, you are given normal gross profit margin of yourself with other transactions. In case of TNMM, you are given gross profit margin of other players in the industry. And if you are not given gross profit margin, you are just given, if you are doing transaction with this person and transaction with that person, you have to use the controllable uncontrolled price. Got this, sir? Okay, no issue. Sir, what if we apply TNMM? Sir, in this case only, if we apply TNMM, sir, we compared the transaction price of Facebook with Facebook USA. What if we could have done it? We could have done transaction price of Wipro with Wipro USA, or Infosys with Infosys USA, or TCS with TCS USA. So there might be more than one transaction price available. There might be more than one arm's length price that can be calculated using the same method. Is it possible? Right answer is it is possible. That arm's length price can be calculated more than once in this through the same method, like through TNMM only now. If you are comparing yourself with Facebook, you could have easily compared with Wipro, you could have easily compared with Infosys, you could have easily compared with HCL. So all these tech companies, you could have got the same transaction value. For that matter, you would have received it, you would have attained a different arm's length price via different methods. For that matter, how will you calculate exact one arm's length price for your transaction? We have different concept for that. But if we have more than one arm's length price via single method only, what to do? We have to identify, do we have more than one up to five arm's length price? We have more than one, but up to five. Then in that case, you have to take the simple arithmetic average of all those transaction price, and you will arrive at one ALP, and that ALP you have to consider as benchmark. But if you have more than six or more, if you have arrived to six arm's length prices or more, then in that case, range concept will apply. Sir, what is that? We'll understand in detail. Sir, for arithmetic mean what you have to do. Sir, for example, let us come to example first. Sir, for example, transaction we have done at 1,000. But for arm's length calculation through suitable method, we arrived at five transaction values. What to do, sir? Take simple average, add all five, divide by five will be 1,036. 1,036 is the arm's length price. Sir, what this provision says, sir, you are allowed 3% margin. Even if your if your transaction price is not equivalent to arm's length price calculated, so 3% variation is allowed. Sir, what 3% variation? Sir, you did transaction at rupees 1,000. Take 3% margin, sir. You could have done transaction at 1,030. But at what you did? Sir, you did at 1,036. That means you did way more than what is allowed. In, in that case, what will happen? Whole 36 difference will be treated as primary difference, and it will be treated in ITR. Did you get this point, sir? What to do? Sir, if we have more than one, if we are doing arithmetic mean, and sir, difference between actual transaction price and calculated arm's length price is lesser than 3%, then in that case, sir, whatever transaction price is will be arm's length price. Whatever transact, if this difference would have been lesser than 3%, for example, if arm's length price would have been 1,025 and transaction price would have been 1,000, then 1,000 only would have been arm's length price. But since difference is more than 3%, in that case, what will happen, sir? Whatever arm's length price arrived will be arm's length price, and difference has to be treated in primary adjustment. Sir, for wholesale trading, sir, this 3% limit is reduced to 1%. If this would have been wholesale trading, then range would have been 1%. Then in that case, 1,010 would have been the margin. Any transaction beyond that would have been liable for primary adjustment. So this is the simple arithmetic rule. So what is wholesale trading? So wholesale trading implies any kind of business in which purchase cost of goods is more than 80% of the total cost of the business. So if you consider P&L, you have to consider total cost. So out of the total cost, more than 80% is just purchase cost only. Those businesses are wholesale business, and along with that, average inventory is lesser than 10% of the sales of that month. So whatever average inventory you have, it should be lesser than 10% of the sales. That means you are holding very less inventory, but you are transacting very fastly. Okay, sir, no issue whatsoever. Sir, what will happen if we have six or more arm's length price? Then you have to apply range concept. This concept is tricky. You have to focus along with me. Some scribbling is already done. Need not to worry about that. Okay. Sir, what happens is, sir, whenever range concept comes, you have to calculate the median. If you already know median from CA foundation, you need not to worry about it at all. But if you do not remember median, then you have to focus here. Seriously. Sir, for example, we arrived at 10 arm's length prices. For example, we arrived at 10 values. What you have to do, sir, first of all, you have to rearrange data into ascending order. From smallest to largest, you have to arrange. So right away, we just arranged. In step number 2, you have to identify, sir, 3 values. So out of these data of 10 figures, you have to identify 35th percentile value, 50th percentile value, and 60th or 65th percentile value. Sir, what is 65th percentile, 35 percentile? Sir, out of 10, sir, what is 35th percentile is nothing but 3.5. Out of 10, so 65th percentile is nothing but 6.5. So ultimately, out of those data set, number of data sets, you have to find out the percentile value. Sir, if these percentile values are not whole numbers, if these values are not whole numbers, take the succeeding value. Sir, for example, 35th percentile of 10 values is nothing but 3.5. Since this is not whole number, take the fourth value. Sir, fourth value in the data set is the 30th percentile, 35th percentile. Sir, what is the fourth value? 1050 is the 35th percentile. Sir, what is 65th percentile? 65th percentile, 65th percentile of 10 is nothing but 6.5. Since this is also not whole number, this is not whole number, take the succeeding value, so 7th, and take the 7th value from the data set. So 7th value from data set is nothing but 1080. 1080 is the 65th percentile. Got this point? Sir, also 50th percentile. Sir, 50th percentile. 50th percentile is nothing but the fifth value. Sir, since this is whole number, this is a whole number. You cannot take sixth value, you cannot take fifth value. You have to take average of fifth and sixth. If 50th percentile or 35th percentile or 65th percentile is a whole number, so take average of that value and succeeding value. In this case, since fifth we have arrived at a whole number, you have to take the average of fifth value and sixth value. So what is the value at fifth position and sixth position? So at fifth position we have 1060 and sixth position we have 1070. So average turns out to be 1065. So our 50th percentile value is 1065. How arm's length price is determined? So assume whatever the transaction price. Assume whatever the transaction price is, that transaction price should lie between 1050 and 1080. That means it should lie between 35th percentile and, sir, 65th percentile. If this transaction price lies between this range, if this transaction price lie between this range, then what will happen in that case? In that case, sir, our transaction price will be arm's length price. But what if transaction price lies below, before this or after this? Then what will happen? Then you have to consider the value at 50th percentile as arm length price. At this point, we are revising faster. I expect you already know these things. We are just revising. Got this point, sir? We did get this point. Believe me or not, if you have studied this even once, you should be comfortable with these things, because these are not difficult things. Okay, koi dikkat nahi, no problem. Okay. Sir, for range concept is not applicable for profit split method, because in profit split method there can be multiple ways. You should be restricting yourself to 5 ways only. Sir, no range concept is available for PSM method. In all the other concepts you can apply range. Sir, what happens is, after that, the less relevant point, you can even ignore this point. But sir, what happens is determination of arm's length price by assessing officer. Sir, in what cases assessing officer will determine your arm's length price? Sir, what if, sir, when assessee fails to apply the appropriate method? Sir, assessee should have applied cost plus method, but he applied cup method. In that case, sir, assessing officer will compute ALP. Or sir, data is not reliable. Sir, whatever data assessee uses is not reliable. Or sir, documents are not being maintained by assessee. Or in that case, sir, in case where assessee is required to furnish information to assessing officer and assessee could not furnish. In these 4 cases, sir, assessing officer will calculate arm's length price for assessee. Sir, in whatever case, when he calculates, sir, reasonable opportunity of being heard will be given to assessee. Without that reasonable opportunity, AO will not compute AO will not compute any kind of arm's length price. Okay, sir, got it. Sir, effect of arm's length price, sir, what will happen? Sir, what will happen? Just listen to this point very seriously. Sir, do AO know how to calculate arm's length price? Right answer is AO does not know. AO does not know how to calculate arm's length price. For that matter, he will be giving reference to transfer pricing officer. Sir, is it really relevant? Sir, for examination point of view, there is nothing different that you will be studying here. There is nothing different you will be studying here. You can just ignore this point. Sir, what this says, sir, transfer pricing officer on being referred by the assessing officer shall gather information. On the basis of material gathered, he shall compute arm's length price and calculate order. That is it. Sir, in case of 148 assessment, sir, he shall get 60 days extra to pass an order. Sir, In case assessment is pending under section 148, in that case he shall pass order within 60 days, 60 days prior to the final date of passing order. So for example, final day of passing order is 1st April, so 31st March 2024 is the last date of passing order. So he should pass his order, he should pass he should give his report before 31st January 2024. At least 60 days prior, he shall be submitting his report to the assessing officer. That is the bottom line. Sir, what if, sir, assessment proceedings are being stayed by the court, then transfer pricing officer, then time given to transfer pricing officer, in that time limit, you have to exclude that period of stay. Also, sir, who can be transfer pricing officer? It can be joint commissioner, assistant commissioner, deputy commissioner, or any person authorized by CBDT. Only these persons will be authorized, no other person will be authorized. Sir, one point is important. Sir, what will be effect of arm's length price if calculated by assessing officer? Sir, if assessing officer or TPO calculates the arm's length price, what will be effect on our transaction? Sir, what will happen is, sir, there are two impacts. Sir, what if, sir, listen to this example. For example, we have Rahul Private Limited. Sir, Rahul sold goods to Rachel. Sir, sold goods to Rachel at 1 CR. Either he could have sold at 1.6, 1.3 CR. Sir, this is the transaction price. Sir, but this is arm's length price. So what is the difference? 30 lakh is the difference. Sir, if assessing officer finds out this and assessing officer calculates the arm's length price, sir, what will he do? He will add 30 lakh to the income of the Rahul. He will add 30 lakh income to Rahul, income in the hands of Rahul. Sir, but will he allow 30 lakh additional deduction to Rachel? Will he allow 30 lakh additional deduction to Rachel? Right answer is he will not allow. If income of one of the enterprises being increased, the income of other associated enterprise remains unchanged. In this case, Rachel will not get deduction of this 30 lakh. She has to debit rupees 1 CR only to her P&L. She will not be allowed expenditure of this deduction of this expenditure. But bottom line is, if income of one enterprise is being increased, the other remains unchanged. Second thing, sir, what happens is, sir, for example, if an entity has income, say for example, 10 CR and took deduction under section 10AA, 10 CR. Sir, what if this income is being reduced to 15 CR? Will they be entitled to increase amount of 10AA? Right answer is will not be allowed. Already you are being given concession. In that case also, you are undercasting your profit. You are transferring assets to associate enterprise at a lower cost. You are reducing your income. How can you do so? You are already given 100% deduction. For that matter, then too you are doing something wrong. So for that matter, no additional deduction will be allowed if income is being increased by assessing officer in case of calculation. So safe harbor rules you can simply ignore. So safe harbor rules simply you can ignore. Sir, advanced pricing agreement, sir, what it says, sir, you are agreeing, you are entering into an agreement with CBDT for determination of any kind of transaction. The transaction that you had already entered in past, you are thinking that those transactions will continue in future. So for that matter, you are entering into agreement with CBT so that any kind of assessment that may come across your way is avoided. Assessing officer will not interfere in any kind of agreement that has already been done with CBDT. So for that matter, you apply for APA. Sir, what happens is, sir, APA can be whenever APA is entered, then in that case, sir, there can be no reference to TPO. TPO's role will be over if APA has been entered, and sir, there will be no computation of arm's length price because arm's length price is already decided in APA. Sir, AP can be entered for maximum 5 years. Sir, for example, I want APA for previous year 23-24. Sir, for how long I can have, sir, maximum 5 years, 23, 24, 25, 26, 26, 25, 26, 26, 27, and 27, 28. Sir, these are the 5 years I will be allowed APA. Sir, what is the last date of application? Sir, you have to file the application before beginning of the first previous year on which you require APA. Sir, for example, I require advanced pricing agreement for previous year 23-24. Sir, what is the last date of application? Sir, 31st March 2023. Before the commencement of the previous year on which you want APA, you have to apply for that. You cannot seek APA on already commenced the previous year. Okay, sir, got this one, no issue. Sir, for 5 consecutive years. Sir, APA is binding on. Sir, APA is binding on. Sir, and whoever person enters into APA, it will be binding on that person. Sir, any kind of IT authority, CIT, PCIT, PCCIT. Sir, since CBDT is entering, so PCCIT will also be bound with APA. Sir, any kind of transaction in which APA is entered, APA will be also binding those transactions that are being mentioned in APA. Also, sir, CBDT may declare void ab initio APA as void ab initio if later on it finds out that this APA was being entered by willful misstatement or any kind of misrepresentation of facts. But this, what will be consequences of declaring it as void ab initio? So any transaction entered, so all the provisions of the act will apply as if no APA was ever entered. So in case APA is declared as void ab initio, sir, every transaction will be considered as if no APA has been ever entered. You have to consider the regular provisions of Income Tax Act. So whatever the time since the date of application till the date of granting, till the date of till the date of declaration of void ab initio. From the date of application till the date of declaration of void ab initio, whatever the time that has been lapsed will be reduced, will be excluded for completion of assessment of the previous year for those years for which APA has been entered. What I'm saying, whatever the time that has been wasted from date of application till the date of declaration of void ab initio will be excluded from calculating due dates for the assess for due dates of any kind of proceedings under this act. Okay, sir, no issue. Even after reducing these days, if assessing officer has lesser than 60 days, then he shall at least get 16 days to file to pass the final order. So now we have rollback. Sir, we are entering for next 5 consecutive years. Sir, is it possible that we have entered into those transactions in last 4 previous years? Is it possible we have also entered in past? Sir, it is possible. And for that matter, some of the cases are pending with different kind of assessing officers. For that matter, we want to end the dispute. So for that matter, what we want a rollback. We want a rollback. What rollback implies? Whatever transaction that we are aiming to enter in future, we have already entered into past. So for that matter, provide us a rollback so that any kind of dispute that is arising in previous years will be sorted in that case. Sir, what it says, sir, there are certain conditions for rollback. You will be only allowed rollback if you comply with 5 of the conditions. What it says, for whatever years you want rollback, sir, you should have filed return under section 139(1). You should have not filed belated return. This is important question. No belated return is allowed, sir. No belated return is allowed in any of the previous year. If you have filed belated return, for that matter, you will not get any kind of rollback. Okay, sir, no issue. Sir, whatever transaction that you are about to enter in future for which you have asked for APA, the similar transaction you must have incurred in past for which you are applying rollback. Sir, rollback application shall be for 4 years. You cannot seek rollback for lesser than 4 years. Also, sir, remember you have to pay the fees of 5 lakh. You have to pay the 5 lakh fees and you have to furnish form 3 CEDA. 3 CEDA, 3 CEDA. You have to furnish form 3 CEDA. Along with that, for every year for which you are seeking rollback, you must have undergone audit under transfer pricing section 92E. You must have undergone audit. But this point, no issue, sir, whatsoever, no issue. Sir, in 2 cases, the rollback is not applicable. Sir, in 2 cases, rollback is not applicable. Sir, what are those 2 cases? First of all, in any of the previous year for which you are seeking rollback, case is already pending at ITAT. For example, in previous year 2021, sir, AO has contended something, and for that matter, the case is pending at ITAT. And ITAT has disposed of our application against us, disposed of an application against us, rejecting the transfer price that we are contesting. So, in that case, no rollback is allowed for that year. Sir, what I am saying is, sir, for example, for previous year 21-22, we calculated arm's length price at 100 CR with a method, any method, say method 1. Assessing officer calculated arm's length price with method 2 at 130 CR. Now in previous year 23-24, I am seeking APA plus rollback with method 1, and ITAT has disposed of method 1. ITAT has rejected that method 1 is not allowed. So will CBDT allow APA against that method? CBDT will not go against ITAT and will not allow rollback in that case. Sir, what is the second case? When rollback provision results in reducing the income as declared in return of income. Sir, what it says? Sir, for example, assessee filed return of income worth rupees 70 CR. Sir, his assessed income is 90 CR. Sir, his assessed income is 90 CR because of certain adjustments, because of certain wrong arm's length prices. His assessed income is 90 CR. Sir, for example, now APA is being entered. And because of APA, his income is being reduced. Sir, for example, if his income is being reduced by 10 CR, Can he enter into rollback? Right answer is, sir, if his assessed income is being can be reduced na 10 CR, then it is allowed. Then APA, then rollback can be entered. But if this total filed income is being reduced because of this APA or because of this rollback, he will not be allowed rollback for that previous year. Got this point or not? Yes, sir, we did get this point. Sir, what will be the effect of APA? So what will be the effect from the date prior to entering the AP? If any return has been furnished, then assessee has to file a modified return within 3 months from the end of the month in which AP is entered. Sir, if any return has already been furnished for which you have been seeking rollback, sir, for that matter, you have to file a modified return. Sir, modified return within 3 months from the end of the month on which you entered for APA. Sir, for any kind of pending assessment, if any assessment of any previous year is pending, AO will get extra year for completion of the assessment. Also, if any kind of assessment that has already been completed, what AO will do, AO will pass modified order according to the AP and rollback. So some certain clarifications. So you cannot seek APA for 1 or 2 years. You have to file application for at least 4 years, and you have to fulfill all the conditions that are prescribed above. So that audit one, that return you have that must be filed. You have to file. You have to comply with those conditions, but you cannot apply for APA for single year. You have to apply for 4 years only. So return must have been filed under section 139(1). No late return should be filed. So revised return is allowed, but no 139(4) return is allowed in rollback. So also you can seek APA for future years, for further years, but you can seek APA and rollback simultaneously. But you cannot seek a rollback without entering APA for future. See, asking for advance pricing agreement for future can give you additional advantage for rollback. But you cannot seek just rollback without asking for any future advance pricing agreement. That is not allowed. Sir, what is the compliance procedure? Sir, for that matters, for entering APA, you have to file an application to DGIT, International Taxation, before pre-consultation that whether SSC is allowed, whether SSC is eligible for AP or not. So what is the fees that he has to pay with application? The fees is, sir, up to 100 CR 0.1%. So up to 100 CR, take 0.1% will be 10 lakh. It will be the fees. For 100 for greater than 100 CR up to 200 CR, sir, just consider 0.1% of 150, it will be 15 lakh. Sir, these are the tricks to make you remember. For transaction greater than 2 100 CR, take 0.1%, it will be 20 lakh. So for any transaction up to 100 CR, 10 lakh. Any transaction between 100 CR to 200 CR, 15 lakh. Any transaction exceeding 200 CR, you have to take 20 lakh. And along with that, you have to pay 5 lakh rupees for rollback and 3 CEDA. You have to pay 5 lakh. Sir, if SSC before finalization of APA wants to withdraw the application, can he do so? Right answer is he can simply do so, but there will be no refund of fees. Sir, what will APA include? Sir, APA includes, sir, whatever the international transactions that are being required to be covered. Sir, how transfer pricing will be calculated? Sir, what assumptions that they will be using, and any kind of rollback, if applicable, will also be detailed. Sir, compliance report. Sir, SSC has to furnish compliance reports, sir, remember, within 30 days from the date of the due date of ROI. Sir, due date of ROI is nothing but 30th September. 30th September, sorry, 30th, due date of ROI is nothing but 30th November. Within 30 days, assessee has to furnish compliance report, or, sir, 90 days from the date of entering APA, whichever is later. Whichever is later, sir, for every year you have to furnish compliance report. What is the due date? 30 days from the end of the 30 days from the end of the due date of 30 days from the due date, or 90 days from entering AP, whichever is later. Sir, also assessee has to undergo compliance audit. Sir, who will do compliance audit? Compliance audit will be done by transfer pricing officer. Sir, transfer pricing officer will be appointed by assessing officer. Sir, when this transfer pricing audit will be conducted, sir, it has to be conducted within 6 months from the end of the month in which, sir, compliance report is being received by the assessing officer. Sir, assessee files return. Within 30 days, he has to file the compliance report. Sir, as soon as this compliance report is being received by the assessing officer, within 6 months from the end of that month, he is required to get the compliance audit done of that assessee. Sir, I have given you timeline. You can ignore this timeline. That has never been asked. This is less relevant. Sir, secondary adjustment. Sir, if any kind of primary adjustment is being done, sir, for example, Rahul transacts with Rachel. And sir, there is primary adjustment of 30 lakhs. So just example, for example, Rahul is in India, sold goods to Rachel. And sir, value of the goods is 100 CR. So transaction could have easily been done at 1.3 CR. So 30 lakh is nothing but primary adjustment that is to be added in the income of the Rahul. This is the primary adjustment. Sir, this primary adjustment is treated nothing but a loan given to Rachel. And this loan given should be repatriated to India because you are transacting at a lesser price. So we are assuming that you have given loan to that, because of which you are transacting at lesser price. So you have to bring that money to India. Excess money has to be repatriated to India. And if such money is not repatriated to India, SSC has to offer interest on such money. SSC has to offer interest on such loan advance. That is what we called secondary adjustment. Got this point? Yes, sir, we did get this point. Sir, listen, listen. When you have to carry out the secondary adjustment, sir, for that matter, whenever there will be primary adjustment, there will be secondary adjustment. If there is primary adjustment, there will be secondary adjustment. Sir, in what cases we'll have primary adjustment? Sir, if SSC suo moto says my transaction price is wrong in ROI and he files in ROI, he corrects in ROI, in that case secondary adjustment will be there. Sir, if because of any appellate authority, because of order of any appellate authority, is a transfer pricing is being decided, and because of which SSC is required to carry out primary adjustment, he is also required to carry out the secondary adjustment. So if any kind of transaction price is being determined by advanced pricing agreement or any kind of safe harbor rules or any kind of mutual agreement procedure, in any of these cases, SSC agrees with the transaction price, he has to carry out the primary adjustment. Along with that, he is required to carry out the secondary adjustment. So what this point says, this point says excess money as a result of primary adjustment is required to be repatriated to India. Up to the due date of repatriation, such money shall be deemed to be advance given. It will be assumed as advance given to such SSC. Repatriation shall be made within 90 days from the table below. Sir, you have to repatriate, you have to get that money back from that person to India within 90 days. So you have to calculate 90 days from, this is important. If it is not repatriated within 90 days, then interest shall be calculated on from the next day. What it says, just listen. So what if primary adjustment is being made because of order of the appellate authority? For example, because of IT or assessing officer, you are required to make primary adjustment. So from the date of the order, within 90 days, you have to get that money back from that person. If you could not get back, if you could not get back within 90 days, you will be charged interest from the date of the order. That means those 90 days that have been lapsed and you could not get that money, you will be charged interest on that also. Sir, for example, sir, order is being passed on 1st Jan 2024. In how long you have to get that money, sir? As for simple calculation, assume that you are required to get that money back within 31st March 2024. Sir, you could not get money up to, sir, 1st April. Sir, from when interest will be calculated? Will it be calculated from here? Right answer is no. Interest will be calculated from the date of the appellate order. Date of the order by the appellate authority. Yes, sir, we did get this point. Sir, if primary adjustment is being made on account of mutual agreement procedure. Sir, mutual agreement procedure between two countries. Sir, two countries under section 90 sit together, decide the residential status, decide the transaction price, because of which primary adjustment is required to be made. So SSC is required to get that money repatriated within 90 days from the date of giving effect by the AO to such mutual agreement procedure. So what it says, sir, as soon as mutual agreement procedure is done, AO is required to to pass an order incorporating such mutual agreement procedure. As soon as AO5 passes the order within 90 days, SSC is required to get that money repatriated. If he could not repatriate, in that case, he will be required to pay interest from the date on which as AO passed the order. That means he will also be charged interest for those 90 days also. Now, these are two tricky points. First of all, listen. If any kind of primary adjustment is being done because of advanced pricing agreement, you have to check whether advanced pricing agreement was entered before the up to the due date of ROI or not. If advanced pricing agreement is done before ROI, then what happens? You have to consider actual date of ROI. You have to consider actual date of ROI and get that money repatriated within 90 days from the actual date of ROI. But if you could not get repatriated, then interest will be calculated from the due date of the ROI. Got this point? This is important, sir. This is important. And also another is important, I'll tell you. If APA is entered after due date of ROI, sir, ROI due date has been passed. Now what happens is you have to check from the end of the month in which APA is entered. Sir, as soon as, for example, APA is entered on 1st January 2024. So you have to get this money repatriated from the end of the month, so 31st January, and 90 days from there, and sir, plus 90 days. You have to get this money repatriated within 90 days from the end of the month in which APA is entered. And if you could not get repatriated, interest will be charged from, sir, 1st Feb itself. Okay, sir, This was it. So last case, really very important. Sir, really very important because MCQs have been asked innumerous times from this point. Sir, because of any other reason, for example, SSC did primary adjustment suo moto in ITR. SSC did primary adjustment suo moto. So from that day, from in that case, so you have to consider the due date of ROI. You have to get this excess money repatriated from the due date or from the other SSC. You have to get this excess money repatriated from the associate enterprise within 90 days from the due date of the ROI. But if you could not get that repatriated, the interest will be charged from the due date of the ROI. So due date is important in any of the case where SSC does any kind of suo motu adjustment. So for that matter, money is required to be repatriated within 90 days from the date of repatriation, date of the ROI. And if he could not get that repatriated, then interest will be charged from the due date of ROI. Got this point? Sir, how much interest will be charged in case of secondary adjustment? You have to check whether that international transaction is denominated in Indian rupees or not. If such international transaction is denominated in Indian rupee, then whatever is the SBI rate as on 1st April plus 3.25%. For example, 11% is SBI rate and 3.25% is labor. 3.25% you have to add. So 14.25% interest will be charged. But if such transaction is denominated in international currency, for example, loan is being given or any kind of sales is being made in dollar. So for that matter, how much rate you will charge? So you have to check 6 months labor as per 30th September. 6 month labor as per 30th September plus 3%. 3.25% in case of rupee denominated transactions and 3% labor plus 3% in case of foreign currency denominated transaction. Okay, sir. Very important point because this is being tested in numerous times. Sir, if SSC is not, if SSC does not want to pay, if SSC does not want to do any kind of secondary adjustment, what can he do? He does not want to offer interest. If he does not want to get excess money repatriated back to India, what will he do? For that matter, sir, he can pay an additional tax. He can pay additional tax, sir, at the rate 18% plus 12% surcharge plus 4% education cess on the excess money. Sir, for example, simply this point says Rahul sold goods to Rachel. And sir, so transaction price of 1 CR actually could have been simply 1.3 CR, 30 lakh is excess money with Rachel. Rahul has to get this money repatriated back to India. So this 30 lakh primary adjustment will always be made, but interest on such money will also be charged to Rahul's income, but that interest can cease to happen. That interest can stop if Rahul pays additional tax on this 30 lakh, so additional tax of rupees 18% plus 12% plus 4%. That means effectively 20.9664% effectively is required to pay tax. Sir, even if he pays the additional tax, he will be required to pay interest till the date on which he pays the tax. Pays the tax. If he does not make the additional, if he does not pay the additional tax, he has to get that money repatriated back to India. Otherwise, interest will be charged for X number of years. But if he pays the additional tax, interest will cease to stop on the date on which he pays the additional tax. But till then, he has to pay, he has to offer such interest in his income. Sir, in two cases, you don't have to do a secondary adjustment. What are those two cases? Sir, if primary adjustment is up to 1 CR or in case of primary adjustment is relevant to assessment year 16-17 or any prior previous year. So we have an example, very classic example. Sir, for example, India Unilever sold goods of rupees 100 CR to England Unilever. Sir, arm's length price is 130. Sir, transaction took place on 1st July 2023. Okay, sir, no issue. Primary adjustment in ITR 30 CR, no issue, sir. 15 November, due date 30th November. ITR was simply filed. In ITR only, I made the adjustment and I made adjustment of rupees 30 CR. Now this 30 CR is required to be brought back to India. Is required to be brought back to India within 90 days from the due date of the ROI. They are required to be repatriated back to India. Sir, also 30 CR is stated as loan and interest on that 30 CR is to be offered unless such money is repatriated back to India. Simple. SBI rate assume 11%. Interest for previous year 24-25. How much it will be? The 30 CR is loan taken, loan assumed. Sir, 11 plus 3.25% for 121 days out of 365 days. Sir, 1.417 CR will be interest from 1st December till 31st March 2024. Now, SSC wishes to pay the additional tax on 31st March 2025. In that case, sir, he will be still required to pay interest up to 31st of July 2025. And how much interest will be? Sir, interest will be same, sir, 14.25% for, sir, number of days. For 122 days, he will be required to pay interest out of 365 days and on 30 CR. So total interest that he is required to pay is 1.49 CR plus 1.41 is nothing but 2.846 CR. I know example is a bit fast, but this example is a concept builder. This example is a concept builder. You already know these concepts. Remember, you already know these concepts. Okay, sir. And additional tax is required to pay 20.9664% of 30 CR is nothing but 6.29 CR. Okay, sir. Got it. No issue. Sir, maintenance of information and documents. Sir, every SSC who enters into any kind of international transaction or domestic transaction is required to maintain, sir, proof of transaction. So whatever transactions you are entering, you have to enter those transactions in your, sir, TP study report, or I can say local file. You have to maintain a local file in which all the transactions that you did as international transactions are recorded. That is very important. Sir, as a constituent entity of international group shall maintain a file, also master file we'll study later on. Whenever CIT asks for such file, you have to present that file within 10 days. You can seek for condonation for 30 days. Sir, study report must be maintained for international transaction if any kind of international transaction exceeds 1 CR. So any kind of international transaction that exceeds 1 CR, you have to maintain such transaction in local file, and you have to record that transaction, and whenever AO asks, you have to present that. Sir, how long you have to present? Sir, 8 years from the end of the relevant assessment year. You have to keep that file for at least 8 years. Sir, audit report. Sir, you have to require your books whenever you enter any international transaction or any kind of transaction that is covered under transfer pricing. For that matter, you have to get your books of accounts audited by a chartered accountant in Form 3CEB before 31st October before 31st October of the assessment year by chartered accountant. Sir, what are the penalties? Sir, penalties you can ignore. I have already uploaded video on penalty. It will take nearly, sir, 30 minutes. You'll remember all the penalties by heart. You can ignore these penalties. So country by country reporting. So before understanding country by country reporting, we have three structure plan. We have three structure plan as per BEPS for documentation and transfer pricing. Three structure plan. So what is this three structure plan? So you have to maintain a local file. So local file involves any kind of transaction that you have entered is entered into local file. Sir, we have master file. What master file implies? Master file implies any kind of detail of the entity. Sir, what business you do, what transaction you are entering, what kind of other entities are there in your group. These are the master file. And the CBC reporting. So CBC reporting, we have to study what CBC reporting says. For example, if we have a multinational entity that is into business into many countries, so not just one entry, but multinational. It is a part of multinational entity. For that matter, parent entity, parent entity of this multinational group is required to furnish CBC reporting. Sir, in the residence of in the state in which such parent entity is resident. What I'm saying, any kind of multinational group has a parent entity. Any multinational group has a parent entity. That parent entity has to submit CBC report to their respective state, respective country. Sir, what information they have to furnish? They have to furnish details of income tax paid in different countries, details of employees employed, and details of capital employed, details of profit before tax. These information are required to be furnished. This information is required to be furnished to their respective countries. Remember, India must have right to such information. For example, parent entity is in London, parent entity is in USA, for example. Now, if India wants information about that entity, India can simply ask the US government to furnish that information, and US government should furnish that information. Got this point? In case US government did not furnishes the information, then Indian government can force the Indian constituent entity to furnish such CBC reporting. Also, also, sir, if parent entity is in a country which does not follow CBC reporting, sir, in that case, Indian government can force Indian entity to furnish CBC reporting. Also, in case of systemic failure, sir, for example, we do have APA with that, we do have DTAA with that country. That DTAA prescribes for sharing of information, but when we asked for CBC reporting, that country denied to give any information. In that case, it is considered as systemic failure, and Indian government can compel the Indian entity to furnish CBC reporting within prescribed time. Read along with me. Sir, parent entity is resident of India, then Indian resident shall submit CBC reporting to joint director with in form 3C add within 12 months from the end of the relevant accounting year. So that means if any of the parent entities in India, for example, Infosys parent entity is in India. So for that matter, Infosys is required to file CBC reporting within 12 months from the end of the relevant accounting year. CBC reporting is mandatory only if consolidated group revenue exceeds 6400 CR. Consolidated group revenue 6400 CR or more. In that case, CBC reporting is important. Sir, exceeds 6400, not just 6400. Constituent entity of a multinational company is resident of India is required. Sir, for example, if any of the multinational company has a constituent resident in India. For example, any of the company, for example, Google has a resident Indian resident company. In that case, the government can force the resident country, that Indian constituent entity, to file CBC reporting if country of that parent entity does not have any obligation to have to get CBC reporting, or there is no information sharing agreement, or in case of systemic failure we asked for information but they denied to give information. In those cases, Indian government can force Indian constituent entity to furnish CBC reporting. Sir, what is the fees for non-filing of CBC reporting? Sir, for every day 5,000 rupees for a month, then thereafter, sir, 15,000 rupees beyond 1 month. And even if you did not file CBC reporting after receiving notice, in that case 50,000 rupees per day after notice. Sir, for submitting inaccurate information, rupees 5 lakh can be charged, and no penalty if there is reasonable cause of failure. Sir, what is master file? What does master file implies? Sir, master supply file implies list of all the entities of international group, their address, their legal status, ownership, and brief description of what they do. It is detailed. It is the biodata of the entities, all the group entities, all the constituent entities of the group. Sir, master file is required to be submitted by constituent entity resident of India up to the due date of ROI. So Indian entity has to furnish the master file every year up to the due date of ROI. Sir, master file is only applicable if consolidated revenue is exceeding 500 CR of the group. Or, sir, or listen, what it says. 500 CR is important. And sir, and what it says, either sir aggregate international transaction exceeds 50 CR, or sir intangible transaction enters 10 CR. Either of the two condition, sir, complied with 500 CR, then master file is important. So what it says, if international transaction entered by such entity exceeds 50 CR, or sir international intangible transaction, for example, purchase of goodwill, patent, copyright exceeds 10 CR, plus group revenue is 500 CR, if both these conditions are fulfilled, then in that case master file is important. Otherwise, master file is not important. Again, I am repeating, sir, aggregate international transaction in the accounting year exceeds 50 CR, or it says, sir, purchase of intangible exceeds 10 CR, so 50 CR or 10 CR. Any of this complied with 500 CR revenue, sir, if merging these two will only make you liable for master file. Otherwise, you are not liable for master file. So specified domestic transactions, a domestic transfer pricing. What it says, sir, if you are purchasing or selling goods to a closely connected group who takes deduction under section 80 IE or 80 IAC. For example, my entity is Rahul Limited. Rahul Limited has a startup which is eligible for 80 IAC. Sir, it has profit of 10 CR, it has profit of 1 CR. Sir, I diverted my whole profit to an entity which claims deduction under 80 IAC. So tax will be zero. In that case, sir, whatever transaction that Rahul is doing with his startup or any kind of associate enterprise, in that case, such transaction should be also done at arm's length price. So this was an example where one entity transfers its profits or sales goods or purchases goods to an entity which takes deduction under section 80 IA or 80 IA to 80 RRB. Sir, same provision applies if any of the entity closely connected person does transaction and one of them takes deduction under section 10AA. Or if any two of the closely connected person does any transaction and one of them pays tax under section 115 BAP, that is transaction at the rate 15, tax at the rate 15% on manufacturing income, or any kind of cooperative that pays tax at the rate 15%. So in those cases, so transfer pricing provision will apply if transaction value exceeds the 20 CR in a previous year. Domestic transfer pricing is only applicable if transaction value in financial year exceeds 20 CR. So same, sir, rules of valuation, sir, TPO, any kind of documentation, audit, everything will apply as it is for domestic transfer pricing also. Got this point or not? Sir, bonus stripping transactions, sir, simply understand this point. Sir, whenever company announces bonus, we have a record date. Record date implies the date on which you must have shares to get the bonus. Sir, for example, record date. If you bought bonus, sir, within a range of 3 months prior, if you bought if you bought shares within a range of 3 months prior, and you consequently sold within 9 months, or you bought shares within 3 months, and you sold the shares that you got in bonus within 9 months, then in that case, any loss arising shall be ignored. For example, listen this example. You have 200 shares. You bought 200 shares at rupees 500 each. What is the worth you have invested, sir? 1 lakh you have invested. Now you got bonus. These 200 shares got 300. Now this 200 shares got bonus of 100 shares, and this these 200 shares became 300. So sir, value will decline significantly. The price of these shares will also decline. So since there is 50% increase, sir, 50% price will decline. So price will nearly turn out to be 333. Don't ask why, but this is what the price will be. Okay. Now in that case, what if I sold this 100 shares? What if I sold these 100 shares? Sir, what will be sales price? Just listen. What will be the sales price? The sales price will be 333 into 100 is nothing but 33,000. 333,300. What will be the cost of acquisition of these shares? Sir, cost of acquisition. Sir, assume now cost of acquisition. What will be? Sorry, sir. If you sold original shares, sir. If you sold original shares, sir. For example, you sold original 200 shares. What will be the sales price? Sales consideration, sir. 666,600. What will be the cost of the original share? Cost of original share was nothing but 1 lakh, because you invested 1 lakh and you got 200 shares. In this case, you are incurring loss. So whatever loss you are incurring now will be ignored. Will not be allowed. Will not be allowed. It will be allowed when you further sell this bonus shares and incur any kind of gain. It will be allowed. So this loss can be carried forward. It will not be allowed. Simply got this point? That is the bottom line. Loss on such bonus cannot be set off. Rather, it becomes cost of acquisition for the bonus share. So this loss will not be allowed. But sir, this will be treated as cost of acquisition. Whatever loss that is being incurred will be treated as cost of acquisition for this bonus share. Any kind of any kind of gain that we get this from this bonus shares, you will get a reduction of cost of acquisition of such loss. The transaction with notified jurisdictional person. The central government of India may declare any of the entity as notified jurisdictional person, jurisdictional entity, or notified jurisdictional area. If any of the entity does not have effective information sharing agreement. For example, we want information, they are not allowing, so we can declare it as NJA. Sir, what will happen if any of the areas declared as NJA? Sir, all the transactions that you do with such entity located in NJA will be associated entities. All the transaction will be enterprise, associate enterprise, and any kind of transaction that you do, sir, should be at arm's length price. Got this point? Yes, sir, we did get this point. So all the provisions of transfer pricing will apply, sir, but one provision will not apply. Sir, we have understood, sir, transaction if done, sir, if transaction is done at 1,000, and sir, 3% variance we are getting, sir, 1,030 is allowed limit of doing the transactions. Sir, in this case, sir, range of 3% is not given. A range of 3% is also not allowed. Sir, if you are making any payment to person located in NJ, sir, you have to deduct TDS at the rate 30%. If you are receiving any fund from a person located in NJ, sir, you have to offer the source of that fund. If you are unable to offer the source of that fund, such income will be taxable. Such income will be treated as such incoming money will be treated as income in your hands. Got this point? Yes, sir, we did get this point. The limitation of interest. For example, if any of the Indian entity pays heavy interest to any of the associate enterprise, for that matter, there is limitation of payment of interest. So what is the limitation? What it says, if any Indian company or permanent establishment of a foreign company located in India pays debt or interest to any of the non-resident associate enterprise, so debt may be short term, long term, operating, financing, so they're relevant. Any kind of interest, any kind of finance charge that is incurring. Sir, any kind of excess interest would be disallowed. Sir, what is the excess interest? Sir, whatever interest you are making to associate enterprise, interest payment you are making to associate enterprise minus 30% of EBITDA, or sir, interest to associate enterprise, whichever is lower will be disallowed. So in short, I can say 30% of the EBITDA will be only allowed, rest everything will be disallowed. So 30% of EBITDA will be allowed, rest everything will be disallowed. In that case, you have to remember, sir, whatever is disallowed for this year can be carried forward for 8 years. That means, for example, if you are paying excess interest in this year, which got disallowed because of this limit, next year you are paying lower interest. So can you get deduction of the earlier disallowed interest? Right answer is you will be allowed to get. You will be allowed to get. For example, if this year, in current year, previous year 23-24, I paid interest of rupees 100 CR and allowed interest suppose is 80 CR. Can I say 20 CR is disallowed? Right answer is 20 CR is disallowed for this previous year. For previous year 24-25, what happens is, sir, I am allowed to pay interest of 100 CR. I am allowed to pay 100 CR. But how much did I pay? I did pay just 70 CR. I did pay only 70 CR. So can I say, wait, 30 CR I am paying short, I am paying 30 CR less. I am allowed 100 CR, but I am paying just 70. So can I say this deduction of 20 CR will be allowed to me? Right answer is 20 CR will be allowed to me, and sir, 90 CR will be interest expense for this year. Got this point? So there is question in MTP1. I have solved that MTP1 along with you in on YouTube. First question pertains to this topic only. So do watch out that MTP video also. Got this point? Yes, sir. Sir, what it says, sir, if any debt is given by third party, for example, this is Rahul. Sir, we have associate enterprise, but associate enterprise does not lend you money, did not lend you money. Sir, rather, sir, any third person gave you loan, but guarantee on such loan is given by associate enterprise. So any kind of payment made to such person will also be treated as payment to associate enterprise. Then limit will apply. Limit of 30% of EBITDA will apply. Remember, this condition will not apply in case where interest is paid up to 1 CR in a previous year. If you are making interest payment up to 1 CR in a year, then in this case, this provision will not apply. This provision of what? This provision of 30% will not apply. Or if you are making payment to any kind of NBFC or any kind of insurance company or any kind of banking company, then in that case, this provision will not apply. With that, your transfer pricing chapter is also over. Let us start with equalization levy. Very important chapter for your exam. Really very important. Complete international taxation is very important. Sir, for example, we have India, we have Boat India, and we have Spotify in US. Spotify, the songs you hear, Spotify. Sir, on hearing songs on Spotify, you hear ad of Boat. For that matter, Boat pays money to Spotify. And sir, such money is not taxable in India because Spotify does not have any kind of permanent establishment in India. For that matter, such money is not taxable in India. Now government want to tax such transaction. So what government did? Government asked both to deduct sir 6% equalization levy for making payment to Spotify USA. It is as good as TDS, but covered in the envelope of equalization levy. It is as good as TDS. Sir, any kind of payment that boat makes, boat has to deduct the 6% equalization levy on such transaction. Sir, what does equalization levy implies? Sir, first of all, it was introduced by BEPS Action Plan 1 Digital Economy. You have to remember this point. Sir, in Finance Act 2016, sir, one equalization levy was introduced. One equalization levy was introduced. Sir, it was Section 165. And sir, as per Finance Act 2020 to 2020, sir, another equalization levy was introduced. Sir, equalization levy on the e-commerce supply. Sir, first of all, Section 165. Whenever, sir, what it says, whenever Indian entity, sir, for example, it can be Indian entity, or it can be, sir, permanent establishment of a foreign company, sir, pays any kind of payment for advertisement to any kind of non-resident, if any of these entities make any kind of advertisement payment to non-resident, they are bound, sir, they are bound to deduct, sir, deduct word is important, otherwise you'll forget 6% equalization levy. They are bound to deduct 6% equalization levy. But sir, two things you have to remember, sir, that payment must be made for business purpose. That payment must be made for business purpose. And second thing, payment must exceed 1 CR. Sorry, the payment must exceed 1 lakh. So at least 1 lakh payment should be made in a financial year, below which you are not required to deduct equalization levy. Only above that amount you are required to pay. Sir, as soon as this Indian entity deducted the equalization levy, it is required to pay to government. So till when they are required to pay? They are required to pay till 7th of next month. Till 7th of next month, they are required to pay equalization levy. So in circumstances, in what cases equalization levy is not applicable? So if non-resident has permanent establishment in India and such non-resident is making if Indian entity is making payment to such permanent establishment of such non-resident, then in that case equalization levy will not be applicable, simply because that P is being taxed in India, so there is no need for equalization levy. So if payment is being made up to 1 lakh rupees in previous year, and third thing, if it is if it is not for business purpose, for example, this is Rahul, and Rahul pays to LinkedIn that I want job. I paid to LinkedIn rupees 2 lakh. For example, I paid to LinkedIn during the year to rupees 2 lakh rupees just to pop up my name into different CEOs for different CEOs so that I can get job. So for that matter, I paid 2 lakh rupees to LinkedIn. Do I require to pay equalization levy? And answer is no, I'm not required, because this is not business. This is not profession. So if I did not pay, if I did not pay equalization levy up to 7th of next month, what will be the interest, sir? What will be interest? Sir, it says penalty. For non-deduction, sir, if I did not deduct equalization levy, then non-deduction penalty will be amount equal to equalization levy. Amount equal to equalization levy. Along with that, sir, if I did not pay up to the due date, then 1,000 rupees per day. Sir, for non-deduction, amount equal to equalization levy. But for non-payment, 1,000 rupees per day, maximum to the equalization levy, sir, will be the penalty imposed. So no penalty if there is reasonable cause of failure. So what I said, in case of non-deduction, amount equal to equalization levy, and in case of non-payment, amount equal to 1,000 rupees per day will be charged as penalty. Sir, equalization levy under section 165A, this is removed from next finance act, but for that matter, they have also to study, they are also required to study, you are also required to study. For example, sir, in case of any e-commerce operator, what it says, in case of any e-commerce operator, sir, who is e-commerce operator? Sir, e-commerce operator is nothing but non-resident person who sells goods or services, or sir, who facilitates the selling of goods and services, who sell either himself or who facilitates such who facilitates such sales. That is the e-commerce operator. Sir, if e-commerce operator sold any goods to person resident of India, if he sold any goods to person resident of India, or such e-commerce operator sold any goods to any person who uses IP address of India, or sir, such e-commerce operator provide services to any non-resident, sir, any non-resident, sir, advertisement services that are effectively targeting the audience of India, in all those cases such e-commerce operator will be required to pay 2% equalization levy of the consideration. 2% of the consideration, 2% of the Indian consideration. Sir, what this third point implies, just tell now. Sir, what happens is, what there is e-commerce operator named Amazon. Sir, Amazon receives 5 lakh rupees from Mr. Rachel. Sorry, Miss Rachel. Miss Rachel pays 5 lakh rupees to Amazon to advertise in India, advertise her products, her hair products in India. Since this ad is targeting Indian audience, for that matter, any money received by such non-resident e-commerce operator will be taxable in India, and that e-commerce operator is required to pay 2% equalization levy to Indian government. Sir, the responsibility in this case is dependent upon the person receiving the consideration. This is of the nature of income tax. Earlier equalization levy we studied was of tedious nature, but this equalization levy is in the nature of income tax. In that case, in 165, the deductor, the person making payment, was required to deduct equalization levy and pay to government. But in this case, responsibility is given to the e-commerce operator that he has to pay 2% out of his own pocket. Got this point? Yes, sir, we did get this point. Sir, what if such e-commerce operator, for example, Amazon, has permanent establishment in India? Sir, you have to check whether he does any kind of supply via such permanent establishment. Then in that case, equalization levy is not applicable. But he does not supply through equalization levy, or sir, he does not have any kind of permanent establishment. In that case, equalization levy is applicable. But you have to remember that such e-commerce operator should have at least a 2 CR turnover from India. Then only such equalization levy is applicable. That e-commerce operator must be doing turnover of at least 2 CR, gross receipts of 2 CR from India, then only such equalization levy is applicable. Below that is not applicable. As soon as equalization levy, the sales is being made by the e-commerce operator, operator is required to pay such EL. Sir, what is the time limit for payment? Sir, for quarter ending June, sir, 7th July. For quarter ending September, sir, 7th October, sir, plus 7 days. Sir, plus quarter ending December, sir, plus January, sir, 7th January. So quarter ending March, sir, 31st March, sir, no addition, sir. Last day is the last day, and such e-commerce operator is required to pay equalization levy on the quarter ending date itself. Got this point? Yes, sir, we did get this point. The circumstances where equalization levy under section 165A, that e-commerce operator one, is not applicable. Sir, for example, if non-resident operator has permanent establishment in India, sir, for example, such non-resident operator has activities in India, in that case, sir, that PE will be charged to tax in India. Na? So no equalization levy applicable. Sir, if turnover is lesser than 2 CR, in that case, no equalization levy applicable. Sir, if equalization levy under section 165 is applicable, sir, for example, if a transaction is being entered and such transaction incurs both the equalization levy, in that case, section 165 equalization levy will prevail, and sir, payment maker is required to deduct 6% EL. Sir, if consideration is being made for services taxable under royalty FTS, in that case, sir, no equalization levy is required to be deducted. The equalization levy is imposed on those transactions that could not be taxed. Since royalty and FTS can be simply taxed as per DTAA, for that matter, any kind of services, any kind of payment of services that are covered under royalty or FTS is not required under equalization levy. Okay, sir. Or if any of the goods or services are being sold by resident operator via e-commerce operator. So for what this point says, for example, we have Rahul. Sir, Rahul sold goods via Alibaba to person resident of India. Sir, any kind of sale made to person resident of India is liable for equalization levy at the rate 2%. But since this income is already included in the income of Rahul, so no equalization levy is required to be paid by Mr. Alibaba because seller is in India. So it will be taxed in the hands of seller only. Sir, what if you did not pay equalization levy? What will happen? Sir, 1% per month delayed interest will be charged. And if you did not pay on time, amount equal to equalization levy will be levied upon you. Sir, these were two basic points. You need to understand the differences. If you do not know the differences, then you are bound to make mistakes. Sir, what this says, section 165 and 165A. 165 deals with advertisement related services and 165A deals with e-commerce related services. Sir, in this case, liability is upon the payment maker, that they have to deduct 6%. In this case, sir, liability is upon the e-commerce operator to pay 2% out of his own pocket. Sir, in this case, sir, on the payment maker, we have the limit. On the payment maker, we have the limit of 1 lakh. Below which, sir, he is not required to deduct any equalization levy, but above which he is required to deduct. But in this case, there is no limit on the recipient. The limit is upon the e-commerce operator. Sir, e-commerce operator, if does turnover greater than 2 CR, in that case, he is required to pay equalization levy. Otherwise, he is not required. Sir, due date of payment, sir, 7th of next month always. But sir, in this case, 7th of next quarter. But for last quarter, e-commerce operator is required to pay equalization levy on 30th of March only. The next point, sir, penalty. Sir, penalty is important. You are bound to make mistake in this penalty, remember. Sir, in this case, sir, since payment maker is required to deduct, so we'll have penalty for non-deduction and non-payment. Non-deduction and non-payment. For non-deduction, we have amount equal to equalization levy. And for non-payment, we have 1,000. But in this case, we do not have any kind of non-deduction because he's paying out of pockets now. So for that matter, we will have non-payment penalty, which will be equal to equalization levy. Just remember, section 165, non-payment, 1,000 rupees per day. Section 165A, non-payment, amount equal to equalization levy. That's it. Furnishing of statement. Sir, every SSC who makes payment under section 165A, 165, or any e-commerce operator who is required to pay equalization levy under section 165 is required to furnish a return under section form 1 up to 30th June of the immediately next financial year. Sir, what they are required to furnish, every kind of transaction that they have entered during the financial year, they have to mention that. Sir, any failure to furnish such return will be liable for 100 rupees per day penalty. But reasonable cause of failure, if there is reasonable cause of failure, there will be no penalty. Sir, even if you forgot to file return up to 30th June, then you can file up to 2 years from the end of the year. Sir, in case you file anything wrong in that return, then there will be a demand notice claiming interest and penalty and any kind of levy informed to. Sir, any kind of rectification in that demand can be made within 1 year from the end of the previous year in which mistake finding such intimation was served. What it says, sir, rectification for any mistake apparent from record can be made to assessing officer either by himself or brought to notice by the SSC within 1 year from the end of the financial year in which intimation stating such mistake was issued. Okay, sir, as soon as assessing officer issues such wrong statement, sir, within end of the 1 year from the end of that financial year, assessing officer can rectify such. Sir, if assessee is not satisfied with the order of the assessing officer, in that case, he can file appeal to CIT with 1,000 fees within 30 days from the receipt of the demand notice. Sir, if he is not satisfied with CIT, then he can file appeal to IT18 form number 4 with 1,000 fees within 60 days from the end of the receipt of the order. So 60 days from the receipt of the order of the CIT. If a person makes a failed statement or false statement or delivers any wrong information, then he shall be eligible, he shall be liable for imprisonment of 3 years along with fine. But sir, remember this fine is only applicable only when it is being approved by CCIT, not even PCIT, but CCIT. Sir, it is non-cognizable offense. That means you are required warranted to get arrested. Otherwise, you will not be arrested. Sir, in case you are required to deduct equalization levy, but you did not, so what will happen to that expenditure? Sir, that expenditure will be 100% disallowed. But in subsequent years, if you deduct and you paid out of your own pockets, sir, in that case, you will be allowed in that year in which you pay the equalization levy. Sir, important concept. Sir, what it says, sir, if any, in any case, sir, in any case, you are required to deduct equalization levy for any non-resident e-commerce non-resident advertisement maker. For example, boat was required to deduct equalization levy of Spotify, and boat deduct the 6% equalization levy. Then whatever income that boat is receiving will be exempt in hands in India. Such income will be exempt in India, and the such Spotify is not required to pay any further tax on such income. Okay, sir, no issue. Also, sir, what happens is any kind of e-commerce operator, for example, Alibaba paid 2% equalization levy, then any kind of income that is receiving from India will be exempt. Sir, remember, exempt. This point is for next financial year. You need to remember that this will be exempt. Got this, sir? This was all about equalization levy. This was all about equalization levy. Now, next concept is advance ruling. Sir, advance ruling implies, sir, ruling in advance. Ruling is nothing but orders. Sir, you want a judgment in advance. You are not able to understand any provision of income tax. You want some judgment in advance. You want the income tax authorities to interfere and tell you what the uh, actual procedure will be, what actual consequence will be. For that matter, you are seeking advance judgment from Board of Advance Ruling related to question, related to any fact, or related to any law. Okay, sir, no issue. Sir, it can be related to any transaction that is already undertaking, or it is transaction related to proposed transaction that you are about to enter. What will be the constitution of advanced ruling? Board of advanced rulings are two members, each of CIT level, CCIT level or above. The two members, each of CCIT or above level. So remember CCIT. So therefore, since we have CCIT or above level, so no appeal to ITAT is available. So appeal can be made directly to High Court. Remember, this point is very important because in most of the questions, sir, whenever they are asked for advanced ruling, they are asking what are the remedies available in case you are not satisfied with the order of the advanced ruling. Remember, we have only one or two advanced ruling per state. So for that matter, any kind of order that is being passed by the advanced ruling, if you are not satisfied with that, you can simply go to High Court. You are allowed to go to High Court. Nobody can stop you from going. Remember, that is the grievance available to you. You cannot go to ITT, but you can simply go to High Court. Sir, what application is to be furnished to get the advance ruling? For any non-resident who seeks any kind of advance ruling, any kind of judgment in advance, sir, for already undertaken transaction or transaction that is proposed to be undertaken, sir, he shall furnish Form 34C. Sir, any resident person who wants to enter into transaction with on behalf of non-resident, who wants to seek advance ruling on behalf of non-resident for any transaction that is already undertaken or any proposed to be undertaken, he can also seek advance ruling. Sir, any resident person to determine his tax liabilities, sir, for transaction already undertaken, sir, only if, sir, transaction value exceeds 100 CR. So this is very important. A non-resident is allowed to get advance ruling. A resident on behalf of non-resident is allowed to get advance ruling, but if only resident wants advance ruling, his transaction value should exceed 100 CR. Why, sir? Why 100 CR? Because otherwise everybody will ask na advance ruling. Everybody will seek advance ruling. So for that matter, this monetary limit is set for 100 CR or more. If any public sector undertaking wants any advance ruling, can it do so? Right answer is it can do so. Sir, important fact is even if its assessment is pending before ITAT, not High Court, sir. If assessment is pending before ITAT, it can still seek for any kind of advance ruling. Or, sir, any other person who thinks that any kind of arrangement that he is going to enter will be impermissible avoidance agreement, he can seek advance ruling. Remember, sir, he is anticipating that this transaction may turn out to be impermissible avoidance agreement. For that matter, he is seeking advance ruling. The application may be withdrawn within 30 days of the application. How much fees? Sir, for public sector entity, sir, 10,000 rupees. Sir, any kind of person who is seeking information regarding impermissible avoidance agreement, sir, in that case, 1,000, 10,000 rupees. Sir, for any other person, for example, any resident person, any non-resident person, or any resident person on behalf of non-resident person, what will be the fees? So this fees is being asked in MCQ. So you have to remember this fees. So for transaction up to 100 CR, Sir, up to transaction up to 100 CR. Sir, can transaction be up to 100 CR? For non-resident, it can be. The 2 lakh rupees fees. So transaction exceeding 100 CR but up to 300 CR, sir, fees of rupees 5 lakh. Or for transaction exceeding 300 CR, fees of rupees 10 lakh is required. Sir, form is to be digitally signed and ROI. The ROI is form is to be digital signed. If ROI is fine, ROI is what it is saying, sir. Whenever you are furnishing the form of advanced ruling, then that form has to be signed. Sir, when it is to be signed digitally, when the ROI of such entity is digitally signed. So normally every entity's ROI is digitally signed in these days. If it is liable for audit, its ROI is also digitally signed. In that case, it is required to get that form digitally signed and such otherwise communicated through email address. So you can leave this point. Procedure, what this procedure says, sir, board of advanced ruling shall forward an application to CIT PCI to ascertain whether case is pending or not. Sir, remember, whenever you want to seek advanced ruling, your case should not be pending at CIT or PCI or any kind of income tax authorities. You are not allowed to have any pending proceedings for that relevant assessment here, or for related topic you cannot have any kind of proceedings. Remember that proceedings cannot you cannot have any pending proceedings. But for any public sector undertaking, sir, it can have any proceedings pending up to ITAT. Sir, above that it cannot have any. Okay, sir. Sir, Board of Advanced Ruling shall reject the application in following cases. Sir, for it shall reject the application in following cases. In what cases, sir? In case of public sector undertaking, when question is already pending before High Court or Supreme Court. Sir, I told now, if case is pending at ITAT, it is allowed for PSUs. But if it is pending at High Court, Supreme Court, why advanced ruling will interfere? Ignore. Sir, if case is already pending at CIT, Joint Commissioner, ITAT, High Court, Supreme Court for any other SSC, sir, advanced ruling will reject the application. Sir, if question involves determination of FMV of the value property. If you want to know the FMV of the value, go to transfer pricing officer, go to valuation officer. Why you want this? Why you want advanced ruling? And sir, if transaction is designed for avoidance of tax, sir, if transaction is aim to aim for avoidance of tax, in that case, advanced ruling will not be given. But in one case, advanced ruling will be given. Sir, for example, if a person is asking by himself that whether the transaction will be impermissible avoidance agreement or not. So normally, in case transaction is aiming at impermissible avoidance agreement, so no advanced ruling is allowed. But if person is wanting to know whether impermissible avoidance agreement is applying or not, in that case, advanced ruling will be allowed. Sir, Board of Advanced Ruling will pronounce its ruling within 6 months from the date of the receipt of the application. Any kind of ruling shall be copied to forwarded to CIT, PCIT. Also, sir, whenever application is being made by PSU, then IT authority or ITAT shall stop there itself and wait for for Board of Advanced Ruling to pass the final order. So, in case advanced ruling is being obtained by a fraud, misrepresentation, then Board of Advanced Ruling may declare such ruling as void ab initio, and provision of this act will apply as if they were never applied to assess. Last point, sir, what are the powers of board? Sir, this is important because this was asked many times. Sir, any kind of discovery, they can discover or do inspection, compel production of books of accounts, enforcement, attendance, and examination of oath and issuing summons. These are four classic examples. As good as powers of the civil code, Board of Advanced Ruling is also empowered with powers. Sir, if Board of Advanced Ruling compels assessee to furnish books of accounts despite of the fact that proceedings are not pending, or despite of the fact that information is not relevant for pronouncement of that advanced ruling, sir, assessee is bound to furnish information because Board of Advanced Ruling has power as civil court. It has powers of a civil court. Sir, if you want to go to appeal, if you want to go for appeal against the order of the advanced ruling, you can go to High Court only or Supreme Court within 60 days. 60 days is important. Otherwise, you are required to get a file, you are required to file appeal within 120 days. But in this case, only 60 days time limit is given, and additional 30 days if you are doing any delay. Other points. Sir, what if, sir, sir, what if you asked for certain case? You ask for certain case whether this case is taxable or not. Sir, you ask for this case. Now later on you got to know that there is another case. You also want to seek advance ruling for that also. Can you seek in that same application? Right answer is no, you cannot seek. You cannot seek for same application. If you want extra ruling, sir, for example, you want extra coriander with all these vegetables that you buy, so you cannot ask extra question once you have filed the application. Whatever questions that have been asked will be answered. No additional questions will be entertained. And sir, last important, during the course of the proceedings, bar may require applicant to submit additional facts to enable it to pronounce advanced ruling. Sir, bar may require at any point of time bar may require the SSC to furnish additional informations. Got this point or not? So now we can move to DTAA. So DTAA is important topic. We are just doing the concept portion of that. Question answers you have to solve. You have to solve. And one question was in RTP November 24. You have to solve that question. So that question involves partial integration. Along with that, too many concepts of DTAA. Also, you have to solve one question from RTP May 24 also, which involved taxation, which involves relief in case of section 90. ICI is never tested relief under section 90. That is why it is relevant. So double taxation avoidance agreement. So simply calculation of relief, I need to make you remember what it says. Section 90, 91, what it says. Sir, if any of the entities does not have any kind of DTAA with India, for example, country X, our classic example. So country X does not have any kind of DTAA India. Sir, if any of the if any of the person of India, person resident of India, paid taxes in that country, and such income is also taxable in India, so he will be allowed credit of taxes paid in that country in India. Any kind of taxes that have already been paid in that country, India will be allowing credit on such taxes paid. Sir, how credit will be allowed? How much will be allowed? Just focus. Sir, if all the conditions are fulfilled, then relief under section 91 is allowed. The SSC must be resident of India in that previous year. Important. The income must be earned outside India, tax is already paid, and sir, no DTAA should exist. Sir, SSC must have paid taxes in that country. There should be no DTAA between those countries. And sir, last thing is in DTAA should not subsist between those two countries. Sir, how much relief? Sir, relief you have to calculate. Sir, remember. Sir, for example, compute the total income. Compute the net total income in India. Sir, for computing net total income, you have to consider Indian income along with that foreign income. And sir, you have to apply the Indian tax laws in calculating the income. Sir, if foreign income is earned, for example, any kind of rent is received in foreign country, they do not have any concept of 30% deduction. They do not have any concept of municipal taxes. But if in India, if such municipal taxes are deductible, you have to reduce those municipal taxes. You have to take 30%. Sir, you have to consider the Indian tax laws for calculating NTI. After that, calculating NTI, you have to calculate the tax payable in India, and with that, you have to calculate the average rate of tax in India. You got what average tax per rupee is being charged in India. You got average rate of tax. Okay, sir. Along with that, sir, you want foreign tax rate. Sir, what is the rate of tax that SSC has paid in that country? The foreign rate of tax can be, sir, it can be directly 20%, can be directly 15%, or it can be in slab form. It can be in the slab form, or it can be given like dividend income is taxable at 20%, interest at 10%, other income at 15%. Then you have to find average rate in that country also. You will arrive at foreign rate. You will arrive at foreign. Now you have average rate of tax in India and you have foreign rate. You have arrived at two things. Sir, you have to compare, sir, average rate of tax or foreign rate of tax. So you have to take whichever is lower. And this rate you have to apply on doubly tax income. Doubly tax income. Sir, what is doubly tax income? Sir, the income that is taxable in both the countries. Sir, remember, read along with me. The income that is taxable in both the countries. Sir, for example, rent received in USA, sorry, rent received in country X 3 lakh. But after deduction of municipal taxes and standard deduction, rent taxable in India is 2 lakh rupees only. Sir, can I say this 2 lakh rupees is doubly taxed because 2 lakhs is taxable in India and 2 lakhs is taxable in country X also? Because this is taxed in both the countries, so doubly tax income is this, and you have to consider doubly tax income multiplied by lower of foreign tax or average rate of taxes. Sir, for example, we have royalty. Royalty in country X is taxable at rupees 10 lakh. It is taxable 10 lakh of 10 lakh is royalty is taxable in US, country X. But whenever that royalty is received in India, any kind of expenditure incurred or royalty is allowed. For example, expenditure incurred is 2 lakhs. So royalty is 8 lakh taxable. And that 8 lakh royalty is still not taxable completely because you receive deduction under section 80 QQB. So complete royalty taxable is 5 lakh rupees. For that matter, W tax income will be 5 lakh. Okay, sir, got this point. Sir, any kind of business laws that is not allowed in that country. Assume for the time being that business laws is not allowed in that country. But in this case, In our country, you are being allowed business loss. So what will be doubly tax income? Sir, in India, you have to consider business after considering business loss. So for example, listen, we have country income in country X of rupees 20 lakh, and that same income is taxable in India as 20 lakh. But we have business loss in that country of rupees 4 lakh. Sir, business loss is not allowed. Sir, but in India, business loss is allowed. So what will be doubly tax income? Just remember, sir, in that case, in that country, income of 20 lakh is taxable. But in India, we are taxing only 16 lakh. Now we are giving deduction of that 4 lakh. So in that case, doubly tax income will be 4 lakh. In that case, deduction of 4 lakh losses will be allowed in India. Got this point or not? Yes, sir, we did get this point. This question has been this concept is completely tested in RTP. You have to solve that question. RTP November 24 DTAA question that is also covered in Super 80 questions that you can also refer. As soon as you do this, so you will get this answer. The foreign tax laws are irrelevant for calculating total income in India. Along with that, if multiple rates are given, then you have to convert it into single foreign rate. And sir, you have to calculate separate calculation. For example, you are having income from country X, Y, Z. Sir, for country X, you have to calculate separate foreign tax rate. For country Y, you have to calculate foreign tax rate. For country Z, you have to calculate separate foreign tax rate. Along with that, you have to calculate doubly tax income for every country. So three things are very important. Sir, average rate of tax payable in India, foreign tax rate in that country, and doubly tax income. You have to identify these three things. You will never make any mistake in this question. Sir, come to starting what it says. So double taxation, what it implies? So taxing same income in two hands. Taxing same income in two hands. Sir, what it implies? So taxing same income in the hands of two person. For example, if I am a resident of India and earning any income in USA, the USA says because of source rule it is taxable there, but because I am a resident of India, it should be taxable in India. So for that matter, Indian government wants to tax the same income again. In that case, it is considered as double taxation. To avoid that double taxation, we have double taxation relief. Relief is of two types. First relief is unilateral relief, in which we have no DTAA. For example, in country X, somebody earns any income and pays taxes thereon, and India does not have any kind of DTAA, but such income is also taxable in India. So for that matter, India will give relief to such income under Section 91, as we have calculated, as we have understood how income is calculated, how relief is calculated. But for relief under Section 90, what it says. Sir, if such income is taxable in that country, India has to give relief. Either do not consider it into total income of India or give credit of such income. What it says. So for example, royalty. France and India. We have country France and India. Any kind of royalty that is earned by resident of India in France. Resident of India but earned royalty in France. Sir, as per India DTAA, it says, sir, any kind of source rule has right to tax royalty. So in that case, sir, France will have right to royalty. Right to royalty. In that case, sir, whatever taxes that have been paid in France, for that matter, India has to either exempt such income, exempt such royalty income. For that matter, what will happen? So such royalty income will not become part of total income. But India may opt, India may opt to do things differently. India can want such income to be part of total income, can want such income to be part of tax payable, and can give tax credit or relief under Section 90. How relief under Section 90 is calculated? So there is different method in this case. What this method says, sir, whatever the tax have been paid in that country, whatever the amount of taxes that have been paid in that country on such income, not doubly tax income, I'm saying. Not doubly tax income. Sir, whatever taxes that have been paid in that country, you have to compare the taxes paid on such income in India. For that matter, what you have to do, sir, you have to again consider doubly tax income into average rate of taxes in India will give you taxes paid in India. Taxes paid in India. Or I can say simply not doubly tax income, sir, income tax in India. Income tax in India into average rate of tax in India, it will be taxes paid in India. And in that country, you have to calculate the amount of tax payable and you have to compare the actual tax payable. You don't have to consider doubly tax income multiplied by average tax rate. No, you do not have to do. In this case, you have to find out the tax payable on such foreign income in India and tax payable on such foreign income in that country, and you have to compare the lower of two, and you will be allowed exemption. You will be allowed credit of the lower of two. Sir, will answer remain same in both the cases under Section 1991? Right answer is answer will be different. In most of the cases, answer will be different because of doubly tax income. Because of doubly tax income, answer will be different. So, for example, what happens is, just understand this point and most of the things will get clear. For example, we have royalty. Royalty. The royalty, you earn royalty, for example, 20 lakh rupees. Such royalty is taxable in that country at the rate 10%. For example, 10% turns out to be 2 lakh. You paid taxes in that country at rupees 2 lakh. Okay, sir, you got this point. So this royalty when came to India became taxable at the rate 20%. Sir, expenses, for example, 5 lakhs are incurred and 3 lakh 80 QQB is allowed, sir. 80 QQB is allowed 3 lakh. Sir, income turned out to be 12 lakh rupees. For example, in India, such income is taxable at the rate 25%. So 25% tax rate will be nothing but 2.4 lakh. So this is the amount of tax that is payable in India. Got it, sir? No problem. The average rate of tax, if I'm considering in India, it is nothing but 25%. And foreign tax rate, if I'm considering, it is nothing but 10%. Whatever relief will be allowed in India, just tell me what relief will be allowed in India. So I am comparing actual rate of tax with foreign tax multiplied by the doubly tax income. What is doubly tax income? In foreign country, I am taxing 12, 20 lakh. But into India, I am just taxing 12 lakh rupees only. So for that matter, doubly tax income will be 12 lakh only. And you are allowing rebate of 12 lakh into 10% is nothing but, sir, 1.2 lakh rebate I am getting under section 90, under section 91. Do you get this point? How did I calculate the relief under section 91? This is the simple method. So lower of average rate of tax multiplied by doubly tax income. So doubly tax income is 12 lakh. Lower of 2 is nothing but, sir, 10%. Okay, sir, no issue whatsoever. Sir, but if this were section 90, what would have been? Sir, taxes paid in India. The taxes paid in India on royalty is nothing but, sir, 2.4 CR. Taxes paid in US is, the taxes paid in that country. The taxes paid in that country is nothing but, sir, 2 lakh. Sir, you have to compare the lower of two. For that matter, in what relief will be allowed? Sir, in this case, relief will be allowed to 2 CR. And you are, sorry, relief will be allowed to 2 CR. And your actual tax payable in India will be 40 lakh only. This is the difference because of doubly tax income. At this point, sir, in section 90, you have to compare the actual taxes payable. And under section 91, you have to compare the rates multiplied by doubly tax income. Got this point? So this concept was really important. So there is question named Mahesh. I guess this was the question was starting from Mahesh only. You have to solve that question. You have to solve that question. Otherwise you might miss something. Okay, sir. I'm just focusing on concepts here. Question taking will take time. That may be dependent upon your speed. For that matter, I want you to solve that question on your end. Okay, sir. Got this point. The double taxation avoidance agreement, sir. To avoid double taxation, every country, matlab different countries across the globe come together to have DTAA. Sir, what is the reason for what is the purpose of having that DTAA? For exchange of information, for recovery of taxes, or for granting relief in case of double taxation and creating without creating opportunity of non-taxation. Sir, we want to grant relief for double taxation and we want to avoid double non-taxation. For that matter, we are having DTAA, double taxation avoidance agreement. Remember, the provision of DTAA and Income Tax Act, whichever are more beneficial to the SSC, will always apply. For example, sir, DTAA says 10%, Income Tax Act say 20%. So what will be the tax rate? Sir, both whichever is more beneficial will apply. For example, sir, business income is taxable at the rate 40% as per. Sir, business income is taxable at the rate 40%. But DTAA says business income will not be taxable if you do not have any PE. Business income will not be taxable if you do not have any permanent establishment. So whatever beneficial will be applied. Sir, if any kind of business income is taxable at the rate 40% in India, but DAA prescribes for 20%. In that case, sir, higher rate will apply. What I am saying, sir, in case of tax rate for foreign country, what I am saying is tax rate for foreign company can never be said as less advantageous. Normally, whichever is beneficial will apply. Whichever is beneficial for assessee will apply. But tax rate for foreign company is an exception. If India prescribes a higher tax rates for such foreign companies, despite of the fact that DTAA provides for lesser tax rates, but still that foreign company will be required to pay tax as per income tax laws. At this point, which implies, sir, tax payable can never be considered as less advantageous. Okay, sir. Then we have section 90. You can ignore this point. So terms mentioned in DTAA. Sir, if you want to know the meaning of terms mentioned in DTAA, nothing but take meaning given in DTAA. If it is not given in DTAA, take meanings given in Income Tax Act. If they are not given in both of the Act or DTAA, then you can take the different pronouncements, different notifications, or in different kind of meanings, different kind of judgments you can take. Sir, another point is permanent establishments or any kind of branch, office, place, warehouse, factory, outlet, or any kind of natural extraction resource is also considered as permanent establishment. Non-resident may outsource certain services of the entity, but it may not constitute business connection between the two entity in India. Then it shall not be have any PE. So, for example, if any non-resident has outsourced certain works in India, and it does not consider any kind of business connection, will that be considered as permanent establishment? Right answer is it will not be considered. For example, many of the companies in USA have outsourced their call centers in India. So can I say that call centers constitute permanent establishment? Right answer is they do not constitute any kind of permanent establishment. They do not have any kind of business connection in India. So any kind of business connection established will be considered as permanent establishment. Okay, sir, no issue. Independent agents are not considered as permanent establishment. So, for example, if Rahul is a person who provides services to different people, for example, I provide services to different people. We have studied a business connection in our taxation. If Rahul provides services to Rachel, to Monica, to any different type of persons independently, I am not dependent on anybody and I do not provide services to any one person. I am providing services independently to everybody. So, can I say I will be any kind of permanent establishment? Right answer is I will not be considered. Sir, profit of any permanent establishment shall be computed as per arm's length price. So any kind of disproportionate expenditure given to such any kind of permanent establishment will not be allowed. Sir, it will be considered as per arm's length price only. Then only expenditure will be allowed. This was all about DAA. Now we can simply move to next chapter. We can have a break of 2 minutes and we can continue later on. We'll just start with model tax conventions and later on we'll proceed with tax treaties and followed by base erosion and profit shifting. Chapters are easy, but chapters are trickier a bit. Easy as in these are scoring smaller topics, but for that matter, you have to remember too much of things. So we'll try to sum it up quickly. We'll continue after 2 minutes. Okay, so welcome back from break. I hope you all are back from your break. Now we are about to start three very important chapters that are basic base erosion profit shifting, model tax conventions, and tax treaties interpretation. Sir, one question you will see from in exam, at least from these three chapters, one question is being tested. So the volume that these chapters carry is not justified for one question. So for that matter, we have to be very reasonable enough in studying these topics. There might be possibility that you may not understand a few terms, but logic says leave those topics. Unless that question has been tested in exam or that question is really very important, if you did not understand, you can leave it simply. But whatever you remember, you should be able to reproduce that in exam. Okay, sir. I will try to make a logical connection between different chapters so that you may be able to memorize it well. For that matter, let us recall first the DTAA. Sir, what we have studied in DTAA, sir, we have studied that it is agreement between two countries. Sir, how we will avoid double taxation? Sir, but we did not understand how DTAA will be drafted. If I am making an agreement with France, if India is making an agreement with France, how much clauses will it have? If India is making DTAA with any other country, say Germany, how much clauses will it have? Which clause will be speaking about what? So this will become very hectic. If India is making DTAA with 150 countries, 180 countries, India has 180 DTAAs. Similarly, different countries in the world have their own DTAA. So everybody has to refer different DTAAs, different clauses, n number of clauses, and so what? So many. For that matter, there was a need to rationalize things. There was a need to fix a format on which DTAA will be prepared. This format we'll be studying in this topic. Whenever I say model tax convention, you have to remember, sir, model means role model. Role model implies the way it should be. And tax convention implies, sir, first of all, understand, sir, tax conventions is nothing but tax treaties is nothing but DTAA. How DTAA will be defined, how tax convention will be designed, how tax treaties will be designed, all things we will be studying in this topic. So for that matter, we have two types of models in prevalence these days. Sir, first one is OECD model. Sir, OECD model, what does OECD model says? Sir, OECD model is the format of DTAA between two developed nations. Sir, whenever a developed nation enters into DTAA with other nation, for example, France enters with Japan. These are two developed nations. So they will be following OECD model. Sir, whenever a developing nation enters into DTAA with a developing nation, or a developing nation enters into DTAA with developed nation, or a developed nation enters into DTAA with developing nation, in all these three cases, they will follow UN model. Sir, what are the difference? Sir, OECD model has 32 articles and UN model has 31 articles. Sir, almost all the articles are same. You need not to worry about that. We'll study in detail. Also, sir, remember, sir, UN model focuses on residence rule of taxation. Wherever you are resident, that resident state has right to tax. Whereas in UN models, a right to tax is in source rule. Wherever you are earning, the country in which you are earning should have right to tax. Whereas in some cases, UN model also compromises, and UN model says resident school or resident state should also have right to tax. So for that matter, sir, OECD focuses on residence rule, sir, but UN model focuses on source rule. But sir, in some cases, it also focuses on residence rule also. At this point, and there is another model which normally is not in your CA final curriculum, sir. It is US model. Sir, what US model states, whenever any country enters into WTAA with USA, United States of America, in that case, those countries will be following US model. Sir, not relevant for exam because this has never been asked. Sir, first of all, should be title. Sir, what should be the title? Sir, every DTAA shall be convention between two states for elimination of double taxation and prevention of tax evasion and tax avoidance. This is the title of every DTAA. For example, France and India entered into DTAA for elimination of double taxation and double taxation on income and prevention of tax evasion. This should be the title of every DTAA. Sir, what should be preamble? So this convention is for avoidance of double taxation and treaty shopping. Sir, what treaty shopping is? Sir, taking advantages of a treaty to avoid tax. Taking advantage of the treaty, diverting your income to that country to use to reduce your tax liabilities overall. So preamble should be, this convention is for avoidance. This convention is for avoidance of double taxation and treaty shopping. Do you have to remember any of these? Right answer is you don't have to remember. You can leave these points, but you have to remember, sir, you have to remember this point, that OECD model is between developed countries and UN model is between developing and developed countries. Sir, it focuses on residence rule and focuses on source rule. This is what you have to remember. Sir, article 1, what it says? Sir, this treaty is applicable to the person resident of both of the contracting states. Sir, for example, if Rahul is the resident of India and Rahul enters any of the transaction with France, so DTAA with India and France will apply to Rahul. At this point, the treaty shall apply to the person who is resident to one of the state or both of the contracting state. So, for example, if I am resident of India and I enter into contract with France, I enter into any transaction with France. So, for that matter, so India France DTAA will become active. If I am the resident of France, then in that case, again France India DTAA will come into play. And if I am resident of both the countries, then to this DTAA will enter. So, fiscally transparent entity, you can leave this point for this point for your exam. Sir, what are the taxes covered? Article 2 will speak about taxes covered. In every DTAA, Article 2 will speak about taxes covered. So this contention shall apply to taxes that are on income, that are on capital, and that are on capital appreciation. Any kind of income tax, any kind of capital tax is nothing but capital gain tax. And sir, capital appreciation like wealth tax, it is not in India, but it convention may speak about wealth tax, how wealth tax will be taxed in different countries. Sir, it also shall state that even if after certain time the name of taxes change, or any new tax is being introduced by whatever name called, but it names at taxing income, in that case this DTAA will also apply to that new law also. For example, India introduces a new law called property law prohibition of black property law, which aims at taxing the income that has escaped assessment. The intention of this act is just to tax the unescaped income, untaxed income. For that matter, this DTAA will also apply to that act also. Any new act that has come into force, which has an intention of taxing income, capital, or capital appreciation, will also be covered in this DTAA. We don't have clause number 3. Now clause number 4. Sir, who is the resident? Sir, on whom this provision will apply? How will you decide who is the resident? Sir, for that matter, every model states Every model states, sir, you have to find out residential status as per their domestic laws. For example, we have India, France, DTAA. How will you determine that person is resident of India or person is resident of France? For that matter, you have to check the tax laws of India and you have to check the tax laws of the France. If he becomes resident of India, then DTAA will apply. If he becomes resident of France, then DTAA will apply. Sir, what if he becomes resident of both the countries? So this is important question. You have to remember this. If he becomes residents of both the countries, then a tiebreaker rule will apply. You have to check, sir, what is his permanent place of where his permanent place of home is. Sir, he shall be resident of the country of his permanent home. Wherever his permanent home is, that will be his place of residence. Sir, what if he has permanent home in both the countries? Sir, for that matter, you have to check, sir, in which of the country he has personal and economic relation close. For example, he continues business on day-to-day basis. He had Samajik activities, sir. He has cultural activities in which countries? In social inclusion, in which countries he has? So for that matter, you have to check where is economic and personal relations close. In that country, he will become resident. What if he has equal economic interest and personal interest in both the countries? For that matter, you have to check his habitual abode. Where habitually he stays. For example, he stays 300 days in India and 65 days in France. So for that matter, he shall be resident of India. But what if he stays equally? His habitual abode is in both the countries. Then you have to check in which country he has nationality. If he is national of both the countries, then what you have to do? Then competent authority of both the countries shall come together and decide where his residential status would lie. So what is tiebreaker rule? Sir, read along with me. So what is tiebreaker rule? Read along with me. So first of all, you have to check where his permanent home is. Sir, if permanent home is in both the countries, you have to check where his personal interest is. Sir, if personal interest is in both the countries, then you have to check where his habitual abode is. Sir, normally where he stays. If he normally stays in both the countries, then you have to check in which country he is national. In which country's nationality he holds. If he is national of both the countries, then you have to check. So we have to compel the competent authorities to sit together and decide his residential status. For other than individuals, a competent authority may decide together on the basis of concept of poem, on the basis of concept of residential status or as per domestic tax laws, that competent authorities will decide. Then we have concept of permanent establishment. Sir, any kind of fixed place of business through which an enterprise carries out business is nothing but permanent establishment. So first of all, there has to be a fixed place. Then second thing, sir, it has to be a part of enterprise. Third thing, sir, it should be used to carry out business wholly or partly. First of all, fixed place is important. Second thing, it should be a part of organization. And third one, it should constitute, sir, it should that place should constitute any business. That means any kind of business should be originating from that place. That fixed place will constitute permanent establishment. Sir, what can be a permanent establishment? For example, a branch, a office, a factory, a workshop, any kind of mine, or any kind of, sir, building, site construction, installation projects will also be considered as permanent establishment. This is the basic definition. Any fixed place of business is permanent establishment. But for that matter, you have to see. Sir, for that matter, you have to see any kind of building, any kind of site will be considered as permanent establishment under OECD model if it is for more than 12 months. If any kind of site is under construction, and that under construction is being going on for 12 months, more than 12 months, then only such site will be considered as permanent establishment. Otherwise, it will not be considered. And for UN model, how much time it is? Sir, 6 months. If any site construction is pending for 6 months or it is undergoing for 6 months or more, in that case, such site will become permanent establishment. Otherwise, it will not become. So for OECD model, 12 months. For UN model, it is 6 months. You have to remember the difference. If this difference is significant, you have to remember this difference. Sir, also, UN model also prescribes for service PE, whereby furnishing of the services by an enterprise through an employee or professional for 183 days shall also constitute PE. For example, in India, we require technical manpower, and the technical manpower is being imported by another company, say you Google USA. Google USA, technical manpower is being employed from there. Some of the IT professionals came and taught India how to do things. For that matter, stay of such IT professional, if increased by, if it is more than 183 days, if stay of such IT professionals is more than 183 days in India, for that matter, such income arising from IT professionals will also be taxable in India because such employees will also constitute permanent establishment in India. And this concept is only applicable in UN model. This is not applicable in OECD model. So what I said, any kind of professionals that come to India and they stay for 183 days or more, they stay for more than 183 days in fiscal year, then any income arising from that service or professionals will also constitute permanent establishment and shall be taxable in India. So also this concept is only available in UN model. It is not an OECD model. Then we have, sir, both OECD model and UN model, sir, targets activities by the dependent agent should also constitute P. Sir, what it is saying? Just give me a second. Sir, what it is saying, just focus here. So, for example, this is Miss Rachel. Miss Rachel has a dependent agent named Mr. Rahul in India. Mr. Rahul is in India. Can I say this constitute business connection? Because, sir, if Rahul habitually contracts for Miss Rachel, secures order and places delivery and maintains the stock, in that case, Rahul will become business connection for Miss Rachel. It is clear. This is very much clear. Sir, both UN model and OECD model also says the same thing, that even if any of the non-resident has any kind of dependent agent in the other state, then in that case activities of such dependent agent will also constitute permanent establishment, and any income arising from such dependent agent will be taxable in India, will be taxable, will be will be considered permanent establishment. Also, sir, insurance collecting enterprise shall also constitute permanent establishment as per UN model. For example, there is an entity in South Africa called South African Insurance Limited. Sir, it offers insurance at a very cheaper rate and it is collecting insurance from India. It does not have any kind of permanent establishment in India, but it is yet collecting insurance from India. Sir, can I say that insurance company will have permanent establishment in India? Right answer is yes, it will constitute PE, as insurance collecting enterprise will also constitute PE in India in UN model. If this contract is between two developing countries or developed developing countries, sir, insurance collecting enterprise shall be bound to have any kind of permanent establishment if it is collecting insurance as per UN model. Sir, remember, permanent establishment shall not include, sir, any fixed place of business for collecting information. For example, if any of the company like news collecting agency named BBC has an office in India just for collection of information from India, will it constitute permanent establishment? Right answer is no. If any foreign company has advertisement banners in India, will it constitute permanent establishment? Right answer is no. Sir, any kind of website is in India, sir, website is available for every company. So will that website constitute permanent establishment? Right answer is no. But if any server of that website is located in India, then that server will constitute permanent establishment. Any kind of independent agent will not constitute for permanent establishment. For example, Rahul not only works for Rachel, but it also works for Mr. Ross. He also works for Mr. Joey. He also works for Mr. Chandler. So in those cases, sir, if he is an independent agent, he shall not constitute permanent establishment, or any kind of associate subsidiary shall not constitute permanent establishment unless business is being originating from that entity. Then next one is business profit. Sir, how business profit will be taxed? This provision says that, so profit shall be taxed in resident state only. This is the thumb rule. Profit shall be taxed in resident state only. But sir, remember, source state can also tax the profit of permanent establishment in the store state, that too to the extent of the profit of the P. What it is saying, just focus here. Sir, sir, for example, USA has an entity, sir, whose permanent establishment is in India. So whatever earning this permanent establishment is making from India, as per source rule, this should be taxable in India. So this is only this point is saying this only, that India can tax profits of this permanent establishment to the extent the profits are being made by this establishment only. India cannot tax profits of entity as a whole. It can only tax the profits of that respective permanent establishment only as per source rule. And rest all the profits will be taxable as per resident rule. Got this point? Now we have a force of attraction rule. So remember this point. This point may come in exam for 2 marks. What it says. So for example, there is company called Tesla. And there is also permanent establishment, or I can say showroom of Tesla. Showroom can be a permanent establishment, showroom of Tesla. Now, if anybody wants to buy a car from Tesla, he can directly visit showroom. He can directly visit showroom. But sir, as soon as he went to showroom, he placed order with showroom. Sir, complete transaction is being made by Tesla USA. This this permanent establishment was capable of fulfilling the order, but this order was not fulfilled by showroom, it was fulfilled by Tesla USA. Sir, can I say that this is the income of permanent establishment, or the income of or the income of a foreign company or a non-resident person? For that matter, force of attraction rule will apply. What this says, under UN model, sir, if any of the entity has permanent establishment in India and that permanent establishment is capable of fulfilling order, but order is being fulfilled by some of the person outside India, then in that case, sir, to the extent the order could have been fulfilled by this, would be considered as taxable in India, would be considered as, sir, business profit in India. If the sale is being made by Tesla USA and this Tesla India was capable of fulfilling such order, then income of this Tesla USA will be considered as income of India. This is force of attraction rule. This is only prevalent in UN model. This is not prevalent in UK OECD model. Got this point? Yes, sir, we did get this. Sir, interest income. Sir, interest, first of all, meaning of interest is very important. Sir, meaning of interest is important. Sir, what it says, any kind of income on the debt claims. Income of every kind on debt claims. On debt claims, income of every kind is interest. Sir, whether such debt is secured or not secured, sir, you have given that money with security or not, that is not relevant. Even by giving that money, you are getting any rights and profits or not, sir, that is irrelevant. Sir, whatever income that you are giving on any kind of debt claims, any kind of debt that you are giving, any kind of income on such debt as interest. Sir, got that. Got this. Sir, residence state has a right to tax interest, but in some cases, source can also tax interest. The normally resident state has right to tax interest, but in some cases, source rule can also tax the interest. Sir, what it says, sir, OECD, as per OECD model, sir, interest cannot be taxed in source rule exceeding 10%. Sir, for example, what this says, for example, France pays interest to Germany. Sir, if both the countries are following OECD model, then in that case, sir, whatever interest that France is paying shall be taxable in France. Sir, it cannot be exceeding 10% because and as per OECD model, tax rate in source rule cannot exceed 10%. Sir, but as per UN model, you have to remember, sir, it cannot be exceeding specified percentage. Sir, what is specified percentage? That two countries may decide together. That two countries may decide. So, for example, if India is entering any DTAA with France, India is entering DTAA with any kind of country, France. It is following, sir, which model, sir? UN model it is following. Sir, India can tax interest, sir, at the rate specified in the agreement. Sir, what is that specified rate that India and France together may decide? Okay, sir, we did get this point. Sir, what is the taxation of royalty? Sir, as per UN model, royalty will be taxed. Sir, as per UN model, royalty will be taxed as per source and residence rule, but source cannot tax more than specified percentage. Normally, source and resident will have a compromise, and sir, source cannot tax exceeding the specified percentage. But in OECD model, sir, exclusive right for taxing royalty is with resident rule only. But sir, same for FTS, sir, UN model, under UN model, sir, source and resident will have compromise, but sir, source cannot tax more than specified percentage. Sir, OECD model says nothing about FTS, but sir, resident only can tax such FTS. Source state cannot tax under OECD model. Sir, what does royalty means? It is important. Royalty means it is important. Sir, what does royalty means? Listen. So first of all, right to use any tangible and intangible assets, right to use any kind of tangible, intangible asset is royalty. First of all, this is the basic thumb rule. Right to use, the right to use is important for any tangible or intangible constitutes royalty. Okay, sir, no issue. Sir, OECD model includes the following from the royalty. As per UN model, right to use any tangible, intangible is royalty. As per UN model, also same. OECD model also same. But in OECD model, we have two additions. What it says, rental of film tapes used for radio and television. So whatever the film or television that used to premiere earlier, we used to have a film tapes for that. Any kind of rental payment for such film tapes will also constitute royalty, and any kind of equipment for rentals for industrial, commercial, and scientific purpose. If anybody is paying any kind of rental equipment, rent on equipment for commercial, industrial, or any kind of scientific work, then in that case, such rental payment will also constitute royalty. Sir, FTS fees for technical services, nothing but MTC. You have to remember FTS with MTC, sir. What MTC implies: managerial, technical, and consultancy fees. Any kind of payment you are making for managerial purpose, or for a technical purpose, or for consultancy purpose, it shall constitute FTS. Simple. Sir, capital gain you can ignore. Sir, capital gain, it is just saying that it can be exclusively capital gain can be exclusively taxed in resident state. But sir, if immovable property is related in source state, then source state may also tax such capital gain. That is the basic rule it is saying. Sir, independent personal services, sir, using you only UN model has independent personal service. Only UN model says about this point. What this says, if any professional services, if income from any professional services shall be taxable in the resident state, however, sir, source can also tax it. For example, what it says, I want to know how to use camera. I want to know how to use camera. For that matter, I ask a IT professional to come to India, teach me how to use camera, and then just go back to China. For that matter, if that professional stays in India for 183 days or more, stays in India for 183 days or more, so it is but obvious he'll become resident, so his income will be taxable in India. It is but obvious. Sir, but what if he provides me services online? What if he provides me services online? What if he provides me services online? Sir, what you have to do in that case, sir, services will be taxable, sir, if sir, only if person has fixed place of business in source state or he stays in source state for 183 days or more, sir, in that case, sir, it is saying it will not be taxable. If he's providing services online, sir, it will not be taxable as per DTAA. As per income tax act, yes, you can tax it. As per DTAA, you cannot tax it. So whichever is beneficial will apply. In that case, taxability will not arise. Sir, for taxing such person, you need to have a fixed place of business in India, or he should have come to India for 183 days. At least 183 days he must have come to India. Then only such income can be taxed under DTAA. Got this point? Got this point? Professional services shall be taxable in resident state only. However, tax if source state, source state may tax if person has fixed base in source state or he stays in source state exceeding 183 days. So other income, OECD model simply says resident rule only. UN model says source plus resident, whatever the compromise you want to make. So important points are elimination of double taxation. Sir, we have studied this in DTAA. If any of the country has DTAA, any income that is already taxed in source state, that should not be taxable in the resident state again. For that matter, what resident state can do, it can either exempt such income while calculation of total income, or it can give tax credit. Sir, what tax credit it gives? Sir, we have studied tax rebate under section 90. That tax credit it can give, for that matter, we need not to stretch this topic. Exemption methods: a resident state may completely exempt such doubly taxed income or tax credit. It shall first make it taxable and then calculate tax and correspondingly give credit for such taxes. So non-discrimination, there should be no discrimination between resident and non-resident. Completely senseless point. You can leave this. Sir, mutual agreement procedure. Sir, two of the competent authorities have to sit together to settle the dispute. Sir, we have already studied this mutual agreement procedure where we could not decide the residential status of any entity. Article 3, sir, Article 4, sorry, Article 4, sir, where there was tiebreaker rule, we had fifth point. If because of four things, we could not decide what the residential status will be. In that case, competent authorities will come together, have a mutual agreement procedure, and decide its residential status. Similarly, any kind of dispute that occur between two entities, between two states, that dispute will be settled through mutual agreement procedure, and how that mutual agreement procedure will proceed will be discussed in Article 25. Sir, Article 26, what it says, exchange of information. This was asked in May 24. It is less likely to ask, but you may know what the point is. Sir, for example, our Vijay Mallya fled from India and is staying in London. Now we want his information. Whatever property he has, we should have effective information exchange system. For that matter, every DTAA Article 26 shall communicate about how information will be exchanged. Sir, why that information exchange is important? Sir, to avoid cross-border tax evasion and avoidance. So simple thing is cross-border tax evasion should be restricted and tax avoidance should be restricted. That is the essence of having any kind of information exchange system. Also, scope is not limited for taxpayer also, but it can also for tax administration or better compliance. Even we can ask information for better compliance purpose. That is also allowed. But sir, remember, sir, DTAA should also mention that contracting state have no obligation. Sir, what no obligation? Sir, what if we are asking information that is not obtainable for UK government? We asked for the property of Vijay Mallya, which even UK government cannot find out. Sir, is it under any obligation? Is UK government under any obligation to provide any information which is not obtainable? Right answer is no, but that should be mentioned in DTAA. Also, sir, if for example, India entered into DTAA with USA and India wanted to know the technical know-how of producing Coca-Cola. Sir, is UK government bound to tell that? Right answer is no. If it relates to any kind of secrecy, if it relates to any kind of technical know-how or any kind of disclosure of trade or business, in that case, that government has no obligation to exchange any information. And third point says supply information contrary to public policy. So, for example, any kind of information that we are asking is contrary to public policy, that can cause any harm to public policy, then in that case, that information will not be shared by that entity. And non-disclosure of information or to third party, this should also be a part of DTAA, that whenever we are having any exchange of information, that exchange of information should not be communicated to third party. So we should have non-disclosure, that information should not be disclosed to any other third person. This was all about base erosion and this was all about model tax conventions. Now we have tax treaties, and model tax conventions was easy. Tax treaties is a bit technical. You can simply remember only those points that I am telling you. Rest you can leave. Rest you can simply leave. Source of international law, source of interpretation actually. So these are the things from where how we interpret the law. First of all, sir, interpretation tool is DTAA. Sir, first of all, we have to take the protocols given in DTAA or any kind of memorandum forming part of DTAA or any kind of exchange of information clause that is in DTAA that can be used as source of interpretation. So second thing, customary international practices. So for example, there has been a judicial pronouncement. There has been a judicial judgment decision that has taken place in an international arbitration or any of the renowned countries. That judgment can be used for interpretation. And third one is Vienna Convention law of treaties. So it was a multilateral treaty. Many of the countries, sir, more than 115 countries came together and signed the multilateral treaty for interpretation of tax treaties. So these are the sources of interpretation of tax laws. So what are tax laws? It is nothing but a written agreement governed by international law, whether single agreement or multiple instruments are irrelevant. Definition, treaty, word is not relevant. But type of DTAA is important. So type of DTAA is important. So first of all is limited DTAA and second one is comprehensive DTAA. Limited DTAA, for example, India, Pakistan DTAA. Only a few information, few provisions will be covered. Out of 32 clauses, only few clauses will be covered. So but comprehensive DTAA covers all the incomes. Every type of income will be covered. So these are two types of DTAA. So remember, there are two exemptions available in DTAA and two types of DTAA. You have to understand the difference. You have to understand the difference. You cannot simply just write tax exemption method and tax credit method in case you are being asked types of DTAA. Got it, sir? Sir, also directive principles, you can cut this point. Sir, need for treaty, sir, it is important question. Why do we need a tax treaty? Why do we need a tax treaty? It is important, sir, to allocate the taxing right and allocation of elimination of double taxation. Why tax treaty is important, sir? As the name suggested, DTAA, double taxation avoidance is required. For that matter, we require DTAA. Second thing, sir, non-discrimination of resident and non-resident. Sir, for some cases, there should not be discrimination between resident and non-resident. For that matter, treaty is important. Sir, resolution of any dispute, for example, there is dispute between two countries for taxing rights, then in that case, treaty becomes relevant. Sir, providing assistance in collection of taxes, the tax collection becomes easy because of treaty. There will be no dispute. Sir, equity and fairness, sir, same rate for different taxpayers. Sir, neutrality and equity. What it says, sir, export neutrality and import neutrality. For example, person exporting from India should be indifferent in the country in which he exports. For example, he is exporting in USA. He should have equal right to export in Spain also. There should not be any difference because of certain import duties, because of certain taxing rights. He should not be export partial. He should be export neutral. Along with that, he should have import neutrality. So from whichever countries he is willing to buy, he should be able to buy without any issue. There should be no partiality on the grounds that custom duty on certain countries is very high. So for that matter, DTAA should also focus on neutrality, that is export neutrality and import neutrality. So and also last point is promotion of economic relation and trade investment. Sir, what 7 points I have told? Sir, 7 points, just repeat after me. So first of all, avoidance of elimination of double taxation. Second thing is non-discrimination between resident and non-resident. Third thing is resolution of disputes. Fourth one is assistance in collection of tax. Fifth one is export import neutrality. Seventh one is equity and fairness, and last one is I forgot one. Last one is promotion of economic relation and investments. You are given 7 points. If you are being asked to write the importance of treaty, if you are being asked need for treaty or importance of treaty, you just have to quote any six, any four. If you are quoting, you will be getting 4 marks. So you must remember this point. You cannot think of leaving this topic. Sir, interpretation of tax treaties, how treaty will be interpreted. Sir, just remember there is a golden rule. Sir, rule implies objective interpretation. Sir, word and term treated in the treaty should be used objectively and literal meaning. Sir, objectively you have to interpret and literal meaning you have to interpret. You have to objectively read treaty and sir literal interpretation you have to say. If treaty says this will be taxed at 10%, that means this should be taxed at 10%. So this is the golden rule. Take treaty literally. Okay, take treaty literally. Okay, sir. Second thing, subjective interpretation. Sometimes subjective interpretation is also important. Sir, it should be interpreted according to the common intentions of the contracting party at the time of treaty conclusion. Sir, for example, treaty was concluded way back in 1970s. And treaty intended to tax certain transactions which are not even relevant, but related transactions are relevant today. So for that matter, we have to catch the intention of the treaty makers at the conclusion of the treaty and apply that treaty in today's sense. That is what subjective interpretation implies. Sir, purposive interpretation, it implies that aim of treaty should be achieved. Sir, for example, by applying treaty, there comes a situation where we have double taxation or where comes a situation of double non-taxation. So for that matter, purpose of treaty is defeated. So you have to apply or you have to interpret treaty in such a way that purpose of treaty is completely fulfilled. Sir, principle of effectiveness. Sir, what it says, sir, it should be interpreted in a manner so that it should be effective and not void. Sir, for example, if treaty says taxing nothing, or if treaty is saying something which makes treaty as a void, if treaty itself says that do not follow treaty, then you don't have to interpret in that way. You have to find out the purposive effectiveness. You have to find out the effectiveness in that treaty. What I'm saying is, meaning of interpreting treaty should not make any void meaning. Meaning of interpretation of treaty should not make any void. Sir, principle of contemporanea exposito. Contemporanea exposito. Just repeat after me. Contemporanea exposito. Contemporanea exposito. What does this imply? Contemporanea exposito. Sir, you have to understand the meaning of those words that were used at the time of conclusion of treaty. Sir, for example, in olden times, a word was used called asharfia. Asharfia implied golden coins. For example, asharfia in today's data dollar or rupees, 1,000 rupees note, 500 rupee note. These are asharfia today. So if any of the treaty says a word asharfia which is not relevant, which was used in olden times because they were relevant then back then, but today we don't have any asharfi, we have just currency notes. So that asharfi word should be interpreted as currency note in today's sense. This is what contemporanea exposito implies. Meaning of the term shall be taken at the time of conclusion of the treaty. That means if meaning of asharfi is not applicable today, but asharfi was applicable when the treaty was signed, but right now it implies currency note, so treaty should be applied to currency note. This is what the contemporanea exposito implies. You might think that this is not making too much of sense, but that is what it is. Example is vague, I know, but sense is this only. Sir, liberal interpretation, sometimes what happens is when you are reading he shall do this. Sir, many a times we find that he only implies male, but you have to take liberal interpretation, and liberal interpretation says that he includes a he includes she. Whenever a word he is mentioned in a paragraph, it also implies female person also in while applying any law. So for that matter, you have to be liberal at sometimes. So use treaty as a whole. Treaty as a whole. Many a times when you are reading treaty as a part, you might not understand something. So for that matter, interpretation of the treaty requires reading treaty as a whole. Along with that, sir, you have to see the reasonable and consistency. Sir, it should a consistent meaning should be taken. For example, if you are finding out the meaning of a term used in some other sense in one paragraph and used in another sense in another paragraph, don't do that. You have to find the consistent meaning of that term and use it accordingly in the whole treaty. So these are the basic laws of interpretation of treaties. Relevant or not, sir, golden rule is relevant. Sir, contemporanea exposito is important. The rest you can leave. Sir, extrinsic aids to treaty. Sir, what are the extrinsic aid? If you want to understand treaty, how can you understand treaty? What are the extrinsic rules? Sir, for that matter, we have 7 or 8 points which can help you to read treaty. First of all, sir, foreign court judgments, sir, for example, a case has been pending or a case has been pronounced in foreign court, which helps you to interpret any treaty, so you can use that. Sir, mutual agreement procedure. For example, there is doubt in taxing India and France person. Person resident in India and a person resident in France. And there has already been a judgment on there has been a mutual agreement procedure between India and France. Then you can refer that mutual agreement procedure. Second thing, sir, preamble. Preamble implies the front page of the treaty. Sir, like we have preamble for Constitution of India. We, India, a sovereign country, we have a preamble related to that integrity, and we have many things I don't remember, but sir, we have preamble of India. Similarly, preamble is the front page which tells the essence of the treaty in a few lines, so that preamble can also be used for interpretation to find out the essence of the treaty. Sir, international articles publications, for example, any international articles relating to any kind of taxation laws is being published, so that can also be used for interpretation. Sir, any other treaties, for example, if you want to understand the meaning of India France DTAA, you can understand by Russia or Spain treaty. You can use that treaty also. Sir, any kind of consequent conduct of the parties. Sir, for example, treaty was concluded back in 1970s. Example, and a conduct has been occurred on in 1980s. There was a case, similar case pending, or similar case to our case has already occurred in 1980s. So you can also refer that case. Along with that's a different agreement between the parties regarding information. For example, we have any agreement with France that whenever we'll be having any issue, this is how we are going to solve that. You can do, or you can say interpretive protocols. Protocols is nothing but annexure. So Sandarbha Suchi, many a time what happens is in most of the books you are being given references from where such paragraphs are being taken. In many of the books you read, at the last 4 or 5 pages, you are being given references of which books from where the data has been taken. Many of the times a reference is given. For that matter, a protocol that are called protocol, you can refer those protocol to find out the reference, and for that matter interpretation of treaty becomes effective. So you can use resolution or committee reports. There are many committee reports that you can refer. These are the extrinsic aids that you can use. Just remember, we have nearly 8 extrinsic aids. You need to remember just 6. First of all, protocol. Second is preamble. These are very basic. So protocol, resolutions, or committee reports. Like second is preamble. These are very important. So foreign court judgments, mutual agreement procedure. We have international international articles, or we have subsequent conducts of the party. These 6 or 7 you need to remember. You will be given full marks if you are able to quote 6. So protocol nothing implies supplementary to the treaty, that is an integral part of the treaty and must be referred to arrive the conclusion. Sir, it has binding effect. The way DTAA has binding effect, same as protocol has also binding effect. Sir, preamble implies the beginning of the treaty. Annexed to the beginning of the treaty, it is an integral part of the treaty and helps in guiding the tax treaties. Sir, MFN clause, you need not to remember all this, but you need to remember what I am saying. What you need to remember, I am saying. Sir, for example, India is a part of most favored nations. Sir, for example, most favored nations are India. Sir, for example, China. Sir, for example, Russia. Sir, for example, France. Sir, I am just giving an arbitrary example. Do not say that these are not the part of MFN. Okay, France and Spain. Okay, we have most favored nation clause. Sir, signed on 1st April 2021. Example, it is arbitrary example. Whatever tax rate for royalty between India and China will be 10%. India and Russia will be 10%. Sir, every clause, every country in the most favored nation clause, royalty will be charged 10% only. For example, out of nowhere, India entered into DTAA with Mauritius. Mauritius on Sir 1st 4 2022, and in DTAA it mentions taxing the royalty at 5%. Sir, now these remaining nations came together argument that how can you tax somebody else at a lower rate and not us? We are most favored ones. We are your most favored ones. How can you tax other person at a lower rate than ours? How can you do that? For that matter, the other most favored nation clause can also enjoy the lower tax rate. Can also enjoy the lower tax rate for this point. But sir, this provision is not applicable in 2 or 3 cases. Sir, listen. Sir, what if this provision with Mauritius was entered way before India became a part of most favored nation clause? Sir, in that case, it will not be eligible. It will not, sir. In this case, most favored nation countries will not then get benefit of this lower clause. also. Sir, what if this rate is higher? Sir, in that case, no benefit will be allowed. In that case, no benefit will be allowed. Sir, just read after me what it says. Clarifies the applicability of MFN clause and beneficial of lower or restricted rate in the slab rate shall imply. Okay. The second treaty with the third state is entered after signing in the treaty. Sir, these are the conditions. Sir, in under what conditions most MFN nations will get the benefit of lower tax rate? Sir, again, I am taking the example. Sir, under what conditions these MFN countries will get advantage of a lower tax rate? Sir, this says second treaty is entered after the first treaty. Sir, second treaty, that means India Mauritius treaty is entered after entering the MFN clause. Second treaty is second treaty is entered between India and a state which is a member of OECD at the time of signing the treaty. The second country is Mauritius. The second country is in second agreement with second country is entered later on, and it was also a part of OECD. Third point is India should limit its rights in taxing that country. So India has limited its rights in taxing DTAA in taxing royalty with Mauritius. So if all the three conditions are complied, then in that case, the remaining countries of the most favored nations will also get the benefit of lower tax rate. And separate notification has been issued by India importing the benefits of the second treaty. This you can leave. So if all the conditions are satisfied, in that case, all the countries that are part of most favored nations will get benefit of this lower tax rate. So static and ambulatory approach. What this implies? So these are approach. These are approach. Sir, what it implies? Sir, look at the meaning at the time when treaty was signed. Sir, for example, there is a word given in treaty you are not able to understand. Sir, you can refer the meaning that was prevalent at the time treaty was signed. That is the static approach of looking the treaty historically. But second thing is ambulatory approach, sir. It implies looking at the meaning at the time of application of treaty. Looking at the meaning at the time of application of treaty. Whenever you are applying that treaty, understand the meaning of that. That is the ambulatory approach. So this is important, sir. Yes, this is important. Vienna Convention law of treaty. Important point. Important point. Very important point, sir. What is the pacta sunt servanda? Sir, cut this sunt, right? Sunt. It is sunt servanda. Sir, remember. Sir, treaty is binding upon the parties and must be followed in good faith. Sir, pacta sunt servanda. There is also another term we remembered. Sir, contemporaneous expositio. Treaty must be interpreted liberally. Sorry, treaty must be interpreted at the time of the conclusion of the treaty. Okay, you have to remember, you have to understand the terms at the time at which the treaty was signed. You have to consider those terms also. Pacta sunt servanda is second different thing we studied today is nothing but treaty should be interpreted in good faith. This is important. Pacta sunt servanda is being asked a few times for 2 months. Second thing, so Vienna Convention law of treaty, what it says, it lays down certain guidelines for interpretation of treaties. First of all is pacta sunt servanda, which implies it must be followed in good faith. Any treaty that you are interpreting must be interpreted in good faith. Okay, got it. Internal laws and observance of treaties. You can leave this point. So non-retroactivity of the treaty. So treaty cannot be applied retrospectively. For example, there is treaty between India and France, which aims at taxing royalty at the rate 10%. Now, later on, India and France amended treaty retrospectively to tax the royalty at the rate 30%. Can it do so? Right answer is no, it cannot do so. Okay, sir, no issue. So, territorial scope of the treaty. Treaty is binding in the territories, entire territories. For example, there is India and France DTAA. So, whatever the territory of India is and whatever the territory of France is, any person lying in that territory, treaty will be binding on such person. And last one is so general rule of interpretation. How generally these treaties are being interpreted. So these are as good as extrinsic aids, but there are certain differences. What it says, sir, it should be treated in good faith. It should be interpreted in good faith. Second thing, it should a treaty interpreted must comprise preamble annexures also. So preamble also you should be reading, or annexures also you should be reading for interpretation. Any subsequent practices that have been taken place after conclusion of treaty, any kind of agreement that parties have made, any kind of subsequent practice or application, or any kind of relevant rules you have to refer for interpreting the treaty. These are the general rules. So this has been asked a few times. Sir, what is the general rule of interpretation as per Vienna Convention law of treaty? So first of all, you have to remember treaty must be interpreted in good faith. Then second thing is subsequent agreement between the parties and subsequent practices by the parties. Subsequent agreement after the conduct of the treaty. conclusion of the treaty, and subsequent practices of the parties after signing of the treaty. These are three things. Then other relevant laws, you have to remember the preamble and annexure, and sir, other relevant laws. If you write, you will get full marks in this case. The supplementary meaning of treaty, sir. Whenever after interpreting all the things, meaning of treaty turns out to be ambiguous. What to do in that case? You have to leave the unreasonable meaning and you have to take the supplementary meaning. Find out the another meaning of those words and use that. Do not use those words which make treaty ambiguous. Do not interpret treaty in an ambiguous way. Try to find out the meanings, even though supplementary meanings. Try to find out the meanings that make better sense of that treaty. The interpretation of the treaty is being authenticated in two or more languages. Sir, remember, sir, if there is treaty between India and France, there might be possibility that treaty can be authenticated in other languages also. For example, in India, treaty is in English, but can that treaty be in Hindi? Right answer is it can be Hindi. Sir, for that matter, it has to be authenticated in Hindi. Sir, it has to be properly checked and it has to be authenticated by the person in France also. Also, version of treaty in other language shall be considered authentic if remember terms of treaty shall be presumed to have same meaning. Sir, English treaty and Hindi treaty will have in Hindi treaty will only be authentic if meanings given in English treaty are same in Hindi. Difference in meaning, then meaning shall meet objective and purpose of the treaty. So, for example, there is any difference in meanings in Hindi and English, for that matter, Hindi treaty will be considered as void. The general rule regarding third state, so no right of the third state, no obligation of the third state. For example, there is treaty between India and France. Sir, is there any right and obligation on behalf of USA? Right answer is no. There is no right or no obligation of the third state regarding a single treaty. Sir, validity and continuance in force of the parties. Sir, it is treaty's provision. You can leave this. Sir, termination, suspension. Simple. You have to remember, if there is any kind of supervening impossibility, or there is possibility that treaty can never be performed, or there's possibility that there is change in law. Sir, anything that you think might cause impossibility on the ground of performance of treaty, in that case treaty will become void. For example, there has been substantial changes in tax laws globally, treaty will become void. Sir, for example, there is a supervening impossibility because of which you cannot apply treaty. Sir, for example, you want to tax somebody and somebody died, how can you apply treaty? You cannot find his legal rights, how can you apply treaty? For that matter, treaty will become void in those cases. Void for those person, it will become void for those cases. So, for example, there is material breach, for example, repudiation of treaty by convention or violation of any essential provision. In that case, what will happen? Treaty suspension of the operations of the treaty in case of breach. So, supervening impossibility, suspend treaty. Fundamental change in circumstances in treaty will become impossible. Also, sir, emergence of new international form, treaty will become void. This is how things will go in case of. This is how things will go in case of interpretation of treaty. Sir, what are important points? I have already made you marked what are important points. Even, sir, important questions are given. Sir, for example, this question was important. Vienna Convention law of treaty was important. So I have given important question here. You have to refer this a day before exam. You can refer this video also. Whatever you remember, you just have to spit it out in your paper and just get marks. As simple as it can be. So last topic is base erosion and profit shifting. This topic is more technical, so I request you not to do PhD in this topic, but sidewise also focus on what the essence is. Focus on what the essence is. Sir, base erosion, profit shifting refers to tax planning strategies that conflict. Sir, just remember what I'm saying, sir. What example is? Sir, for example, we have multinational entity. Sir, multinational entity has branch in India and it has also branch in Mauritius. Sir, so India has 30% tax rate, Mauritius has 1% tax rate. So what happens in this case? So this MNE can transfer its profits from India to Mauritius to take the advantage of the lower tax rate. This multinational entity can plan its activities in such a way that profit of high tax jurisdiction is being disappeared to low tax jurisdiction. Did you get this point or not? Yes, sir, we did get this point. There is no issue whatsoever. BEPS refers to tax planning strategy that exploit gaps and mismatches in the tax rules to make profit disappear and shift to location where there is no tax loss. So simply transferring your profits from high tax paying jurisdiction to low tax paying jurisdiction or no tax paying jurisdictions. This is nothing but base erosion and shifting of profit. What are the adverse effect of BEPS? So what will happen if any multinational entity does base erosion? What will happen? Sir, it will cause four issues. What are those four issues? Sir, government has to cope up with less revenue and higher admin costs. Sir, in this case, what happens? Sir, Indian government is getting no taxes in India from this foreign multinational entity. Sir, what is happening? Sir, government is having lower tax plus higher admin costs. Now you have to do the assessment of this entity. You have to send intimation. You have to process the return. You are requiring him to file the return. So there is administration cost involved. So government has to cope up with higher administration costs and lesser revenue. Also, sir, underfunding of enterprises since government is getting lesser revenue. Sir, in public enterprises, PSUs are getting underfunded. You can transfer lesser money to PSUs. Also, sir, what happens is, sir, it undermines the integrity of tax system. Sir, an entity which is registered in India, for example, Reliance, it is completely an Indian entity and it is paying 30% tax rate, but this foreign entity is paying lesser tax rate in India because it is making its profit disappear. So it is undermining the integrity of the tax system. And fourth point, it says it hampers local competition. So, for example, if any multinational entity is paying lesser taxes, it is making more profits, and because of which it is able to dump its product at a cheaper prices, and Indian market will not be able to produce such products at such lower prices. So, for that matter, competition is also hampered. So, there are four adverse effects of such base erosion and profit shifting. First of all, is government has lesser revenue and has to cope up with higher admin costs. Second thing, sir, what happens? Second thing happen is underfunding of public enterprises. Third thing, what happen is, sir, integrity of tax laws is being undermined, and fourth one is nothing but local competition is threatened in this case. Case competition. Okay. For that matter, sir, OECD has recommended 15 action plans. Sir, 15 action plans are being recommended, sir, on three pillars. Sir, you don't have to remember these three pillars. Sir, what are 15 action plans? Sir, first action plan is challenging the addresses of the digital economy. Sir, because of digitization, many a times foreign entity does not have any permanent establishment in India. And because of those permanent establishment, we are not able to track the transaction. We are not able to tax such entity, and we are not able to tax many other transactions. How to address that? Sir, for example, Google in India never paid taxes for many years. So how can we tax that entity? For that matter, OECD has given certain recommendations. So what were the issues prevalent in that case for which action plan 1 came in? So difficulty in characterizing payment, characterizing transaction, difficulty in locating the transaction and taxpayer, and old permanent establishment rules were ineffective. So there were three issues. First of all, sir, characterizing nature of payment. Second thing, locating transaction was difficult, and third one is permanent establishment rules were ineffective. Okay. Sir, what were the OECD's recommendation? Sir, OECD gave two recommendations. OECD gave three recommendations. Sir, recommendations are important. Sir, what OECD said? Sir, dematerialize activities. Sir, modify the permanent establishment rules, and dematerialize activities should also constitute PE. Sir, for example, if any entity has website in India, that website should also constitute PE. Second thing, sir, virtual place of business. Sir, virtual place of business. For example, if you are not able to make that website as permanent establishment, at least make servers of those website if kept in India as permanent establishment. If any of the company has their servers parked in India and operating via those servers, so make those servers permanent establishments or virtual fixed place of business. And third one, OECD said, is imposition of withholding taxes. Whenever any foreign company wants to take the payment outside India, they should bypass some withholding taxes. India should withhold some money and keep it with itself. And last one is, sir, equalization levy. That was imposition of equalization levy. Any kind of foreign payment that is being made, it should bypass equalization levy. It should at least follow equalization levy. Equalization levy should be deducted on such payments. So, sir, what OECD recommended? Sir, OECD recommended, sir, existing rules should be modified to address the digital activities. Second thing, sir, virtual fixed place of business should be decided. And third thing is imposition of withholding taxes and equalization levy. Sir, what India did on this regard? Sir, India made available two concepts. India brought two concepts. Sir, what were those two concepts? Sir, India brought significant economic presence and equalization levy. Sir, virtual fixed place of business and modifying existing rules. Sir, what India brought? India brought significant economic presence. Sir, if you remember section 9, Subsection 1, sir, clause 1, sir, says any kind of business connection, if established, will be taxable in India. Sir, how business connection will be established? One case was business connection via agent. Second case was business connection via significant economic presence. Sir, how significant economic presence was established? Sir, if any foreign company is providing its services in India, and sir, it has turnover greater than 2 CR, or sir, greater than 3 lakh downloads, in that case, any kind of activities that it does and earns revenue shall be subject to significant economic presence and will be considered as business connection and will be taxable in India. This is what significant economic presence was involved, brought, and equalization levy was imposed. Section plan 2, sir, hybrid mismatch arrangement. Sir, what hybrid mismatch arrangement is? Just focus on the example what I am saying. So for example, this is country X and country Y. Country X is an entity, for example, Rahul Private Limited, and it has Shweta Private Limited. Shweta Private Limited. Sir, these two are nothing but, sir, 100% parent or subsidiary, 100% parent subsidiary, 100% holding subsidiary. For tax laws of country X, sir, parent subsidiary, any kind of payment that you make to your subsidiary is nothing but dividend. Any kind of payment that you make, any kind of payment that you make to your subsidiary is interest. Any kind of payment that you make to entity is interest. So for example, it paid interest. Any kind of payment you make is interest. For that matter, sir, the interest is always deductible. So in country X, Rahul did not pay any tax, deductible. But for country Y, sir, any kind of money that you receive from your parent company is nothing but dividend. Any kind of money that you receive from your parent company is nothing but dividend. So for that matter, dividend is exempt in this country. So these are arbitrary examples, but there might be certain loopholes. If you want to find out, there you will be able to find out certain loopholes in some or the other treaties. So I'm just giving you example, hybrid mismatch arrangement. So for example, the same transaction is non-taxable in this country or deductible in this country because, sir, it is treated as interest. But same transaction is treated as dividend in another country and it is exempt because it is dividend. Dividend income is exempt in that country. For that matter, sir, any transaction being made is non-taxable in both the countries. There is a chance of double non-taxation. There is chance of double non-taxation. This is called hybrid mismatch arrangement. Sir, a kind of arrangement where there is mismatch in the treatment of single items in different cases. Sir, how can you do hybrid mismatch arrangements? How can you do hybrid mismatch arrangements? Sir, for that matter, we have four steps, four ways of doing hybrid mismatch arrangement, or four ways of doing double non-taxation. Sir, how can you do hybrid mismatch arrangement? Sir, first one is creation of two deduction for single borrowers. Sir, for single borrower, like I said, any kind of interest deduction, and for other it is dividend. In that case, sir, deduction of two deduction for single borrower. So taking deductions without corresponding income inclusion. So this can also lead to hybrid mismatch arrangement. So misusing of foreign tax credit, even if you are not eligible for foreign tax credit, you tried to use that because of treaty shopping. And last one is participating in exemption regimes. So you are not eligible for exemption, but you took the exemption. And this is not just because you are avoiding tax. So it is not because you are evading tax, sir. You are avoiding tax. In case of tax avoidance, you are doing, sir, if you are doing any of the four of things, it will be considered as hybrid mismatch arrangement. Hybrid mismatch arrangement. So this question is important for exam. This question is really very important for exam. So four things can lead to hybrid mismatch arrangements. Sir, what are those? The creation of double deduction for single borrower, taking advantage without corresponding income, taking deduction without including corresponding income. Second thing, the third thing is misusing foreign tax rate and participating in exemption regimes. Sir, what OECD recommended? OECD recommended amend tax laws to neutralize hybrid mismatch arrangement. For example, sir, in India, dividend is exempt, and for other country, interest is non-deductible. In that case, India can amend the tax treaties and make dividend taxable in such cases where other party has got deduction of the same. India can make the dividend taxable in India if other party has already got deduction of the same. So general recommended amendments, you can ignore this. You can ignore this. The third one is controlled foreign operations. Just give me a second. Okay, so controlled foreign operations. What happens in action plan 3 is many of the entities that are located in high tax paying jurisdiction transfer their income to the areas of low tax jurisdiction. That is nothing but controlled foreign operations. For example, if an entity is located in, for example, India, It is located in India, and India pay taxes at the rate rupees 30 40% for foreign company and 30% for domestic companies. Sir, it has transferred its income to a country located to an entity. It transferred its income to entity located in Cayman Islands. Sir, where tax rate is zero. Tax rate is zero. So this is controlled foreign operations where you directly transfer your income. You directly transfer your income. Sir, for that matter, what you have to do, sir, you have to make CFC regulations which are active, which are applicable on passive income like interest, royalty, dividend, or any other transaction with the related party. You have to make the laws because of the CFC only we got transfer pricing. Okay, action plan number 4, what it says. So simply action plan 4. Sir, action plan 4 implies 94B. Sir, if you remember, 94B is nothing but transfer pricing. Sir, interest paid to associate enterprise. Whenever you are paying any interest to associate enterprise, sir, your interest should be up to 30% of EBITDA. You are not allowed more interest than 30%. Sir, what these entity used to do? Sir, these entity used to dump loan in the countries which has higher tax paying jurisdiction, and for that matter interest is being allowed too much, and on that too much of interest has been allowed and too much of tax has been reduced. Gets reduced. So for that matter capping of interest was being asked in action plan 4. OECD recommended to fix the interest payment. What India did something 94B of transfer pricing. India did 94B under transfer pricing. Sir, what OECD recommended, just remember these 3 points. Sir, what is group fixed rule? If you are paying any interest to any of the associated price, up to a specified limit of EBITDA will be allowed. That is fixed ratio rule. That whenever you want to pay interest to associated price, specified limit will be allowed. That is group fixed rule. That is 30% of EBITDA in our case. The group rule, for example, if you are paying a certain interest to associated enterprise, sir, 20% is allowed. Sir, you are paying interest to any other person who is not related to you but is a part of multinational entity of that who is a part of multinational group. Sir, what I am saying is, for example, Rahul pays interest to any entity, for example, Rachel, and Rachel is its associate enterprise. So, sir, you have to fix the amount of interest. You have to fix the amount of interest. You have to fix the interest. This is fixed ratio rule. Sir, but you are not paying interest just to Rachel. Sir, you are paying interest to Ross. Sir, you are paying interest to Chandler. You are paying interest to Phoebe. You are paying interest to Joey. Sir, all these together form a bunch. They all are group and you are paying interest to a group. So you have to fix the limit payable to whole group. You are paying to Rachel that 20% is allowed, but whole group should be maximum 50% of EBITDA. You cannot pay interest more than 50% of EBITDA to whole group also. And so, what are targeted rules? Targeted rules is nothing but for banking companies, there are certain regulations that are not relevant for examination. You just need to remember fixed rule and group rule. And what India did 94B, that is transfer pricing. How will you remember? So, action plan 1, digital economy. Action plan 2, sir, hybrid mismatch arrangement, interest for one, dividend for other. Section number 3, sir, controlled foreign operations, control foreign what was it? Controlled foreign operations. Yes. Action plan number 4, sir, interest payments, sir, interest deduction. Sir, action plan number 5 was counter harmful tax practices. Sir, what big entities used to do? They used to do research and development in countries which were having high tax paying jurisdiction. But they used to register such royalty, such patent in the countries with lower tax. So whatever the income that we used to receive in low tax paying jurisdiction, interest was reduced to a very lower extent. So tax was reduced to a very lower extent. For that matter, certain suggestions were made to counter this harmful tax practices. What it said, every country should promote research and development. For that matter, any kind of patent that has been developed in your country should be taxed at a lower rate. That is what the suggestion of OECD was. What India did, India brought 115 BBF. 115 BBF. So action plan number 5, 115 BBF. Sir, what 115 BBF was? 115 BB was in tax on royalty. If any of the royalty is registered in India and more than 75% of the expenditure is incurred in India, then whatever the income of royalty that you are receiving will be taxed at the rate 10% without any deduction of any expenses. So that is what India did. So this is many a times a question has been asked, what is nexus approach that India followed under base action plan number 5 of BEPS? What is the nexus approach India followed? So India followed approach under Section 115 BBF, whereby taxing the royalty at the rate 10% only if such 75% of such expenditure on research and development of such royalty is incurred in India. So next one is, sir, preventing treaty abuse. Sir, taking advantage of the treaty of the other country when it is not meant for you. So Action Plan 1, Action Plan 7 is, sir, Action Plan 7 aims to protect the treaty from those which is not meant for them. For example, what happens is, I am not allowed, I want to reduce my tax burden. And Mauritius says that this kind of interest for which I am avoiding tax, this kind of interest will be taxable at a rate at lower rate. So instead of directly receiving that income in India, I received that income in Mauritius, and then again I'm just transferring such income to India. For example, what happens is, for example, I am receiving interest from USA interest. So this interest is taxable at the rate 30% in India, but this similar interest is taxable with Mauritius. Mauritius at the rate, so 10% only. So I am receiving this from Mauritius and then later on transferring this income to India. Got this point? Yes, sir. Got this point. No issue with that. Sir, treaty abuse, preventing treaty abuse, taking advantage of the treaty or other country when it is not meant for the person. So you could have directly received money from USA, but in this case, you are transferring your money via Mauritius, so it is not meant for you. So that is the aim of this action plan, to prevent the treaty abuse. Sir, what were the OECD's recommendation? Sir, there were three recommendations. So there were actually two recommendations. First one was, sir, LOB rule. Sir, limitation of benefit rule. Sir, what limitation of benefit rule was? Sir, interest at the rate 10%. Interest at the rate 10% is only applicable if it is kept for at least 10 years. If that money is kept for 10 years, so limitation of benefit, so that excess money cannot be repatriated to India, or money should not be repatriated. Or sir, listen. For example, interest will. For example, India India gets to pay lesser tax in Mauritius. India gets to pay lesser tax in Mauritius on business income. For example, tax rate is 5%. Whatever income that Indian person earns in Mauritius will be taxable at the rate 5%. But it is only applicable if you spend at least 70% of the money in Mauritius only. It is only applicable if you do 70% of the expenditure in Mauritius only. So this is limitation of benefit. You are limiting the benefit. You are only allowed benefit if you do certain expenditure. In that case, this is limitation of benefit. Sir, then second one is PP2 rule. So general anti-avoidance rule to general anti-abuse rule on the basis of the principal purpose of the transaction. Simply said, this nothing but principal purpose of transaction should be safe. So for that matter, general anti-abuse rule should be introduced. And also clearly stating that this treaty is for avoidance of taxation and not for treaty shopping. This treaty is clearly for avoidance of non-taxation or not for treaty shopping. This treaty is clearly stating in that treaty that this treaty is for avoidance of taxation and not for treaty shopping. Not for avoidance of taxation and not for treaty shopping. Clearly, you should state in preamble. Last point is, sir, what India did. Sir, India Mauritius treaty says that 50% of the tax, sir, whatever tax rate between India and Mauritius country is, sir, of that 50% will only be applicable. Sir, for example, Mauritius tax Indian business income at the rate 30%. But sir, Mauritius gives 50% concession. But this 50% concession is only allowed if operating expenses are greater than 7 lakh. If operating expenses in Mauritius are greater than 7 lakh, then only this benefit is applicable. This concessional tax rate is applicable only if operating expenses are more than 7 lakh. This is example that what India did. Action Plan 7. Sir, artificial avoidance of PE. Sir, many a times foreign companies try to avoid the status of PE. For that matter, what to do? Sir, define all the different type of activities as PE. Sir, recharacterize the meaning of the PE. Change the definition of the permanent establishment to include all the things that can be related to constitute PE, but they are not constituting. So what it says, sir, activities of closely related entities should be examined together and define PE accordingly. Permanent establishment should be redefined to include even those activities that do not constitute PE should also be constituted as PE. Action plan number 8 to 10. Sir, less relevant. Sir, in case of transfer pricing, in case of transfer pricing of intangibles, you have to take strict actions because intangibles pricing cannot be easily determined. For that matter, you have to really you have to do real research to find out the actual price of intangible. So for that matter, pricing of intangible is important in case of associate enterprises. Sir, contractual allocation of risk and rewards, sir, what how uh, head office expenses will be allocated to branch, how that allocation will be made, that is important. Action plan 9 aims to do that. Action plan 10, high risk areas, for example, allocation of transactions between which are not commercially rational, or the transfer pricing or branch and overall expenditure. So ultimately high risk areas that can cause BEPS is being looked upon by action plan number 10. So do you want to focus on this? You can simply ignore these 3 points. Action plan 8 says pricing of intangible. Action plan 9 says contractual allocation of risk and reward. And action plan 10 says focus high risk areas, including profit allocation, transfer pricing to divert project, and branch expenses, including over or under allocation of expenses. This is what the action plan 8, 9, 10 is. Action plan 11. Sir, you have to identify whether BEPS is happening or not. Whether BEPS is happening or not. So there are certain indicators which tell whether BEPS is happening or not. So you have to measure and monitor whether BEPS is happening or not. This is action plan 11 to curb the BEPS. What are the 6 steps? What are the 6 or 5 steps in cases which indicate that BEPS is occurring or not? So first of all, profit rate of MNE and affiliate is in lower tax countries is higher than group average. So for example, country is an MNE. So it has a branch in USA. Sir, USA profit percentage is 10%. Sir, in Dubai, where tax rate is zero, profit percentage is 100%. Sir, in India, where tax rate is 40% for foreign company, tax rate is 10%. Sir, you can see simply, sir, group profit is lesser, but profit in low tax countries is higher. This means it is an indication of base erosion and profit shifting. Second thing, effective tax rate by MNE is lower than tax paid by the domestic tax countries. Sir, for example, sir, here tax rate is 10%. Sir, here tax rate is 100% and here tax rate is 10%. In this case, sir, effectively it is paying lower tax rate. Sir, effectively it is paying lower tax rate. Sorry. This is the profit percentage. This is the profit percentage. So let us assume tax rate is USA is 40%. India tax rate is 40% and Dubai tax rate is 0%. Sir, effective tax rate paid by this entity is way lower than tax rate in domestic countries. A domestic company's tax rate is 40%. Ideally, average tax rate should be nearly to this, but it is way lesser than this domestic tax rate just because it is diverting its income to no tax paying jurisdiction. This implies that it is an indication of BEPS based erosion and profit shifting. Sir, foreign direct investment is concentratedly increasing. Sir, for example, more of the income, more of the investment is being made to Dubai so that more profit can be generated in Dubai. So this is also an example of BEPS where more profit is being attributed to Dubai by investing more capital to Dubai. Sir, location of value creation and taxability is different. For example, complete production is being made in USA, but profit is being taxable in Dubai. Sir, profit generation place and value creation place and profit generation places are different. This is an example of base erosion where value created is in Dubai. For example, royalty is being developed. Royalty is being developed in USA. Complete expenditure is done in USA, but it is registered in Dubai. So value creation is in USA, but taxability turns out to be in Dubai. So for that matter, this is also an indication of BEPS. The last one is debt received is highly concentrated in high tax countries. What it implies, whichever country has high tax rate, sir, more and more debt will be inflowing in that country. Why this will be so? Because it will be paying more interest and more interest will be deductible and lesser profit in that country. So this is also an indication of BEPS. You can leave this royalty point. If you write these 5 points, it will be more than sufficient for you. So action plan number 12. So disclosure of aggressive tax planning arrangements. Sir, OECD recommended that income tax department shall be equipped with early information regarding potential tax plannings. Income tax department should be equipped with early information regarding tax plannings so that they can do things way before time. Also, include disclosure requirements in tax laws. Sir, every entity that is local to that nation should do more and more disclosure requirements so that income tax department can take informed decision. And also, tax laws should equip income tax department so that they can so that they can work proactively to find out whether there is potential aggressive tax planning or not. So these two things should be done as per OECD to avoid aggressive tax planning. What it said income tax department should be equipped with so much of techniques or so much of powers so that they can actively find out potential aggressive tax plannings. And second thing, so disclosure requirements should be increased as per your tax laws. Action plan number 13, sir, transfer documentation and transfer pricing. Sir, we have three documentations required. Local file. Sir, transaction details. Every kind of transaction exceeding 1 CR should be reported in local file. Sir, master file details of company. Sir, what it does. Sir, incorporation status, other entities in the group, and sir, place of incorporation of those master file. Sir, only required if turnover of the group is greater than 500 crore and sir, associate enterprise transaction is greater than 50 CR, or sir, intangibles is greater than 10 CR. We have studied this in transfer pricing. Or sir, country by country reporting. If group revenue is greater than 6400 CR, then only this is required. Sir, India adopted section 92D documentation and 286, which is sir, country by country reporting. India did this thing. Action plan number 14, making dispute resolution more effective. Sir, making dispute resolution more effective. How to do that? For that, you have to enter with mutual agreement procedure, like we did in we did it in MTC chapter. We did in MTC, where dispute resolution process becomes more effective. How will it become more effective? Sir, by sitting together. When competent authorities of both the countries sit together and decide different things, decide upon different disputes, then disputes will solve. For that matter, mutual agreement procedure should take place. Cases where MAP are timely process and MAP is mutual agreement procedure is accessible to every taxpayer, that should also be the case. So, for example, to minimize the risk of uncertainty and unintended double taxation, such mutual agreement procedure should take place between the different countries. Even every DTAA has a clause for mutual agreement procedure. Last one is the action plan 15 is developing a multinational entity. Multinational instruments are multilateral instrument, MLI, multilateral instrument. Sir, this topic is big and this topic is less relevant for exam because it has not been asked. Only two or three things are important. Just focus on this. Sir, what is MLI? Sir, if you want to amend the tax treaties of all the countries, for example, royalty taxable in India previously was 10%, but for your exam it is 20%. Tax rate on royalty and FTS has been increased as per 115A. Now India has to amend every treaty. Do every country wants to know that tax has been this has been amended, the tax rate has been amended. For that, there has been there an instrument has been designed so that instead of amending every treaty, just add an annexure to it, and that annexure will serve as change to every country. That is nothing but MLI. Develop a multilateral instrument which will act as an annexure, which will act as an addendum, so that instead of ratifying every treaty, so single treaty can be every treaty can be ratified with single instrument. This is what MLI is. Sir, but for MLI, you need to remember that flexibility should be given to other SSCs also, other countries also. For example, uh, if I am willing to tax a certain income and I ratified it with MLI with that instrument, so that other entity should also have flexibility whether to opt for that or not. Whether to opt for that or not, it gives flexibility also. Okay, sir, no problem. Sir, key organs of MLI, sir, covered tax arrangement. Sir, covered tax arrangement are nothing but sir tax plans that involve moving money between the countries, and they are closely watched for dodging for to prevent the tax dodging. So covered tax arrangement are nothing but sir plans that involve looking at the transactions that are done between cross borders to prevent the tax dodging. This is nothing but covered tax arrangement. This is also an organ of MLI, sir. So MLI should also be drafted in such a way that it involves sir covered tax arrangements so that tax dodging or tax planning can be avoided. Sir, MLI should have compatibility clause, like how things will get transferred from MLI to DTAA. Compatibility should be given. Sir, reservation clause should also be given. Sir, reservation clause implies, sir, what things you don't want to apply, you should not apply. That reservation should also be given in MLI. Sir, minimum mandatory standards. So certain minimum things are required to be accepted by every DTAA. So for example, sir, countering harmful practices and sir, country by country reporting should be incorporated in local tax laws. And sir, treaty abuse prevention and effective dispute resolution should be bare minimum standards between any two DTAAs. Sir, enforcing of MLI is not relevant. So this was all about your base erosion and profit shift. Whatever I have asked you, that is only relevant for examination. Even if you want to do something more, just solve question answers from module. With that, we have completed complete international taxation with minimum time possible. I request you to just go through the topics, whatever we have studied, or if you have gone through along with, then no issue whatsoever. But you have to solve question answers of transfer pricing, and non-resident taxation, and a few questions of DTAA. I have given you the list of questions. I have given you question bank. I have given you super 80 questions. You can solve that also. Apart from that, if you want to solve questions on your own, how many questions per chapter you should solve, I have also uploaded a video on YouTube. You can refer that. For every chapter, at least one or two questions you need to practice. That one or two question which represents the whole chapter should be solved. So for that matter, superity is also given, and number of questions per chapter list is also given on YouTube. You can refer that also. Most probably, if you are referring this video a day before examination, a very hearty all the best to you. And congratulations on bearing me for this long, because I know my English is not that great today. And thankful enough that you could bear me till now. So not an issue. All the very best. Enjoy studying. Enjoy studying with same enthusiasm, excitement, and energy. If you have any doubt, just come to Telegram channel. I will be there to solve your every doubt in income tax. Not just before exam, but even after exams, I'll be there for you. If you're worried about anything, I will be there for you also. But only thing you have to do is do not panic. Just focus and continue studying, because that is what you are meant to do right now. That is what the thing is important for you right now, and you have to study and nothing else. Believe me, once this process is done, this will be the most relaxing period. Once you become CA, it will be the most relaxing, the most satisfying thing in your life. I have experienced that, and I want all of you to experience the same. See you guys in the next one. See you in the Telegram channel. I will continue motivating you all, continue to upload such videos. If you want any video on international taxation, or if you want any other topic, just drop down in the comment section. If time permits, I will come a video on that also. Otherwise, I will just drop audio regarding the concept. No issue whatsoever. I am yours. This book is yours. Concept bank is yours. You can refer anything, anytime. Just I want an assurance from you all to that you will score 60 plus in this attempt. Minimum 60. You will be attempting at least 100. Not that I'm not compromising on marks you are attempting. 60 marks is your aim to score minimum. For that, you have to attempt at least 95 plus. Then only you will be able to score 60. So that's all from my side. See you in another video.